Hello guys, come on, let's quickly revise Accounting Standard 1 Disclosure of Accounting Policies. To start with, what exactly do we mean when we say accounting policies? Accounting policies are accounting principles and methods of applying these accounting principles in preparation of our financial statements. You cannot complete your financial statements without coming across accounting policies. In various segments of preparation of financial statements, you will surely come across accounting policies. To give some examples, whenever valuing inventory, which method of accounting policy should you apply? Which method of valuation of inventory should you apply? Should you pick first in first out? Should you pick simple average method? Should you pick weighted average method? Accounting standard 2 tells that you can pick between FIFO or weighted average method for items which are ordinarily interchangeable, and specific identification method for items which are not ordinarily interchangeable. These two options what accounting standard 2 provides us, among which we can pick one, is an accounting policy. Similarly, in terms of valuation of fixed assets, there are two models which accounting standard 10 PPE prescribes. We can either follow cost model or we can follow revaluation model. Whichever one you pick is your accounting policy. So in this way, whatever the policies which are given as an option by the standard for us to follow is our accounting policies. So accounting policies, as I just mentioned, it is significant accounting principles and methods of applying these accounting principles in preparation of financial statements. Similarly, in investment accounting, you have an again option to do FIFO or weighted average method. When you are trying to value retirement benefits, again you have option. All of these options together is what we call as accounting policies. Now, how to pick among these several options that we have? We have two considerations. One is primary consideration, second one is secondary consideration. Primary consideration is very simple. We need to keep our financial statements true and fair. In order to keep the financial statements true and fair, whichever accounting policy gives us the best results, we follow that accounting policy. If both the options that we give, both the options that we have are giving true and fair view, then we go to secondary consideration. Secondary consideration are three. 1. Prudence. 2. Substance over form. 3. Materiality. It is not one of these, but all the three of these have to be considered. Prudence, by prudence we mean practicality. You need to be very practical when you do accounting. An example for prudence is conservatism. We need to account for expenses as and when we incur, and we need to account for losses even before it materializes. However, if you expect an income, it is not conservative to record it till the time it materializes. So by prudence we record profits and assets only when we acquire them, but we record the losses even before we actually incur that loss. So we are trying to record our profits and assets at not an overstated value, but if in case we expect a loss or we have a liability, we don't want to understate it. That's the concept of prudence. And when it comes to substance over form, we need to ensure that we record the items by their reality and not just by legality. If in case you buy an asset but it's not registered in your name legally, just because it is not registered in your name legally is not a sufficient area for you to postpone the recognition of the asset. Asset has to be recognized based on substance over form. Wherever there is a clash between accounting reality and legality, accounting reality will win over the legality, and you need to go by the reality in accounts to record the same. We'll have an instance of this in accounting 4 also, accounting standard 4 also, and you'll read this in multiple other places. And the last one is materiality. Materiality is we need to disclose all the items which are going to have substantial or material impact on the user. Now, by disclosing this information, the investor will take a different decision, and by not disclosing this information, an investor will take a different decision. In such a scenario, it is our responsibility when we prepare financial statements to disclose all such information which is material and necessary for the user to take his decision. So I'll quickly run you through everything what I just told now. The basis to decide accounting policy are true. The primary consideration is to ensure that the financial statements have true and fair view. The secondary consideration is prudence, substance over form, and materiality. Next, there are certain assumptions given under accounting standard 1 which are called as fundamental accounting assumptions. These are going concern, accrual, and consistency. The reason why these are called as fundamental accounting assumptions is whenever we follow going concern, whenever we follow accrual system of accounting, or whenever our accounting policies and principles are consistent, there is no need for any separate disclosure. However, when we don't follow going concern, when we are not following accrual system of accounting, or our accounting policies followed are not consistent, then it is our responsibility to disclose that we are not following going concern, we are not following accrual system of accounting, or this specific accounting policy is not consistent. So with regard to fundamental accounting assumption, no disclosure is required when it is followed. However, disclosure is required when it is not followed. All of these significant accounting policies, what we call as SAP, is followed in preparation and presentation of financial statements. All of this should be disclosed. Now, can I disclose this in various places? I'll disclose one accounting policy in balance sheet, one in P&L, one in cash flow statement. No, you need to disclose all of them at one place. All the accounting policies which are significant, which are followed by the organization, are required to be disclosed at one place. And if in case you have not followed any specific rule of accounting, any specific policy which accounting standard mandates us to follow, we have followed the policy which accounting standard doesn't want us to follow. Like simple average method is not allowed under accounting standard to valuation of inventory. If you followed it, you will disclose it, but disclosure is not a remedy. I cannot go kill someone and then say, yes, I agree, I have killed. You can't sue me now, or you can't put me behind bars now, because I am accepting it myself. Acceptance is required, but acceptance is not a remedy. Acceptance doesn't make the error good. Error will remain an error. Not following the accounting policy to be followed, or following the wrong accounting policy, requires disclosure, but such a disclosure is not a remedy for doing something wrong. And the last point that I want you all to note with regard to accounting standard 1 is changes in accounting policy. I told you some time ago that going concern, accrual and consistency is a fundamental accounting assumption. An organization should be consistent when it comes to the way it prepares, the way it follows accounting policies from one accounting year to another accounting year. But are you allowed to breach that flow? Can you stop that flow? Can you follow a different accounting policy from one year to another year? The answer is yes. You are allowed to change your accounting policy, which is an exception to consistency. But in order to change your accounting policy, it should be one among the following three reasons. Reason number one is the statute or the law has changed and the law wants you to change the accounting policy. Or the accounting standard has gone through a change and the new accounting standard wants you to change the accounting policy, or the paragraph in the accounting standard has been amended requiring you to change the accounting policy. Last one is for the sake of appropriate presentation of financial statements. Maybe you followed an accounting policy which is correct, but there is another accounting policy what is best suited for your organization. It will show better financial results, better presentation of financial statements. When I say better presentation, I am not meaning to say higher profit. More appropriate, more reliable financial statements, or more reliable financial statements can be prepared with such change in accounting policy. In such cases, you should change your accounting policy and adopt the new one. And this is the quick revision on accounting standard 1. Let's quickly revise accounting standard 2, valuation of inventories. Objective of this standard is to help us identify the value of inventories to be taken in evaluation of financial performance and also to evaluate financial position of an entity. The scope of the standard is given in paragraph 1, which tells us what are the items for which accounting standard 2 valuation of inventory is not applicable. It says it is not applicable to WIP arising in construction contract. Will be regulated as per accounting standard 7, and for WIP arising in service contracts for which revenue has to be recognized as per accounting standard 9, and for service entity there is no inventory. If inventory itself is not there, what is AS to doing there? Nothing. Then we have shares and debentures. For shares and debentures and other financial instruments, we won't apply accounting standard 2, because even if you are trading them, it is not your inventory. It has to be regulated as per the specific standard issued, which is accounting standard 13, which specifically talks about investment accounting. It doesn't matter whether it is share or debenture, whether it is equity share or preference share. Further, standard talks about certain items which are not covered under inventories, like livestock, forest and agricultural produce, mineral oils, ores, etc. These are all producers inventory. What we call them? These items are not under the purview of accounting standard 2. In fact, these are not under purview of any accounting standard. When we discuss 10 also, we'll tell that these are not covered under accounting standard 10. So then how do we value them? Paragraph 2 of the standard tells that we can value these items at net realizable value. However, there is no specific standard applicable. Inventories like livestock, forest, agricultural produce, mineral oil, ores and gases, will be valued using industrial norms. Going a slightly ahead, paragraph 3 of the standard helps us identify the definition of inventory. As per the definition of inventory, there are three items: finished goods, work in progress, raw material. These three are covered as inventory. Finished goods are such items which are kept in the active business for the purpose of sale, which are held in the ordinary course of operations for sale. Work in progress are such items which are in the process of being sold, in the process of being converted to finished goods. When it becomes finished goods, it will be sold. Lastly, we have raw material which will be consumed in the manufacturing of finished goods. In a manufacturing entity, we'll have raw material, work in progress, and finished goods. If it is not a manufacturing entity, if he is a trader, he will not have raw material, work in progress, he'll only have finished goods. However, if he is into manufacturing, he'll have three variants of inventory: raw material. For example, in a shirt industry, cotton is raw material, cloth is work in progress, ready-made product shirt is finished goods. Further, paragraph 4 of the standard says what are certain items which are actually not covered under the definition of the standard, para 3. However, these, though they don't qualify the definition of inventory under para 3, still accounting standard 2 is applicable to them. We'll value them as an inventory, we'll record them like inventory. What are those items? Material supplies, consumables, and goods. So these three, though they don't qualify the definition of inventory as per para 3, still they'll be valued like inventory as per accounting standard 2. Next, measurement. How do we value all of these items? This is given in paragraph 5. Paragraph 5 of a standard is a very important paragraph and very generic line. It states that inventory should be valued at cost or net realizable value, whichever is less. In this context, what is cost is going to be major part of our discussion in this. However, NRV is not too detailed. I'll tell it to you right now NRV and then go to cost. Actually, the order is first we would have to learn cost and then learn NRV. NRV is net realizable value. That is sale value less selling expenses. Realizable value is sale value. Net realizable value is not sale value. Selling price or sale value is realizable value. It is gross in nature. When we say net, we need to deduct all such expenditure which is incurred to make that sale happen. Transfer expenses, brokerage, commission, or any other expenditure which is incurred for the sale to happen. So selling price minus selling expenses is net realizable value. We will value the inventory at cost or NRV, whichever is less. Reason is conservatism. If you have some inventory, though it is not sold, if its price has gone down and if you are expecting to incur loss when you sell it in the future, such loss has to be booked immediately by way of conservatism. You don't have to wait for actual date of sale to record such loss. Record it right now. How? In the closing stock, when the value decreases, imagine your trading account credit side value decreasing, trading account debit side value decreasing, GP will immediately decrease. Hope you people are getting this. Talking about cost, what does cost include? Cost includes three items. One, cost of purchase, conversion cost, and other directly attributable expense. Cost of purchase. Cost of purchase will include purchase price, duties and taxes. Duties and taxes like GST, central excise duty, or custom duty, entry tax, anything that you pay. Should we include them or should we not include them? Depends whether input tax credit is available or not. If input tax credit is available, then you will take the input tax credit. Why do you add it to the cost of inventory? Don't add it to the cost of inventory. Take the cost of inventory as purchase price after deducting duties and tax. However, if input tax credit is not available, you purchase from an unregistered dealer, in or you for it's a blocked credit, or for some other reason if input tax credit is not available, in such case such amount of tax paid will form part of the cost of the inventory. I hope you got that. Then any freight expenditure, that is travel expenditure or transportation expenditure in any form incurred for bringing the goods from the place of purchase to the place of, so such freight expenditure is included. Any other directly attributable cost that you incur will be included if it relates to the value of the inventory, if it adds value to the inventory, if it is mandatory to be incurred to bring the inventory to the place of sale. One item has to be deducted: trade discount, if any allowed by the supplier, you deduct it. If there is cash discount, what will be attained only and only when you make the payment, that should not be adjusted. That will go to P&L account. So if say, let's say the price is 1 lakh rupees, cash discount of 5,000 is allowed. Inventory's cost is 1 lakh. That 5,000, don't deduct it from 1 lakh to make it 95,000. Inventory value is 1 lakh, 5,000 rupees discount received will go to P&L account credit side as income. Cash discount doesn't decrease the value of inventory, trade discount does. Then we have what are the costs of conversion. expenditure incurred to convert the raw material from, sorry, expenditure incurred to convert the inventory from raw material to finished goods. This can be categorized into two: variable, sorry, direct, indirect. If it is direct, it is direct material, direct labor, direct expense. Directly related to the inventory, in fact, you will have the per unit data available included at the per unit rate into the inventory. However, if it is indirect in nature, it can be further classified into two major classifications: variable overhead, fixed overhead. Variable overhead is such overhead which varies with the level of production. Higher the production, higher the overhead. Lower the production, lower the overhead. So here per unit data will be available. Total overhead divided by number of units produced. That will be allocated to each unit produced. That's not at all difficult. The beauty opens up when it is fixed overhead, meaning irrespective of the level of production, the expenditure is fixed. Whenever there is fixed overhead, that is expenditure is fixed irrespective of the level of production. What do we do in such case? Then compare normal production with actual production, or normal capacity with actual capacity. If the actual capacity or actual output is equal to or lesser than normal capacity, then total fixed overhead is divided by normal capacity. I repeat, if actual capacity is equal to or lesser than normal capacity, total fixed overhead is divided by normal capacity. However, if the actual capacity is more than normal capacity, then scrap this normal capacity, deduct the total overhead by actual capacity. Why? In costing, we have a concept of under absorption, over absorption. Accounts, we don't. There is no concept of over absorption in accounts. You cannot make profit on the expenditure incurred. So we charge the total expense based on actual units, because our estimation of capacity has gone wrong is what we believe in. And in costing, you adjust it with standard costing, adverse and favorable. Here we don't do that. Here we charge it to the inventory totally. If the actual capacity is more, we don't overcharge. If it is less, we'll check. If it is less, then such unused production capacity should be charged to P&L, not to the inventory. So that is the reason we do it based on normal capacity when actual capacity is less. However, if actual capacity is more, charge it based on actual capacity, not on normal capacity. Then we have other expenses. Any other expenses which is incurred to bring the goods to present location and present condition should be included in the value of inventory. That's what other cost paragraph says. Then what costs are excluded? Certain costs are specifically excluded. Number one, abnormal loss. Abnormal loss and normal loss are different. Loss which can be mitigated, loss which can be avoided, loss which can be controlled by taking specific measures, or normal loss. Loss which cannot be controlled. Sorry, loss which cannot be controlled, cannot be mitigated, or not in our control, or normal loss. This has to incur. We can't stop this loss. But loss which can be controlled, which can be mitigated, which is something within our control. If we follow correct measures, we won't incur such loss. That is abnormal loss. Normal loss, we can't do anything, no. So what do? We'll adjust it in units column only. Whenever we adjust normal loss, total value will be same for lesser number of units, because of which per unit cost will go up. So normal loss increases the cost per unit. Normal loss increases the cost. However, abnormal loss, we're going to deduct it in units column. We will also deduct it in amount column, because of which the cost per unit in the case of abnormal loss will remain same before and after. I repeat, in the event of normal loss, units are only deducted, value is not deducted, because of which per unit cost will increase for the good units remaining after normal. In the event of abnormal loss, number of units is reduced, value assigned per unit is also multiplied and written in amount column, because of which total value will also reduce, because of which what's happening, there is no increase in per unit rate, per unit will remain same. Such an amount what is there for abnormal loss should be charged to P&L, it will not be charged to inventory. Normal loss, I told you, no, total value will be same, per unit cost will increase. So normal loss is included, abnormal loss is excluded. What about storage cost? Any expenditure incurred to store the inventory at one place, this will not increase the value of inventory unless it is part of the production process. For example, timber, rice, wine, you have to store it to call the product complete. So then the storage cost will be included in the cost of the inventory. Otherwise, storage cost is not included in the cost of the inventory, that should be charged to P&L. Any other administrative overhead, selling and distribution overhead, which is incurred in the ordinary course of operation, should not be charged to inventory. I hope this made sense. Then, talking about valuation techniques, we have several valuation techniques. You would have learned this in your CA Foundation, chapter 4. If the units are ordinarily interchangeable, one unit can be replaced with another, then considering historical cost. We learnt in foundation that we have FIFO, LIFO, SAM and VAM. But AS2 says you can either follow first in first out method or weighted average method. These two methods can be followed if ordinary items are ordinarily interchangeable. One product can be exchanged with the another, and we are considering historical cost. If we are not considering historical cost, for example, we're doing business in FMCG sector where number of units involved is huge, value per unit is very less. There we follow adjusted selling price method. We'll identify the closing stock at selling price, eliminate the profit margin from this. That will give us closing stock at cost. Or standard cost. Standard will fix cost price per unit, multiply with number of units that is there. That itself is the cost price of the closing stock. Standard cost method or adjusted selling price method. If we cannot replace one product with another, if the business is like customized clothing apparel or jewelry, all of this, one product cannot be replaced with another. There we should go by specific identification method. For every unit of inventory, we need to specifically identify the value of inventory. We cannot skip. Are you getting this? This is with regard to valuation techniques. And next comes to the part where what if in one production process more than one product pops out? We'd have to check whether the product that's popping out is a joint product or a byproduct. When do we call it joint product? When do we call it a byproduct? If the product has commercial viability, it has commercial value, it is material, it is joint product. If not, it is immaterial. It has no commercial value. It doesn't, you didn't have an intention to manufacture it. You are ready to throw it into that gutter. Then it is byproduct. Get this? Whenever it is joint product, the cost that you incur in the entire production process has to be allocated to both the joint products. How do we do it? If that expenditure is incurred after the split off point, after you split and then started processing both the items separately, then you have separate costs, allocate that cost to them. If this expenditure is incurred before split off point, that is when the processing is happening together for both the products, that has to be apportioned to both the products. How do we do it? In a common basis which is reasonable and viable and logical. That reasonable, viable, logical basis is sales value. That sales value can be taken for joint products at the time of sales, at the time of split off point, or at the final point of sale. Wherever it is more clearly and evidently available, such sales value will be taken, not sale units. Sometimes one joint product sale value is high, number of units is less. One more joint product, sale units is more, value is less. So we should take number of units multiplied by selling price per unit value of two joint products. In that ratio, we apportion the joint cost incurred for both of them. If it is byproduct, there is no separate valuation for byproduct. It is valued at NRV, net realizable value. And this net realizable value of the byproduct will be deducted from the cost of production of the total main product. This is if the byproduct is immaterial. It is called as a byproduct when it is immaterial. After some time, I told you a beautiful example if you remember, that cocoa powder and yeah. So if in case this byproduct ends up becoming a material product, so then don't treat it like byproduct, treat it like joint product, allocate cost to it on a reasonable basis. You get that? That's with regard to joint product and byproduct. How do we value raw material? How do we value finished goods? Valuation of raw material actually depends upon how do we value our finished goods. If finished goods are sold at cost or above cost, then finished goods are valued at cost, and then raw material is also valued at cost. If finished goods is sold below cost, then finished goods will be valued at NRV, because finished goods is sold below cost. No, NRV is lesser than cost. Finished goods will be valued at NRV. When finished goods are valued at NRV, finished goods are sold at loss. Raw material might be sold at loss. Raw material, you are not having a proper intention to manufacture a finished goods. Then what do? Then our raw material will be valued at cost or NRV, whichever is less. However, if NRV of the raw material is not available, we'll take replacement price of the raw material as the reasonable. How do we value our work in progress? Work in progress, there is no active market. Cost incurred for work in progress plus cost expected to be incurred to complete it. If we add, we get the total expected cost when it becomes finished goods. Compare that with NRV of finished goods. Take whichever is less. If whichever is less turns out to be cost, then you know what's happening? Finished goods will be sold at profit. So we have proper intention of manufacturing work in progress into finished goods and sell it at profit. Profit will be recorded only when you sell. conservatism. So value work in progress at cost. Value work in progress at. However, when you take the work in progress cost incurred plus cost to be incurred, you will get the total expected cost and you compare it with NRV of finished goods, then you get whichever is less is NRV. Meaning this work in progress, when it becomes finished goods, it will be sold at loss. Conservatism, would have to book that loss now. What do? That loss has to be deducted from cost incurred. That will be the value of WIP. That will be the value of. Alternatively, you can take NRV of finished goods, deduct the cost to be incurred on WIP. You will get the same answer. Either of the approaches, if you follow, you will get the same valuation of WIP. So read this part once again. This is slightly tricky. Then can we reverse the writing down? We had written cost or NRV, whichever is less to NRV. NRV which is lesser than cost. Can we reverse it? Yes, we can. If the conditions prevailing because of which NRV was lesser than cost have reversed. Such economic condition has reversed. We can reverse and restore the value of inventory to cost, not above cost. Inventory cost is 100, NRV is 80. So because of some reason, some downfall in the market, some lack of demand, we valued the inventory at 80. Next year, if such economic condition has reversed, we can take the value of the inventory back till 100, not for a price more than 100. This is a quick revision on accounting standard 2, valuation of inventory. Got it? A quick revision of the topic of cash flow statement. As the name itself says, cash flow statement is a statement. This is a statement which is financial statement. Section 2 subsection 40 definition as well as section 129 of Companies Act covers this cash flow statement. And this is a statement which is prepared to analyze cash flow. We can say that cash book also does the same thing, but cash book analyzes the cash flows into only inflow outflow. Here, each inflow and each outflow is further analyzed into three major activities, that is financing activity, investing activity and operating activity. Any business to originate, first you will get the idea, then you will raise the money, you will use that money and set up the infrastructure and then you do operations. Same is what we are trying to analyze here. When you raise the funds by way of issue of equity shares, issue of preference shares, issue of debentures, raise of loan, it's all financing inflow. Using that you set up infrastructure, buy assets, that is investing outflow. And later you start your business, buy goods, convert the goods to work, finished goods, and then pay expenses, sell the goods, do the business. That's operating activities. And once you get the profit, using that profit, you pay interest, you pay dividend, that's financing outflow. You're done with the business, now you want to stop your business. You sell your assets, investing inflow. And using that you repay debt, financing outflow. You repay debenture holders, financing outflow. You redeem preference shares, you buy back equity shares, you basically close down the business, that is financing outflow. So do you understand how we're trying to analyze the flow of cash in and out into each of the activities? By having a look at these activities, we can understand the pulse of the organization. If too much of investing outflows are there, then the organization is growing. If investing inflows are more, the organization is selling its assets. It's basically closing down its operations. Huge financing inflows means they're borrowing more and more money. They're raising more and more capital. Repayment of debt and buyback of shares, redemption of shares, all of this will lead to financing outflow. That means organization is shutting down. To an extent, it's fine, repayment. But beyond a point, if you're buying back shares and if you're paying back loans, that means the organization is basically closing. And positive cash flows from operating activity tells the profitability of the organization. How rich is the organization when it comes to cash? And this is one of the metrics using which we can scale, we can understand the scalability of the organization as well as the operations and functions of an organization. You get it? Very good. And when we use the word cash and cash equivalent, in this context, the word cash and cash equivalent is very different from what we basically use under the context of Schedule 3. Under Schedule 3, when we say cash and cash equivalent, it includes fixed deposits which is made for a period longer than a year also. And it will never include the context of investments. However, cash and cash equivalent as per AS3 means cash is cash in hand and demand deposits with bank. Demand deposits is savings bank deposit and current account deposit. However, when we say cash equivalent, it includes investments which fulfill four conditions. RISH: readily convertible, insignificant risk, short term and highly liquid. When I say insignificant risk here, it means it should be listed securities or it should be government bonds or of that sort. When we say short term, we refer to the period of 3 months. If it is lesser than 3 months investment, then it is cash equivalent.
If it is even fixed deposit for a period longer than 3 months, it will not be cash equivalent as per AS3. However, as per Schedule 3, it will still be cash equivalent. So the definition of cash equivalent as per AS3 and Schedule 3 are different. It will not match. Please be cautious about this part. And once we talk about this cash flow, whenever we pay dividend, dividend is paid against the shares that we have issued, that will be financing activity. However, dividend received will be usually investing activity because you have invested in the shares of the company and we're receiving dividend out of it. However, whenever we receive dividend, because we are an investment company, our only objective is not to produce a product or give service. Buy the shares, sell the shares, hold it till dividend, and then once we receive dividend, we sell. This is our business. In such a case, dividend received will be operating activity. Similarly, interest paid is financing activity, interest received is investing activity. However, if we are a financial enterprise wherein we don't have a product, we don't have service to give, our only objective is to run our own money, raising the money at lower interest, lending the money at higher interest. So we are money lending business. Our business is a financial enterprise. Then borrowing and lending of money, or it is operational activity. Paying interest and receiving interest will become operational activity. Got this? Then I told you the cash flow statement can be prepared in two formats, two methods. One is direct method, other one is indirect method. What is recommended by AS3 is actually indirect method. What we should prepare prominently in a practical scenario is actually indirect method. If you analyze a cash book, debit side there will be opening balance, credit side there will be closing balance. Receipts on the debit, payments on the credit. Opening, closing, I'll keep it aside. Opening here, closing here. Rest of the receipts and outflows, receipts and payments, I'll cut them into three parts: operating, investing, financing. Operating receipts, operating payments. Together, it will lead to cash flow from operating activities. And investing inflows, investing outflows, investing receipts, investing payments. Together, net cash flow from investing activities. Financing inflows, financing outflows. Financing receipts, financing payments. Together, net cash flow from financing activities. So we have operating cash flows, investing cash flows, financing cash flows, opening cash and cash equivalent to arrive at closing cash and cash equivalent. This is cash flow statement. Under which method? Direct method. Under indirect, it looks very much the same. Only difference is operating is found differently. If you closely observe the financial statements of an entity, balance sheet liability side represents financing activities. Balance sheet asset side represents investing activity. P&L account represents all operational activities. And even further analysis tells us that all the incomes that we have are actually inflows of cash, all the expenses are actually outflows of cash. Income minus expense is profit. Can I say income minus expense profit is inflow minus outflow, net flow from operational activities? We cannot promise that it is cash outflow or cash flow from operational activities, but it is very close. Net profit is a very close item to cash flow from operating activities. It will become cash flow from operating activities if we eliminate few non-cash items or non-operating items that is there in our P&L. So what do? We'll start with net profit as per P&L account after tax. To this, we add back non-cash or non-operating expenses which were previously debited in P&L, like interest charges, like depreciation, amortization. All of these are non-cash or non-operating expense debited to P&L. Because of this, profit has decreased. If I remove the impact of this, my profit will increase to become cash profit. Similarly, there are certain incomes which are non-cash and non-operating but are credited in P&L. For example, dividend received, interest received, profit on sale of assets. So these are non-cash and non-operating, or non-cash or non-operating. These non-cash and non-operating incomes which were previously credited in P&L have increased our profit. Now if I eliminate that, my profit will decrease to become cash profit. So what I would do, I would take my net profit as per P&L account. To this, I'll adjust non-cash and non-operating items. How do I do it? I add back non-cash or non-operating items debited to P&L. I deduct non-cash or non-operating incomes credited to P&L. Once I do this, I won't get cash flow from operating activities. I'll get operating cash profit. The reason why it is not cash flow from operating activities is certain items in the balance sheet liability side and balance sheet asset side actually represent operations. For example, current liabilities and current assets. We cannot look into each current asset and current liability in detail and check how much cash flows have happened. But we can write the net difference. How do we do that? We write changes in working capital. For a current asset, we do opening minus closing and then write it. For current liability, we do closing minus opening and write it. The reason is, whenever there is increase in current asset, it means current asset is being purchased by paying cash. So we do opening minus closing. For a current liability, whenever there is increase, it means we have repaid the loan. So cash and cash equivalent should decrease. Whenever there is increase in current liability, that means you have borrowed the money, because of which cash and cash equivalent should increase. So what do? We take net profit as per P&L account. We adjust non-cash and non-operating items by adding non-cash or non-operating expense debited to P&L, by deducting non-cash or non-operating income credited to P&L. To this, we adjust changes in working capital. How do we do that? We add, one moment, we add current assets minus current liabilities, and we deduct current liabilities minus current assets. For current assets, we do opening minus closing. For current liabilities, we'll do closing minus opening. See, current assets we do opening minus closing. Current liabilities will do closing minus opening. Once we do that, we get cash flow from operating activities before tax and extraordinary items. We deduct the tax paid, and then we get cash flow after tax. If there is any extraordinary but operational items, extraordinary but operational items, they will be written here separately. This is before and that is after. That is to be disclosed separately. What we refer to as extraordinary items under AS 5. I hope you guys understood this. Very good. And whenever I say working capital changes here, there are three items which should not be included in this working capital. Item number 1, provision for tax. Item number 2, proposed dividend. Item number 3, cash and cash equivalent. I repeat, proposed dividend, provision for tax, and cash and cash equivalent. These three items should not be included within that. The reason, proposed dividend, last year's dividend is paid this year, this year's dividend is paid next year. So don't treat it like a current liability. Open ledger, right? Opening balance of liability on the credit, closing balance on the debit. Dividend declared further will be written on the credit, paid during the year will be found as balancing figure. Same with regard to tax. Tax provision is a liability, opening balance on the credit, closing balance on the debit. Further tax provision created during the year will be credited in provision for tax account. We identify tax paid as balancing figure in the debit side. This is the reason why we prepare ledger account. Tax provision created during the year is a non-cash expense debited to P&L. So it will be added back in cash flow from operating activities under indirect method. Dividend we don't add back. Reason is dividend is appropriation item. It will not be debited to P&L, so we don't add back. We add back items because it was previously debited and it has decreased our profit. Dividend is never debited to P&L. It has not decreased our profit, so we don't add it back. But provision for tax has been deducted from the profit to find net profit as per P&L, which is our starting point. So we add back. I hope you guys got this. Cash and cash equivalent will not going to adjust it in changes in working capital because that is the reason no we prepare entire CFS. And in the question, if they've given straight away adjustments, depreciation, amortization, profit on sale of asset, it's very easy. Start with PL, add or less these items, do changes in working capital, pay tax, cash flow from operating activities. However, certain questions they don't do that. They give you PL, they give you balance sheet. In that case, open ledger account for every item with difference in opening and closing balance, or item with same opening closing balance but as adjustment. You get this? But for three items you don't open ledger: current assets, current liabilities, and cash equivalent. But among current assets, current liabilities, you will still open ledger for provision for tax and proposed dividend. In each of this ledger, identify two things: 1, P&L, 2, cash. If it affects cash, categorize operating, investing, financing, check inflow, outflow, write it to cash flow statement. If it comes to be P&L account there, profit on sale of asset, loss on sale of asset, premium on redemption of debentures, premium on redemption of preference shares, or interest received, interest paid, expense paid, some item. All of these items might be non-operating or non-cash items debited to PL, or non-operating or non-cash items credited to PL. If it is non-operating or non-cash items debited to P&L, add back. If it is non-operating or non-cash incomes credited to P&L, deducted. And that's how we close our cash flow statement. Last point that I want you all to remember: whenever you're doing cash flow statement, always keep in mind double entry system and then prepare it in the order, and your cash flow statement is sure short to tally. Let's now quickly revise accounting standard 5, net profit or loss for the period, prior period items and changes in accounting policies. There are 6 items that you should know in this standard. 1, ordinary; 2, exceptional; 3, extraordinary; 4, prior period items; 5, changes in accounting policies; and 6, changes in accounting estimate. Starting with ordinary items: activities which are ordinarily taken care of in the normal course of operations, which are in furtherance of business, which are incidental to business. These items are ordinary items. Ordinary items need no separate disclosure. They can be considered normal in our profit and loss account. Between ordinary items, setting off is allowed if they are same items, if they belong to the same category. If there are two distinct category items, we should not be setting them off. We should be writing them separately. However, based on size, incidence and nature, these items will be considered special. Special is the word used by the standard. Schedule 3 calls these exceptional items. These exceptional items need separate disclosure. How do we disclose them? We disclose nature and amount with an intention to perceive the impact of these items on profit or loss. Understood? Next, we'll quickly understand what exactly do we mean by extraordinary items. Extraordinary items are such events and transactions which arise not in the ordinary course of operations, and these extraordinary items needs to be disclosed separately. How do we decide whether an item is ordinary or extraordinary? Based on frequency and regularity. If it is frequent and regular, it is ordinary. If it is not frequent or irregular, it is extraordinary. However, frequency is not the sole consideration to determine whether it is ordinary or extraordinary. We also use our professional judgment. And these items should be disclosed separately, that is nature of the item and amount against this, with an intention to perceive the impact of these items on our profit or loss. So we understood ordinary, exceptional and extraordinary. Next we'll discuss prior period items. Prior period items are such items which arise in the current accounting period because of an error or omission in one or more previous periods. These prior period items again need separate disclosure. For what? For the nature and amount to perceive the impact of these items on profit or loss. Next thing that we need to note on prior period items is, with regard to prior period items, don't confuse prior period items with change in accounting policy and change in accounting estimate. They're all different. They're not at all same. Got that? Then we have changes in accounting policy. What is accounting policy? It is principles or set of principles followed in preparation of financial statements. Can we change these principles? The answer is no. Who's stopping us? Consistency. However, consistency has certain exceptions. How many? To namely 3. Requirement of accounting standard, change in law and better presentation. For requirement of AS or change in law or better presentation, we can breach consistency and change our accounting policies. So change in accounting policies, change in principles or set of principles that are followed in preparation of financial statements. And whenever we change accounting policy, we have to give it retrospective effect and not prospective effect. On the other hand, in accounting estimates, we give prospective effect. Unless we have a very specific information that it is change in accounting policy, it will not be regarded as accounting policy. If you have doubt between policy and estimate, even you're not sure, you have to go and take it as change in accounting estimate and not policy. You get this? And whenever there is change in accounting policy, remember it is not prior period item, it is not estimate like I just mentioned. And with regard to change in accounting policy, we would have to make 3 disclosures. Namely, what is the change? Why is the change? How much is the financial impact that is arising because of this change? Lastly, accounting estimate. Firstly, what is accounting estimate? It is the value, what to say, it is the way that we go for when we cannot value the item with precision. When we cannot value the item with precision using valuation principles, then using our judgment, we arrive at some value. That is accounting estimate. Accounting estimate is made based on the past understanding, past experience and present situation. However, with more experience and better understanding, that is with change in the circumstance, accounting estimate will change. Such change in the accounting estimate is not prior period item. Such change in accounting estimate is not change in accounting policy. Such change in accounting estimate should be given prospective effect. What effect? You change it from now and not from the beginning. With regard to change in accounting estimate, this change in estimate will take the place of the original item. If originally it was an ordinary item, that estimate, now we are changing it. That change in estimate will also be ordinary item. If originally it was an exceptional item and now we are making change in such estimate, this change in estimate will also become exceptional item. If originally it was extraordinary item, now when we revise the estimate, it will again become extraordinary items. So it will take the place of the original item. That's what we need to remember. There is no separate disclosure required for change in estimate unless it is material. If it is material, we'll disclose nature, amount to perceive the impact of this items on. We'll quickly see the examples. If in case you sell goods, pay expenses, receive incomes, ordinary. However, based on size, incidence, nature, items like inventory valuation being switched to NRV because NRV is less than cost and such impact on P&L. Disposal of fixed assets, scrap sales, reversal of provisions, disposal of long-term investments. All of these are exceptional items. Extraordinary items are like loss that's happening due to earthquake, an asset sold not with an intention to replace it, but to tide over the financial difficulties, or a liability which was due is now settled by giving another asset taken over against the attachment. All of these, or refund of our government grant, is our extraordinary items. Prior period items is entry not written, written wrongly, written in the wrong ledger, totaled wrongly, posted wrongly. All of these errors are prior period items. Changes in accounting policies is shifting from FIFO to WAM in inventory valuation or investment valuation. Change from cost model to revaluation model in PPE valuation. Changing the cost formula in determination of value of inventory, or changing the way we record government grant. All of these are changes in accounting policy. Changes in accounting estimate is you had already created provision for doubtful debts at 2%. You change it from 2% to 3%. That is change in estimate. You revise the useful life of an asset. You revise the scrap value of an asset. You change it the method of depreciation. All of these will be our change in estimates. You all got this? Very good. And that's it with regard to accounting standard 5. Net profit or loss for the period, prior period items, and changes in accounting policies. Let us now do a quick revision of construction contracts under accounting standard 7. This construction contract is not applicable for own construction of a building. It's only applicable for a service contract where you got the contract to construct a specific asset or a combination of assets. We can call them combination of assets when they are connected by way of design, technology, or function. Then we can call it as one single contract. This construction contract, you can treat them as separate contracts or one single contract depending upon negotiation, revenue and cost, and profit. If the contracts are negotiated separately or can be negotiated separately, if the revenue and cost for the contracts can be identified separately and the profits also can be determined separately, then we have to treat them as separate contracts. If we cannot negotiate them separately, if the revenue and cost for the contract cannot be identified separately, if the profit has to be identified only in total and cannot be identified separately, then it will be treated as one single contract. This will be considered as one single contract because they are interconnected by way of design, technology, or function. Get that? Very good. Then we see the contracts based on the revenue can be classified into two types. One is fixed price contract. Second one is cost plus contract. Under the fixed price contract, the customer has promised to pay a fixed sum to the contractor, and this will be the sum that will be paid for construction of the building or construction of flyover, tunnel, or whatever it is. However, under cost plus contract, the consideration is not fixed. After the cost has been incurred by the contractor, a fixed percentage of it will be given towards profit, and that sums up to become contract revenue. However, though we use the word fixed price contract, the contractee can promise the contractor for an escalation clause, meaning the contractor will be eligible for a certain percentage of increase in the contract revenue for increase in the contract cost by a certain percentage. I hope you got this. How do we recognize the revenue with regard to construction contract? That is what the entire standard is about. Though the name of the standard is construction contracts, we can very easily say that it is revenue recognition for construction contracts. Majority of the standard is with the base of accounting standard 9. We can recognize the revenue only on fulfillment of two important conditions. One, reliably you are able to measure the revenue. Two, there is a probability that you will complete the project and then take the revenue. Only if these two are satisfied, we'll go ahead and then learn how to recognize the revenue. If one of these two is not satisfied, then we will not recognize the revenue. We'll wait for actual completion of the contract and then recognize the entire revenue. Got that? Now, construction being done over more than one accounting period, we cannot recognize the entire income in any of this. We cannot recognize it in the first year, last year, or not even in the middle year. So when the construction happens over 3 or 4 accounting periods or even longer, revenue also should be recognized over 3 or 4 accounting periods because expenditure is also incurred over 3 or 4 accounting periods. Do you get this? How do we recognize this? This is done based on percentage completion method. What is this done based on? Percentage. Very good. Where is our percentage completion? Here. Percentage completion method. So this percentage is computed under 4 methods as per the standard. There is surveyor method, cost incurred to total cost method, percentage of work certified method, and physical inspection method. But however, in our chapter, when we do questions, we're going to refer to only these two. One, surveyor method. Second one, cost incurred to total cost. Surveyor is where an external expert is appointed. This external expert will survey the entire construction site and will tell this much percentage of the construction is complete. Under cost incurred to total cost method, cost incurred is actual. We know how much cost is incurred. Total cost is cost incurred plus cost expected to be incurred. When we add both, we get total cost. So I'll take cost incurred divided by total cost, that is cost incurred plus to be incurred. That will give me percentage of completion of the contract. This is one way of computing the percentage. This percentage is important because out of the total revenue, I'll apply this percentage to identify how much revenue should be recognized during the current period. Now talking about contract revenue, what and all is included in contract revenue? Contract revenue will include such amount what we have promised, what we've been promised in the contract. Other than that, we'll be including CVI and excluding P to identify our contract revenue. So contract revenue is the amount entered into by way of signing in the contract plus CVI minus P. C, claims. If in case at the end of the contract, if we take over any of the asset which doesn't belong to us, which belongs to the customer, but we take it over, it is like non-cash consideration taken from the customer. If it is not initially included in the contract revenue, we should add this amount. Next one, variation. Variation is any change in the scope. If in case there is deviation from the existing contract agreement, we go slightly ahead, build one more floor, build a little more extra construction, build an extra wall, build an extra kilometer of road. If we do any of these, for this variation from the existing contract, customer might compensate us by extra payment. That is variation. Incentive is what we get for faster completion of the project, or permission for completion on time, or for better quality than what we promised. If we make the customer happy with our project, then they'll keep us happy by giving us additional consideration, that is incentive. And last one is penalty. For any deviation from the project, for any misconduct, for any nuisance that we create, for any delay, if the customer has to face any adversity, we compensate them by paying penalty. This will be deducted from our contract revenue. Any of these has to be included in the contract revenue only if you have a right to receive it. That is, reliably you can measure it and there is probability that you will get it. Let's say there is some reward that if you finish the contract within 2 years, you will get 2 lakh rupees extra. At the beginning of the contract, we cannot include that 2 lakh. Even if I say that it is my past track record that every year, every contract I finished in time, you cannot include. Why? There is no right to receive. You should prove, you should start the contract, you should complete the contract. Only when you have right to receive such money, you should include it in the revenue. Are you getting it? Any change in this revenue that happens, or any change in the expected cost that happens, is change in accounting estimate. It will not be change in accounting policy, or it will not be considered as pre or period item as per AS5. Then, once this contract revenue is computed, we need to also identify how to recognize contract expense. Contract expense will include 3 important things: direct cost that is incurred for that project, allocable cost which is incurred for several contracts together, but it can be allocated to this construction also, any other cost which is related to this product. It does not include 3 things: administrative cost, selling and distribution overhead, or any other pre-construction cost. If there is any expenditure incurred for securing the contract, it will be included as per para 20. We cannot consider it as pre-construction cost. It can be included in the contract cost. However, to take it, it should be specifically identifiable. It should be measurable reliably. There is a probability that this contract will be obtained because of this expense. Only when this IMP is fulfilled, then you will include this cost incurred to secure the contract in contract expense. Contract expense, usually we will know how much is incurred during the year. And contract revenue, we would not. How contract revenue will be available to us in the total? When the contract revenue is available to us in the total, we'll multiply this contract revenue which is in total with percentage that we've completed. We'll identify the extent to which it should be recognized. From this, we will deduct the revenue which is already recognized. If it is year 1, there is 0 revenue recognized previously, entire revenue is current year income. If it is year 2, then the revenue recognized in the previous year will be deducted from this to arrive at revenue to be recognized in the current year. This revenue to be recognized in the current year is like sales made in the current year. Similarly, we'll do it for cost also. What is the total contract expense multiplied by percentage of completion will give us how much is the contract expense for the period. Contract expense till the date. From that, if we deduct the recognized expenditure already recognized, we'll get the expense to be recognized. This you don't have to do in all the cases. In several questions, they'll give expense for the period. However, there are certain questions that we did where they'll give you contract expense and they'll give you profit or loss. They'll give you contract revenue and they'll give you profit or loss. Contract revenue minus profit will be contract expense, or contract revenue plus loss will be contract expense. That will be total contract expense. You multiply by percentage to find contract expense till date. From that, we'll deduct what is already incurred. We'll get contract expense incurred during the period. This contract revenue to be recognized during the period and this contract expense to be recognized during the period. If we take these in either side of our contract PL, revenue on the credit, expense on the debit, and deduct them, we get the contract profit to be recognized during the period based on percentage completion method. You get that? However, if at any point of time during the contract, if total contract cost exceeds total contract revenue, we cannot recognize only percentage of loss. We have to recognize full loss. Sir, but contract is only 10% complete. Loss is 10 lakh. 10 lakh only 10%. 1 lakh would have been recognized by PCM. Balance 9 lakh of loss will be recognized usually on completion of balance 90%. However, by way of conservatism as well as para 35 of accounting standard 7, we need to recognize that balance 9 lakh of loss also in the current period only. Sir, but construction is only 10% complete. Balance 90% will be recognized based on provision. We'll create provision and then record it. So whenever total contract cost exceeds total contract revenue, entire loss should be provided for by way of provision, irrespective of whether the contract is started or not, stage of completion, and profit from other contracts. Everyone understood this? Then this is very rare. Sometimes they do ask this. Though the standard is about revenue recognition, they might ask you to compute how much is the asset or liability in the specific contract. Then what do? We'll basically take our expense that we've incurred. To this we add profit, because profit is recoverable from customer. If there is loss, we deduct it. If we add profit, deduct loss, this is the amount that we should bill to the customer. If customer we've billed the same amount and they paid some amount, from the expense plus profit minus loss, that is the amount to be billed, we deduct the progressive payment received from the customer. If the resulting amount is positive, that is asset, we have received excess. We are supposed to receive. If the amount is liability, it will be negative, means we've collected more money than what we should collect. I repeat, to expense we add profit, we deduct loss. When we add expense, when we add profit, deduct loss, then whatever results is the amount to be collected. We deduct the amount collected. If the resulting amount is positive, this is the amount to be collected, our asset, receivable. If in case we have collected more, then the amount will be liability, that will be negative. And there can be certain times difference between the amount to billed and amount to be billed, that will be retention. That is expense plus profit minus loss is not the amount billed. Then take that amount billed and this progressive payment to compute asset liability. Amount to be billed and amount billed difference will be retention. And lastly, what you should notice, whenever there is change in contract cost or revenue because of the agreed terms, that will be change in accounting estimate and will be giving it prospective effect. This is quick revision of accounting standard 7. I hope you understood whatever we just discussed. So this sums up the entire AS7 if you observe here. This is it. Got it? Let us now quickly revise accounting standard 10, property, plant and equipment. To call an item as property, plant and equipment, it has to fulfill definition criteria. Definition is TRAPE. What is TRAPE? T, it should be tangible. 2, RAP, it should be used for renting, administration or production of goods or rendering services. Once it is tangible and it's one among this RAP, we should check E. Expected useful life should be longer than one accounting period. Once this is done, it is a property, plant and equipment. Now, once it fulfills definition criteria, we will check recognition criteria. Recognition criteria is E and R. E, FEB, that is future economic benefit should flow from this asset. Then RM, reliable measurement should be possible for that asset. Once it fulfills definition criteria and also fulfills recognition criteria, we can recognize that as property, plant and equipment in our books of accounts. This standard of property, plant and equipment talks about three things. 1, when to recognize, how to recognize and what value should be recognized, the PPE. Second one, when to depreciate, where to say how to depreciate and how much to depreciate the asset. Last one is impairment. Impairment will be discussed majorly in other standard 28 when we discuss later. Got that? Then we talk about the scope of the standard. Similarly, AS10 also has scope. Certain things are covered in AS10, certain things are not. What is not covered? Biological assets. What do you mean by biological assets? With life. Once with life. Life will be two types. One, living plant. Second one is animal. Living plants and animals are not covered under accounting standard 10. They are biological assets and they are not covered under AS 10. However, exception is there. What is it? Bearer plant. Though bearer plants are biological assets, we give them a new name called bearer plants. This is exceptions to biological assets. So for these items, AS10 is applicable. For biological assets, that is plant and animal, AS10 is not applicable. But for bearer plants, AS10 is applicable. What are bearer plants? A living plant is considered as a bearer plant if it fulfills all of the conditions. How many conditions do we have? 3 of them. Number 1, this should be used in producing agricultural produce. Second condition, that agricultural produce should be there for more than 1 accounting period. Condition number 3, there should be very remote possibility of selling this asset as an agricultural produce. You get this? Once these 3 conditions are satisfied, then that plant will become bearer plant. Once it becomes bearer plant, AS10 is applicable. You get that? Then let's quickly see as to what are the items, other items for which AS10 is not applicable. So for biological assets, AS10 is not applicable. For bearer plants, AS10 is applicable. For wasting assets like ore, mine, oil well, coal deposit, iron ore, gold mine, for all of these, AS10 is not applicable. There is no standard applicable for them. There we apply generally accepted accounting principles based on industrial standards. Then we have things which are covered by other AS, like assets which are taken on amalgamation. For that, AS14 will tell how to value. And items on lease, AS19 will tell how to value. So whenever there is a separate standard telling how to recognize them, then AS10 will say follow them, don't follow me. That's what AS10 is all about. You got the scope of the standard? Then whenever we say asset has to be recognized, it should fulfill definition criteria, recognition criteria. Against this asset, if there is a spare part or if there is a standby equipment, can we capitalize it or not? Depends upon the fact whether that spare part or standby equipment, whether it will fulfill definition criteria or not. If it fulfills definition criteria, it is PPE. If it doesn't, it is not. You'll also check the recognition criteria to recognize at what value should it be written. Then, whenever we talk about recognition, there are 2 types of recognition: initial, subsequent. Till the date the asset is ready to be put to use, any cost that is incurred will be taken initial cost. Once the asset is ready to be put to use, after that whatever expenditure you incur will be taken only and only if it fulfills the definition of subsequent cost. Shall we see what is initial cost? Initial cost has 3 main categories. How many categories? First one, purchase price. Second one, directly attributable cost. Third one, cost of dismantling. Let's discuss the purchase price in detail. When we say purchase price, it refers to the price that we pay to get the asset. If you pay the money, get the asset, that is cash price. If you don't pay the money, get the asset, and we say that we'll pay late, and they agree, that price that we pay later will not be cash price. It will be deferred credit price. Such a price is greater than cash price because it includes interest. Such interest cannot be capitalized. We have to check accounting standard 16. It will be capitalized only and only if it is qualifying asset. It is a qualifying asset when it takes substantial period of time for setup. Substantial period definition is not given in AS16. However, accounting standard interpretation 1 says that period of 12 months can be considered substantial. So purchase price will include only cash price. If there is deferred price, adjust interest. Interest can be included subject to accounting standard 16 borrowing cost. That is if it is qualifying asset. Got that? Next, what about taxes? Taxes, duties or anything that we pay will be included in the cost of the asset if there is no input tax credit. If there is input tax credit, if there is no input tax credit, we'll include it. If there is input tax credit, we'll not include it. You get this? Yes. Then talking about what if you purchase the asset but for a non-cash consideration, meaning you don't pay cash, you give one more asset, barter transaction, or you give securities, then we need to check whether there is commercial substance existing or there is no commercial substance against it. How do we check whether there is commercial substance existing or not? Old asset without exchange, if we hold it, what is the cash flows that will generate? If we exchange it to new asset, from the new asset, what is the cash flows that we generate? If both are same, no commercial substance. If the cash flows from old asset, cash flows from new asset are different, distinct, diverse, then it is commercial substance will exist. Do you guys get this? Very good. So if there is commercial substance existing, then the value of the asset given should be credited at book value, but the value of the asset that we get should be debited at fair market value of the asset given or fair market value of the asset taken, whichever is more clearly and evidently available. However, if both are available, it will be recorded at the fair market value of the asset given. Get this? And difference can be P&L. It will be transferred to P&L. See this? Any difference will be transferred to P&L account. However, if there is no commercial substance, you cannot book any profit or loss. There can be cash. If there is no cash, then the value of the asset that we take, should be recorded at the book value of the asset that we give. So asset going out credit, asset that we take debit. Same value for both, no profit, no loss. There can be adjustment with cash, but there cannot be P&L. Because there is no commercial substance, how can you make profit? This is with regard to non-cash consideration. We're done with entire purchase price. Now we'll discuss directly attributable cost. Directly attributable cost in short refers to all the cost that is incurred till the time the asset is ready to be put to use. From the time you buy the asset, there to say unassembling the asset, packing the asset, loading the asset, cargo, cartage, freight, octroi, duty, and once it reaches the country, again unloading and then bringing it to the factory, unpacking, and then assembling, engineering cost, installation cost, site setup cost, everything incurred till the time the asset is ready to be put to use is capital in nature, should be capitalized. However, items that are excluded is to set up the asset. If you move the existing office to a new location, the rent of the new location, or if there is a new product to be launched, the product launch cost, new service launch cost, or new facilities created, inauguration cost, not included. General administrative overhead, not included. Selling and distribution overhead, not included. If you generate the asset yourself, you build the asset yourself, you can charge cost, you cannot charge profit. Internal profits are also not included if the asset is self-constructed. Last part, cost of dismantling. At the end of the useful life of the asset, we remove the asset. For removal of the asset, we might incur expense. That cost that is incurred to remove the asset, to restore the facility, to dismantle the asset, to discard the asset, at the end of its useful life, should be discounted to present day's date, and that should be added to the cost of the asset. At what rate do we discount? The rate that they give in the question. If they don't give the rate, it should be done at the rate at which risk-free return can be earned on government bonds. That will be the rate that will be considered usually in the industry. But in our questions, they give the rate, we'll take it. If they don't, they'll give us a discounted value of itself. By this, we understood how the initial cost should be considered. Next, we'll understand subsequent cost, meaning asset is already ready to be put to use, or asset is put to use. Now we incur cost. Can we capitalize? It can be if it fulfills recognition criteria. What is recognition criteria? What is recognition criteria? An asset can be recognized as PPE if there is future economic benefit from the same and there is reliable measurement. Once these two conditions are satisfied, then subsequent cost also can be capitalized. See, subsequent cost. To recognize it, it should fulfill recognition criteria. What is recognition criteria? Future economic benefit and reliable measurement. For example, if there is repairs and maintenance which is incurred on regular basis, charge it to PL. If there is replacement of parts in the PPE, you might have done this in CA Foundation, capital revenue, rings and piston change, capital. What is a small part change? Revenue. So we should check the recognition criteria. Thereby to tell, no, check the nature of business, purpose for which it is incurred, recoverability, materiality, all of that. Here we are more clear, standard answer. What does it say? Check recognition criteria. Fulfills recognition criteria, capitalize. Doesn't fulfill recognition criteria, don't capitalize. If you do any major inspection or overall, we did this in that airline question. Seats were changed, and what was that? One more was changed. Galley. Seats and galley when it was changed. So that was major change or major inspection when you do of the engine and everything in the aircraft once a year or twice a year. That should be capitalized. You make the overhaul of the entire asset. Check if it fulfills recognition criteria. If it does fulfill recognition criteria, capitalize. Otherwise, not. Do you get this? Next thing that we learn is about the cost model or revaluation model. At the balance sheet date, at what value should you record the asset? There are two options. This is not accounting estimate, this is accounting policy. So we discussed in AS5 also. So changing from cost model to revaluation model is change in accounting policy. So we have two models. One is cost model, other one is revaluation model. Cost model, what we do is we record the asset at original cost, depreciate it, remove the impairment loss if there is any, and then we'll arrive at the carrying amount. What if this carrying amount is incorrect? It is because this depreciation is not correct. Then we do revaluation. Instead, what we do is, here we take the carrying amount as a revalued amount. If the value of the asset is 10, we depreciated it by 1. Closing value is 9. We think 9 is not the right value. Asset should be 9,500 in the market. Then depreciation of 1,000 that we charged is incorrect. We should have charged it 500 depreciation. So what do? We record the asset at 9,500. Sir, but 10,000 minus 1,000 asset is 9. If you make that 9,000 asset as 9,500, you are making upward revaluation by 500. Alternatively, if the asset is 10, depreciation 1,000, asset is 9,000 in your books, but market value of the asset is 8,000 or market value is 7,500. You want to record the asset at 7,500. From 9, you bring it down to 7,500. That difference is downward revaluation. So if we follow revaluation model, you will take the revalued figure in 1 year. Next year opening will also be that fair market value or revalued figure. From that we deduct accumulated depreciation and accumulated impairment loss. After the revaluation, whatever you done, then what we get is the revalued amount, carrying amount at revalued value. You get this? So asset can be revalued. What do you mean by revaluation? You are not happy with the value that is there. Then you will say innocenti value marna and you do valuation again. So that new value that you give to the existing value is revaluation. Revaluation can be done only for the class of the assets, not individual assets. Let us say I have two buildings, office building number 1, office building number 2. When I do revaluation, I cannot say I'll do revaluation only for building number 1. I should do revaluation for both building number 1 and building number 2. But I have two office buildings and one factory building. Can I say I'll do revaluation only for factory building? Yes. Because the purpose is different. The nature is different. So I can do revaluation for class of assets, not individual asset. See this? Revaluation to be done for entire class. Group of assets is similar. Grouping of assets is done based on the nature of the asset and use of the asset. Now, talking about revaluation, it can be upward, it can be downward. When you do upward revaluation, asset value is increasing, debit asset, credit will be given to revaluation reserve. If you downward revalue the asset, asset will be credited, debit will be given to P&L. Why P&L? It is loss. Sir, why not P&L here? Conservatism. If there is loss, recognize immediately. If there is profit, recognize it only when it is actual. What we do here is, whenever there is loss, we immediately transfer to P&L. Here, when we increase the value of the asset, we credit to revaluation reserve. The value of our asset has gone up. Let's say value is 10,000 asset. We revalued it to 11. Asset went to 11. Correct or not? If the asset was 10, next 10 years, depreciation would have been 1,000, 1,000, 1,000, 1,000, 1,000. Now when you revalue the asset from 10 to 11, next 10 years, depreciation will be 1,100, 1,100, 1,100, 1,100. So every year 100 rupees depreciation increased. That will be compensated by revaluation reserve transfer to P&L over 10 years. So when the asset value increases, credit revaluation reserve, this revaluation reserve will be transferred to P&L over the remaining useful life of the asset. When the asset is downward revalued, entire revaluation should be transferred to P&L account in the very first year. Then there can be reversal. Let's say asset is 10,000. You revalued it up by 1,000. Revaluation reserve 1,000 is there. After you did it, you realized, 11,000 is wrong. Asset should be 10,600. Now when you reduce 400, it is not downward revaluation. It is reversal of earlier upward revaluation. So read this. If there is downward revaluation, but if the asset was previously decreased, if the asset is previously increased, now when we do downward revaluation, we will not write P&L to PPE. Here we wrote P&L to PPE, no. We write revaluation reserve to PPE to the extent revaluation reserve is there. When the asset is downward revalued, we usually write the, when the asset is upward revalued, we usually write the entry PPE to revaluation reserve. But if the asset was previously decreased, then we would have previously transferred the asset value to P&L, no. Now also to that extent we will transfer to P&L and not revaluation reserve. To that extent we had done before, because this is reversal and not upward revaluation. Asset which was previously upward revalued, if it is downward revalued, to the extent revaluation reserve is there, we will adjust with revaluation reserve, not transfer to P&L. If the asset which is downward revalued is now upward revalued, to the extent it was previously transferred to P&L, we will adjust with P&L, not transfer to revaluation reserve. Only beyond that we will transfer to revaluation reserve. Got it? This is with regard to revaluation. Last part, depreciation, derecognition and retirement. Depreciation of asset. Depreciation is systematic allocation of depreciable amount of the assets over its remaining useful life. And depreciation can be done under 3 methods according to accounting standard 10. 1. SLM, 2. WDV, 3. Production units method. How do we pick these methods? Based on the FEB, future economic benefit. If the future economic benefit is a straight line, SLM. If the future economic benefit is a slide, WDV. If the future economic benefit is dependent upon the level of production, production units method. Do you get this? We start depreciating the asset when it is ready to use. We stop depreciating the asset once the asset is derecognized. We start when it is recognized, we stop when it is derecognized. Whenever there is change in the method of depreciation, that is change in accounting, estimate as per AS 5. Next, derecognition. Recognition means asset is recognized. Derecognition means asset is not recognized. Stop. When do we stop? 1. Asset is kept ready for disposal. Or we recognize when there is future economic benefit. We derecognize when there is no future economic benefit. Meaning asset is stopped working, now we are keeping it ready for sale. So asset is disposed or there is no future economic benefit, then we de-recognize the asset. Carrying amount of the asset is there, no, that will be immediately transferred to P&L, that will become loss. Sir, how does it become gain? If you sell it, it will become gain. And this entire de-recognition is regulated by AS 9. Sale should be recognized when there is transfer of risk, reward and effective control. There is reliable measurement of the consideration and reasonable certainty of that receipt. Then we should recognize the sale. This is given in AS 9, not AS 10. And impairment of assets, we'll learn it in accounting standard 28. Last part, retirement. What is retirement? Retirement is stopping to work before you die. Asset is stopped working, but it is not yet dead. Asset is stopped working, but it is not yet dead. It is waiting to be dead. It is waiting to be. So asset is not in active use. It is held for disposal, but not yet disposed. Dead is like sold, not working, ready for sale, but not yet sold. Such an asset should be recorded like inventory. Inventory held for sale. Here asset is also held for sale. Inventory will not be used. We are selling bikes. Will you use the bike? No, no, no. You pack it and keep it ready for sale. Here also asset is stopped working or you have stopped using and this asset is ready for sale. Should be treated like inventory. How do we value inventory? Cost or NRV, whichever is. AS2 is not applicable. Treatment is like that of inventory. So here this asset should be recorded carrying amount, not cost. What is it? Carrying amount or net realizable value, whichever is lower. And when we do this cost or NRV, whichever is less, if in case we pick NRV, we are reducing the value of the asset, such reduction in the value of the asset should be transferred to P&L account. Should be transferred to P&L account immediately. Did you guys get this? This, my friends, is quick revision of entire accounting standard 10 PPE. Ashte. Okay, na? Let us now quickly revise accounting standard 13, which talks about investments. Starting with the definition of investments. Investments are assets which are held for the purpose of dividend, interest, rent, or for the purpose of capital appreciation. The scope of the standard specifically mentions what are the items against which accounting standard 13 cannot be applied. You cannot apply this standard to recognize income by way of dividend, interest, and rent. To recognize dividend, interest, and rent, no, accounting standard 9 is to be followed, not accounting standard 13. Accounting standard 13 helps us understand how to account for investments, which will fetch us interest, dividend, and rent. And if you bought any specific asset, to give it on lease, either in the form of operating or in the form of finance lease, though you have invested money in the same, you cannot treat that as an investment under accounting standard 13 because there is more detailed accounting standard 19 which talks about how to deal with assets that are let out on lease or which are purchased on lease. Then talking about the last part, if in case you have an obligation to give a defined benefit to your employee at the end of his employment term and to give the money like gratuity or any other funds to him on retirement, you are saving up some money at the end of every period. Such an amount is called as plan assets, and such an amount of investment made in mutual fund or in terms of equity instruments or debt instruments or in any other form to meet the requirements of retirement benefits to be given to employee will be specifically covered under accounting standard 15 employee benefits, and you should not try to account it under accounting standard 13 which talks about investments. Talking about investments, it can be majorly classified like how I do is investment properties and financial instruments. Investment properties are investment in land, building, or anything of this sort, majorly for the purpose of capital appreciation. And this is the excess money in the business that's kept aside, and this is not in the ordinary course of operations. This is not to be used in the ordinary course of operations. So these will be majorly treated like accounting standard 10 PPE, and there is no great discussion about these items in 13, but they are covered under 13. But accounting is done under 10. Talking about financial instruments, debt instruments, equity instruments, all of these are majorly classified into two categories. One is current investments, other one is non-current investment. Whatever items which are expected to be sold within 12 months or you intend to hold it not longer than 12 months are current instruments, and they should be readily marketable. If they are readily marketable or readily realizable or readily convertible into cash and you intend to hold it for less than 12 months, then it becomes current investments. On the other hand, if it is not a current investment, it will be called as non-current investment. Why do we classify a financial instrument held as an investment into current and non-current? This is because the way we account current investments and the way we account non-current investments is different. Current investment is valued at cost or market price, whichever is less. However, on the other hand, a non-current investment is usually valued always at cost. However, whenever there is decrease in the price or the market price or fair market value, whatever you call by, of a non-current investments, and such decrease or dip is permanent in nature, it's not going to get recovered, then you provide for such loss and decrease the value or cost of that non-current investment. Otherwise, a non-current investments will be always valued at cost, and our current investments on every balance sheet date will be restated to cost or market price, whichever is. Now, the next is the discussion on cost. What and all does cost include? Cost includes purchase price that you incur to buy the specific instrument. If in case you paid some brokerage, registration fees, stamp duty, security transaction tax, anything in this context, that will also be added to the cost of the asset. And if in case you have purchased this specific instrument on a date other than the date on which dividend is issued, or on a date other than the date on which interest is issued, then that instrument what you buy would not just include the price of that instrument, but it will also include the accumulated interest or accumulated dividend. This has to be eliminated. We need to record the investment in the form of debenture at X interest price and share at X dividend. But share, the context is slightly different. I'll come back to it slightly later. Whenever you buy a specific debenture, there is a possibility that the seller will recover interest accrued till that date from us. We need to identify and eliminate that interest and then take the price. If they give cumulative of interest, we'll eliminate the interest. If they give excluding interest, when interest is not included, we'll take the tax interest. Brokerage as a percentage when it is given in the question, brokerage or stamp duty as a percentage when it is given in the question, to be computed on X interest price or cum interest price, whatever is mentioned to us in the question. If the question gives X interest price, on that we'll compute brokerage. If the question gives cum interest, on that you compute brokerage and then eliminate interest. You get this? This is because broker charges the brokerage on the price that we agreed or mentioned in the agreement. And we believe that the transaction price what they've given to us in the transaction is the price at which the agreement is entered between the buyer and seller. Then same thing, talking about interest, dividend and rental. These are incomes and it should be transferred to P&L. This cannot be capitalized, cannot be included in the cost. If in case we compensate the seller for some amount of interest or dividend, what he has earned but we will receive, that has to be eliminated from the price. And what if there is non-cash consideration, meaning we have purchased a specific instrument but we have not given cash, we have given another financial instrument, or we have given asset in any other form as consideration. That specific asset what we receive as investment, in this case, no, unlike A10, always commercial substance is there, because no two instruments will give same financial return, cash flows will be different, so it's always like commercial substance is it. So the asset that we received for non-cash consideration should be recorded at the fair market value of the consideration given, fair market value of the asset sent or fair market value of the asset received, whichever is more clearly and evidently available. If both of them are very clearly and evidently available, priority 1 is given to fair market value of the asset given away. After this, let's talk about the treatment of dividend. A minute ago I told you we'll discuss later. This is the context. So dividend can be treated into two times depending upon the point of holding. One is pre-acquisition dividend, other one is post-acquisition dividend. What do we mean by pre-acquisition dividend? So now whenever the company declares dividend, the period for which the company is declaring dividend, during that period, say the period for which the company is declaring dividend, during that period, if you are the holder of share, that is pre-acquisition dividend, sorry, post-acquisition dividend. If in case you bought the share after the period for which the dividend is declared, it is pre-acquisition dividend. Let me give an example. Let us say company is giving dividend for the year 2023-24. The dividend for the year 2023-24 is issued in 24-25. In the year 2024-25, let's say some date in the month of July, when we are receiving dividend, when we are receiving, I bought the share in April 2024. I'm receiving the dividend in July, but I'm receiving dividend for April to March 2023-24. So from April 2023 to March 2024, I was not holding this share. I bought this share only in April 2024. Now I'm receiving dividend in July. So this dividend is from the profit for the period during which I was not the shareholder. So this dividend is pre-acquisition dividend. Let us say instead of buying the share in April, I bought the share in March. It doesn't matter what date. Let's say I bought the share in March 2024. Then in the month of July, company is declaring dividend for April 1st, 2023 to March 31st, 2024. During that financial year, I've been holding the share. So the dividend that I receive in July is post acquisition. After I bought the shares, I've received the dividend. If in case the dividend is pre-acquisition dividend, it is not my income. I have not earned that dividend. So this dividend belongs to the holder of the share in the previous year. So the holder of the share in the previous year, when he sold the shares to me, he would have sold it at a price higher than the normal price. So the purchase price, what I've recorded in my investment account on the debit side, would be cumulative of dividend price. But unlike debenture, I cannot deduct it at the time of entry because on the date when I purchased, I don't know how much of dividend. So I would have recorded at cumulative dividend price only. On today's date, when I get to know the dividend, I would have to reduce the cost, what I already recorded in my investment account debit side. But I cannot change the entry what I have recorded long ago. So what do I do? To reduce the cost, I'll write the pre-acquisition dividend in the amount column on the credit side in investment account. If I write dividend received for the pre-period in my amount column in the investment account on the credit side, it will decrease the cost which is recorded in the debit side in the amount column on the investment side. On the other hand, if the dividend is post-acquisition dividend, this is received for a period after I acquired the shares, such dividend amount will be written in the dividend column because it is income which will go to P&L. By writing pre-acquisition dividend in the amount column, we reduce the cost. By writing dividend in the dividend column, we treat it as income and post it to P&L. That's the difference between pre-acquisition and post-acquisition. Pre and post-acquisition dividend concept comes up only and only for final dividend. That is dividend declared by the company in the general meeting for an entire year. However, between two annual general meetings, if the company declares dividend, that is called as interim dividend. So during the year you're holding the share, during that year only you receive the dividend. You have already acquired the shares and they've given the dividend. So interim dividend is always post-acquisition dividend. This will not be adjusted against the cost. Post-acquisition dividend will be returned to P&L account. So you should write it in the investment account in the dividend column, not in the amount column. That's with regard to interim dividend. Then talking about shares. So company can issue two types of shares other than the normal issue. After you have acquired the shares of a company, you can receive bonus issue, you can receive whenever the company gives you bonus issue, it is free shares received. It is capitalization of reserves. With regard to bonus issue, only the nominal value of the shares is increasing, but price is not at all increasing. For the sake of accounting and for disclosure purpose, you will prepare one column in the investment account called as nominal value column. This is not the amount column. This has no significance. Just to ensure that dividend can be computed with ease and disclosure requirement is fulfilled, we'll write that dividend. We'll write that nominal value column. So whenever bonus shares are received in the debit side in the investment account, write two bonus shares. It is not a proper journal entry. Just write two bonus shares and write the amount only in the nominal value column, nothing in the dividend column, nothing in the amount column. So only nominal value of the shares will increase because of bonus issue. And after this, if in case there is sale of shares, don't say bonus shares are sold, so purchase price is zero, entire sale consideration is profit. That should not be how we account it. Should always remember that once the bonus issue has happened, share value in the market will get averaged out. So we take the opening shares held plus bonus shares. That will become our denominator. And the cost that we had incurred for acquiring the opening shares, that will be the numerator. So total value of the shares before bonus issue divided by shares before bonus plus bonus shares, that will give us the average price. And this is the average cost of bonus shares even when they are sold. So don't write the total sale value of bonus shares as profit. You need to find the average cost and then determine the sale consideration and profit of bonus shares. If in case it is right shares, all we need to remember is right shares whenever it's given, the investor has three options. One, to subscribe the shares. Two, to renounce his options. Three, to do nothing. If the subscriber, if the right shareholder subscribes to the shares, it is a normal purchase entry, but the entry will be at right issue price. So we'll write bank account debit to investment in shares. So in investment in shares account, you'll write on the debit side 2 back. Write that amount in the amount column, and that's it. Very simple journal entry. If in case this shareholder renounces his right, sells his right to some other person. Remember, he's not selling the share, he's selling the right to buy the share. Such sale consideration, that is number of rights sold multiplied by right value, whatever consideration you get, this has to be taken to P&L account credit side. This has no place in investment account. It has to be taken to P&L account credit side. This has no place in investment account. However, there is an option given in the standard. This is not mandatory. This may be followed. This may be followed. This is when you bought the shares today and immediately company announced right issue, and right after that share price dipped. And during this you sold the rights. So you purchased the shares at cumulative right price, and the company made right issue, and right after the right issue share price in the market dipped. In that case, whatever the number of rights you sold multiplied by selling price, whatever you get, instead of taking it to P&L, and here these shares X market price decrease, no. So when you take the cost will be at cumulative right price, and then the closing balance number of shares will be at theoretical X right price is their market price. When you do cost or market price, whichever is less, it becomes less, and such loss will go to P&L account debit side. So sale of rights income you wrote to P&L account credit, cost or market price, whichever is less when you did less, that also goes to P&L. So one is expense, other is income. Instead of writing expense and income in P&L, that income what you get by sale of rights, you have an option to reduce the cost of the investments using this, to ensure that there is no separate charge to P&L. So this is just an option given. So I'll repeat this again. Whenever the right options given by the company to the shareholder are sold by the shareholder, sale consideration, that is number of rights multiplied by right issue price, will be transferred to P&L account credit side. However, if the shareholder buys the share at cumulative right price and immediately after the purchase, company goes for right shares, and then investor sells his rights and there is decrease in the price, then the investor has an option to take that consideration in the amount column on the credit side in investment account to adjust the cost. This is just an option given. And the last one, if in case the shareholder does nothing, let's say it doesn't buy the share, it doesn't sell the right, you also do nothing and eat this 5 star. Don't eat it because I want it here. And the last part is reclassification. When you classified an investment as long term, thinking that you will hold it for long term, period longer than 12 months, and later you feel like no, you want to dispose it, you want to reclassify it to current investment now, then what should you do? Such an investment which was long term, which is now about to be shifted to current investments, should be valued at the original cost or carrying amount what is there. Carrying amount might be different from original cost only and only when there is huge decrease in the value of that long term or non current investments, that is adjusted. Otherwise, that long term investments will be at cost only. However, if it was huge decrease and it is recorded, that carrying amount will be less, cost will be more. Whichever is less will be considered. Got it? However, in a vice versa scenario, you have initially recognized an investment as current investments, which is expected to be sold within 12 months. Then you see a long term potential in this investment and you want to reclassify it to long term. When we do that, you need to do it at cost price or fair value, whichever is less. Fair value here refers to market price. And this is how we value or count for investments.
Let's get started. 17th one. Ready? Mr. Z has made following transactions during the financial year 2020-21. Investment 1, 8% corporate bonds. This is fixed income bearing security. Interest income is 8% on the nominal value. Nominal value is 100 rupees. And we can go on computing interest for this. But next one, equity shares is variable income bearing security. The moment it is variable income bearing security, we will not write dividend till the time it is declared. So what we do in the case of corporate bonds is, when we buy, if it is cumulative of interest, we won't write it in the amount column. We'll take it outside, identify the interest in that accrued till that date, deduct the interest, write interest in interest column, write the amount, X interest amount in the amount column. I told you yesterday, no, why to do that? Not yesterday, day before yesterday. Towards the end, X interest comment. That's what we do. With regard to equity share, we won't be able to do that. The value will be cumulative of dividend for last year, but we don't know. So we'll write in amount column. Later, when we receive dividend, such dividend will be deducted from that value by writing on the opposite side amount. Shall I repeat? For a fixed income bearing security, if the date of purchase is other than the date on which interest is allowed. Now here, when are we buying? 1st of June. Interest is given on 30th September and 31st March. Interest is given on 30th September and 31st March. So when I sell it to you and you buy it on 1st of June, against that bond already April, May, 2 months interest is accrued. 2 months interest is, so when I collect 86 rupees, it is cumulative of interest. So that interest is not your expense. You pay it to me 2 months interest. Later company will give you 6 months interest. So your income is 4 months. It is reimbursement. So you should not include 86 rupees as your cost. From that 86, you should eliminate the interest. So what do? You will write 36,000 into 86. How much? 36,000 into 86. How much? 1st of June 2020. Yeah, 36,000 bonds have been purchased. Cumulative of interest price. One column enter madbeka. Okay. Now tell me here. How much is the cumulative of interest price? 36,000 into 86. 30 lakh 96,000. This is including interest. I should eliminate interest. How much is interest? 8% on 36,000 bonds into 100 rupees nominal value for 2 months. How much do we get? 48,000. Correct? 48,000. 36,000 into 100% to 8% into 2 by 12. So in this, excluding interest price is actually 30 lakh 96 minus 48, 30 lakh 48. You will pay consideration of 30 lakh 96,000. How much consideration do you pay? 30 lakh 96. In the investment ledger, when you write here 1st of June 2020 to bank account, this is 36,000 bonds purchased. In the amount column, you will write 30 lakh 48. In the interest column, you write 48. You paid 48,000 for interest, not for investment. Investment value is how much? 30 lakh 48,000. Nominal value is 36 lakh. You understand this? For debenture, for bond, for preference share, you will be able to find the interest component included at the time of purchase. For equity share, how will you find? Dividend percentage, sir. Equity shares dividend percentage is announced on declaration only. Till the date of declaration, we don't know dividend rate. Why? Dividend is proposed by board, declared by general shareholders, no, in the meeting. Till then, you don't know. So you will write amount column only, including dividend amount. But that pre-acquisition dividend should be adjusted. Call it pre-acquisition dividend. This is pre-acquisition interest. Interest for the period before we acquired. When did we acquire? 1st of June. For what period is this interest? 2 months. Which 2 months? April and May before I acquired. Similarly, for dividend, I should deduct, but I won't know. So what will I do? I'll write it in the amount column. When I get to know the dividend, I will not write it here minus. I will write it on the credit side in the amount column. That is the treatment of pre-acquisition dividend. Whenever dividend is received for a period, before we acquired it, it will not be written in dividend column and transferred to P&L. Instead, it will be written in the amount column on the credit side to reduce the cost of investment. In this question, there is pre-acquisition dividend also. There is post-acquisition dividend also. Understood this 30 lakh 48? Okay. Next, what is there after? 15th of February. Every time before you write the transaction date, just check is there interest date. Interest dates are 30th September, 31st March. After 1st of June, before 15th of February, isn't there 30th September? 30th September, yeah, what happened on that? 30th September ಏನಾಗಿಲ್ಲ 2nd of October ಆಗೋದು. Oh, I remember. They go, no, 2nd of October. 30th of September, everything was fine. Done. 50. ಗುರೂಜಿ ಮೀಟ್ ಮಾಡಕ್ ಹೋಗ್ತಾರೆ, ಪ್ರವಚನ ಕೇಳಕ್ಕೆ ಬಸ್ ಹತ್ಬಿಟ್ಟು ಫ್ಯಾಮಿಲಿ 4 ಜನ ಹೋಗ್ತಾರೆ, ಮೂವಿಗೆ ಹೋಗ್ತಾರೆ, ಊಟ ತಿನ್ನಕ್ ಹೋಗ್ತಾರೆ. ಮೂವಿನೂ ಕನೆಕ್ಟ್ ಆಗಲ್ಲ ಜೀವ. ನನಗೆ ಎವ್ರಿ ಟೈಮ್ ವೆನ್ ಐ ಆಮ್ ಡೂಯಿಂಗ್ ಕ್ವಶನ್ ಸಮ್ವೇರ್ 2016 ಬಂದ್ರೆ most painful year in life 2016. No, don't ask again. 16, Virat Kohli. 973. We lost in semi-final. Shane Watson, KL Rahul, Virat Kohli yet to bat 134 runs in 12 overs. Still lost the match. AB de Villiers also batting. How? 2016. Fine. Get back here. So we will rate interest on 30th September. On 30th September, how many bonds do we have? 36,000. What is interest rate? 8%. 36,000 into 8% into 100 into 6 by 12 by 6 months interest. How much? Got it? What is the entry? Bank account debit to interest. Bank account debit to this interest column is there, no? This is actually representing interest. So I will write here 30th of June 2020 by bank. This is interest. How much? 36 lakh into 8% into 6 by 12. Okay. Fantastic. What's after that? 15th of February, sold 24,000 bonds at 92 x interest. That 92 doesn't include interest, so don't deduct. If they say cumulative, you deduct. If they say it's already excluding, you don't have to deduct. How many? 24,000 into 92. 15th of February. Shall I write 15th of February? What is the entry? Bank account debit to investment account. How much do we receive? How many debentures? How many bonds are sold? 24,000. 24 lakh is a nominal value. Amount received is 24,000 into 92. ಎಷ್ಟು ಬರುತ್ತೆ? 22 lakh 8,000. This is sale value. This on that interest also we will collect when we sell. They have not included, but we collect separately. How much interest? 24 lakh into 8% into what is the last date of interest before 15th of February? November, December, January, February, Arda. 4.5, half. 4.5 months. What do we get? 72. You write this. Now, same to same thing. We'll actually show it to you in the form of working note also. 15th of February. X interest price 22 lakh 8. Why 24,000 into 92? There is no interest to be deducted. 22 lakh 8 is the sale value for. What is the interest on this? 24,000 into 100 into 8% into 4.5 by 12. 72. Now, every time you write sale, you should check whether there is profit or loss. Every time you write sale, you should check whether there is profit or loss. Now, there is only one item purchased. So, it is from this only. If there is more than one asset, more than one set of investment purchased, then we should check whether we should apply first in, first out or weighted average. Here, though, no confusion. Why? If we are selling, we are selling from the 36,000 bonds only. What is the cost of the 36,000 bonds? 30 lakh 48,000 is the cost for 36,000. 30 lakh 48 divided by 36. Do it. 30 lakh 48,000 divided by 36,000. What do we get? 84.67 per bond. How many bonds are sold? 24,000 multiplied by 24. 20 lakh 39,000. That, my friends, is the cost. Correct or not? So 30 lakh 48 divided by 24 into 24 divided by 36. How much do we get? 20 lakh 32 is the cost. Selling price is 22 lakh 8. Profit or loss? Selling price is more. ಅದು ಜಾಸ್ತಿ ಹೊತ್ತು ನೋಡಿದ್ರೆ ಹಂಗೆ ಆಗುತ್ತಿಲ್ಲ, ತಲೆ ವರ್ಕ್ ಆಗಲ್ಲ. 1,76,000. You get it? Yeah, 1,76,000 profit. It should come in P&L account credit side. Correct or not? So in investment account debit side. I'll write here profit on sale. 1,76,000. This consideration 22 lakh 8 is there. No, it is more than cost. So to reduce it, I'll write here. Getting the logic? Any other transaction for bonds? End of the year, 31st March, you should write interest and then close the year. 31st March will receive interest. On how many bonds will we receive? 36,000? No, that 36 you sold 24. You will receive only on the balance. Yeah, how much? 8,000 bonds into 8% into 6 by 12. 8,000. Sorry, 12, 36 minus 24. 12,000 bonds. 48,000 is the interest. That's it. First close the interest column. Interest column is nominal account, will be transferred to P&L. 144 plus 72 plus 48. 264. 264, you remember? Rohit Sharma. 264 minus 48. 48, 148, you remember? MSD, Pakistan 183, Sri Lanka. Okay. 216 minus 48. Sorry, 264 minus 48 is 260 to P&L account. What is 216 ಬಂದಿದೆ 221 222 219 all right. ಇನ್ನೊಂದು 271 ಇದೆ ರೇಟ್ ರಿವರ್ಸ್ ಸ್ವೀಪ್ ಅನ್ಕೊಂಡು ಲಾಸ್ಟ್ P&L account 2 lakh 16 transfer, then nominal value 36 lakh ಅಲ್ಲಿ 24 lakh you sold, no, balance 12 lakh is balance carried down, 12,000 bonds. What is the value of it? Balancing figure 30 48 plus 176 32 24. 32 24 minus 22 lakh 8, 10 lakh 16,000 is the balance carried down of bonds. Do you understand this? This was much simpler because there was only one set of investment. If there is more than one, let's say there was two purchases and you're doing sale, how to find cost? Two methods. One, first in first out. Two, weighted average. If you're doing weighted average, add amount of this purchase and the next purchase, divide by number of bonds of first purchase and second purchase, we'll get the average price. That you multiply by number of bonds sold, you'll get the answer. And whenever you do weighted average, without smallest of the hesitation, straight away find the closing balance as balance figure. Get it? That is weighted average. First in first out, what you should do? There is this first purchase, there is this second purchase, and there is opening stock also. Opening stock is the units that you sell first. If units that you are selling is less than the number of units that is there in opening stock, very simple. Opening stock value divided by opening stock units, that is the price, over. If opening stock is 100 units, sale is 120 units. 100 units is sold from opening stock, 20 units is sold from first purchase. So we'll find the cost for 100 units and 20 units separately and then add them to find total cost. That is first in first out. Very good. If in case there is pre-acquisition dividend on such item, or that opening stock pre-acquisition dividend, what is there, we should deduct and then find the. ಅದಕ್ಕೆ ಯೂಶಲಿ ಫಸ್ಟ್ ಇನ್ ಫಸ್ಟ್ ಔಟ್ ಮೆಥಡ್ ಮಾಡೋದಿಲ್ಲ ಕ್ಲಾಸ್, ಕಷ್ಟ ಆಗುತ್ತೆ. Doable, it's not impossible. Once you get the logic, this is a very nice chapter, very nice chapter. You'll love it. Shall we do the next one? Equity shares. Shall we do equity shares? Okay. 1/4/2020 opening balance 8,000 equity shares at book value 190. This is the opening value. Correct? Shall I write here debit side 1/4/2020 balance brought down. How many equity shares? 8,000. At what value? 190. 8,000. Nominal value is 10. 80,000. 8,000 into 190. How much is that? 15 lakh 20. What is 15 lakh 20? Opening balance. 15 lakh 20 is, what is happening after opening balance? We have purchased 7,000 equity shares at rupees 230 on come right basis. It includes the right. Don't have to adjust anything. Remember that there is brokerage of 1% also. On purchases, brokerage will get added to the cost. On sale, brokerage will get reduced from the cost, reduced from the sale consideration. Here they have given here only 1%. Sometimes you know what they do? Illi purchase on 230 and irutte 7,000. Illi sale irutte, illi purchase irutte, ella irutte. You do everything. Come here. At the end, they'll say prepare investment account considering brokerage of 1%. You get it? So always check if there is brokerage. Some questions will have stamp duty also. Brokerage 1%, stamp duty 50.5% or something. Stamp duty should be incurred only and only on purchase. Stamp duty only and only on, not on sale. Stamp duty will be incurred by the buyer. No, I am selling the product to you. I am selling the asset to you. Who is eager to get it registered? You or me? You. Who will pay stamp duty? You will say you won't pay. You want me to pay? I won't pay. You also don't pay. Let it be in my name only, registered in my name. You give consideration, you start using. When my kids come, they'll file a case on you, and my kids and you kids, let them become friends and go to court every month. Now, who is interested in getting it registered? You. Who will incur stamp duty? Buyer, not the seller. Not the seller. Are you getting it? If they give stamp duty, charge it on the sale consideration only. Sorry, purchase cost only, not on the sale consideration. Next thing is, whenever there is brokerage, should we compute brokerage on X interest price or come interest price? whatever is given in the question. For one transaction, they have given come interest price. For one transaction, they have given fixed interest price. What will you do? For the first transaction, you will do it on come interest price, what is given. For the second transaction, do it on X interest price, what is given. Because the broker doesn't understand interest. Broker will ask, what price are you selling? 120. What price are you buying? 120. Give me commission on 120. You both will say, you are buying at 100 rupees. He is selling at 100 rupees. I will charge commission on 100. Interest you are settling from separately. That I won't charge commission. If in the agreement you mention come interest price, broker will charge commission on come interest. In the agreement you mention X interest price. Interest is settled between the parties separately. Then broker will not charge commission on interest. Are you getting it? So interest is brokerage is computed on X interest price or come interest price. What is mentioned for each transaction? It can be different. For first purchase, you might charge it on come interest price. For the second transaction, you might compute it on X interest price. You did, but you forgot now. Now you remember? Yeah, in Manega. We wrote this. Shall we write this purchase 7,230? Shall we have a look at the working? 1st of May 2020. Just I thought already. After this break, then we'll discuss. Come right price is how much? 7,000 into 230. 16 lakh 10. Are you getting it? 16 lakh 10. Brokerage 1%. 16,100. 16 lakh 26,100 is the purchase price. Agreed? In our investment account, equity share, I'll write here 1/5/2020 bank account 7,000 equity shares, 16 lakh 26,100 is the purchase price. Nominal value is 7. You usually tend to prepare a column here called as number of equity shares. I would recommend you to write number of equity shares here and prepare nominal value column here. Why? If you prepare number of equity shares column here, when you have to do interest, again you will do into number of unit value, nominal value per share. If you write nominal value, it will become easier. If you want to remember number of equity shares, write it below the transaction in the inner column so that you have both the kinds of data available. So the probability of doing mistake will reduce. Okay, after this bank 16/26/100. Next, 15/6/2020. Company announced a bonus issue of 2 shares for every 5 shares held. 2 shares for every bonus issue. How many shares do we hold on that date? 8 plus 7, 15. 8 plus 7, 15. 15,000 shares into what is the bonus ratio? Divide by 5, multiply by 2. 6. Nominal value 10. 60,000 nominal value shares you receive free. Do you give any money? No. Bonus issue andre free. I'll write 2 bonus issue. I'll write only the nominal value column. Amount column it will be 0. Amount column it will be only nominal value of shares will increase. Number of shares will increase. Now you don't have what to say 15,000 shares. You have 8,000 plus 7,000 plus 6,000. How did you get 6? 8 plus 7, 15 divided by 5 into 2. Artha aita? Very good. What's after this bonus issue? 1st of August. Company made right issue of 1 share for every 7 shares held. 1 share for every, how many do you hold? 8 plus 7, 15. 15 plus 6, 21,000 shares. 1 share for one right share for every 7 shares means 21,000 divided by 7. 3,000 right you get. 3,000 rights, not 3,000 right shares. You can make it 3,000 shares. What did you do? 30% of his entitlement was sold. 3,000 only 30% is sold. That is 900 is sold. Correct? Correct, no? Then how much is entitled? 70%. 2,100 shares are bought. At what rate? Sorry. 230. This that 900 shares into 75 money you get, no? What do we do? Should we write it in amount column credit side? Decrease in cost of production. This is not sale of scrap. Decrease in cost of production, manufacturing account credit side and break. So this will be complete amount will be considered as income and it should be recorded in P&L account credit side. Long ago they used to write this in investment account credit side. After that accounting at 13 got revised. Henceforth we are not allowed to write it in the investment account credit side. We will straight away write it to P&L. I'll show the same working note once. Enjoy. on 25th of August. What's happening? Right shares entitled. One for every 7. We have 21,000 shares. So how many rights will we get? 3,000. In that, what are we doing? Sold is 3,000 into 30% into 75. 6,750 transferred to P&L. And purchased 3,000 into 70% into 230. How much do we pay? 4,83,000 we pay. 2,100 shares we get. Am I right? Say something. Right here, 25th of August to bank account 2,100 equity shares, 21,000 nominal value, 4,83,000 consideration, right shares purchased. Understood? After this, 15th of May, dividend at rupees 6 per share, and it was received, but it is not on right issue and bonus issue. Why? This is for previous year, 2020. We are in which year? Sir, we are also in 2020. This is 1920. We are in 2021. Sir, no sir, 2020 ಕೊಟ್ಟಿದ್ದಾರೆ 2020 ಅಂದ್ರೆ 2020-2021 year. They are talking about 2019-2020. So this is for the this is on the profits that is earned in 1920. Were we shareholders then? Some part yes, some part no. Why? Opening balance 8,000 is there. Usually you would have seen question with pre-acquisition dividend or post-acquisition dividend. Here partly pre, partly post. How many shares do you hold? Come here 8, 7, 6, 2,100. But dividend will not be given on these two. Why? They were not born only last year. Correct or not? It's only given on this 8,000 and 7,000. Talking about not being born, our Telgi uncle was there. No, he was also caught like this only. He gave stamp papers for the date when he didn't even have license. Money. Pretty. 8,000 and 7,000. 15,000. On this 8,000 equity shares, 8 rupees per share, 6 rupees per share. 6 rupees. History. 6 rupees. That will be post acquisition. 8,000 into 6 is post. After we acquired, we got 7,000 into 6 is pre-acquisition. Here people get confused. Sir, 8,000 is there from us before. So 8,000 is pre-acquisition. 7,000 we acquired after. 7,000 is post-acquisition. Post-acquisition andre angalla. After we acquired, like if for the dividend declaration period, if you already hold the share, it is post-acquisition. If the dividend is declared for a period before we acquired, it is pre-acquisition. When did we buy this 7,000 equity shares? 1/5/2020. Dividend is declared for 1920. So the dividend is declared out of the profits which was earned in the pre-acquisition period. So it is pre-acquisition dividend. Are you getting it? Okay. Now tell me, how much is pre-acquisition dividend? Don't have to tell the amount. What should I multiply with what? 7,000 multiplied by 6. Very good. That pre-acquisition dividend will decrease cost of investments. So I'll write here by bank account. I will write that to the extent of 7,000 into 6 in amount column. And on that opening balance 8,000 into 6 in dividend column. This is profit post acquisition. This is reduction in cost of investments pre acquisition. Aita. Next, shall I go to next adjustment? Okay. What is after? Doubt ama? 6 per share. Okay. 1st of December 2020. Sold 7,000 shares at 260 per share. Brokerage 1%. Sold 7,000 shares. Shall we write the entry for sold 7,000 shares? 1st of December 2020. Sale of how many shares? 7,000 equity shares. Tell me how much is sale price? 7,000 into 260. What do we get? 18,20,000. Now tell me how much is brokerage? 1%. Brokerage should be deducted from sale price, added to purchase price. 18,200. When you deduct, what do we get? 18,01,200 is the sale value, net consideration that we're getting. Okay. Now, what is the cost of this? We need to find. Which method are we following? Have they told anything in the question? No. What is the weighted average? If they don't give, we'll always follow weighted average. Why? Weighted average is easy. How do you find weighted average? Very simple. Very simple. Take all the totals. Amount column to take your calculator. 15, 20,
plus 1626 100 plus 4,83,000. You added amount column these three items. Deduct pre-acquisition dividend of 42. What you got? No, that is a total value for all the shares together. How much did you get? M plus added to memory. Now we'll divide it by number of equity shares that we have. How many? 8,000 plus 7,000 plus 6,000 plus 2,100. ನಾನು ಅಷ್ಟೇ ಸೇಲ್ ಇಲ್ಲಪ್ಪ, ಈಗ ಮಾಡ್ತಾ ಇದೀವಿ ಸೇಲಿನ. ಎಷ್ಟು ಬಂತು? 23,100. 23,100 you remember. MRC divided by 23,100. 150 that you got. No, that is per share value. How many are you selling? Why? Multiply by 7,000. I am finding, see here, cost of 23,100 shares is adding all of this 35, 87, 100, whatever you got. What is the cost of 7,000 shares? 35,87,100 into 7,000 divided by 23,100. What did you get? ಎಷ್ಟು ಬಂತು? 10,87,000 is the cost. Selling price 18,01,800. Profit or loss? How much profit? 7,14,800. 7,14,800 should go to P&L account credit side. So in investment account debit side, I'll write 2 P&L. 2 P&L. 7,14,800. Sale consideration, I'll write on the credit side. By bank, 18,01,800. Sale of 7,000 equity. Class idella. Then interim dividend 3 rupees. Interim dividend you will get it on bonus shares, right shares, everything. Interim dividend 3, and this will write it to dividend column. On this date, 25th of January, how many shares do we have? 8 plus 7 plus 6 plus 2,100 minus 7,000. 16,000. That will write in amount column. 16,100 into number of shares into how much dividend? 3. Okay, now done. Then last we have shares are quoted in the market at 260. Yen madbeku? We'll compute the cost price. Compare whichever is less is what we'll take. Whichever is less is what we'll take. Investment should be valued at cost or market price. Whichever is less. Don't tell cost or NRV. NRV is for goods. For shares it is market value. Okay, chalo, let's take here. 1520 plus 1626 100 plus 4,83,000 plus 7,14,800 minus 42 minus 18,01,800. ಅಲ್ಲಿ ಮಾಡಿ ಸರ್ ಹೊರತು ಮಾಡ್ರಿ, do it please. Here if I do, I'll straight away show the answer. 15,20,000 plus 16,26,100 plus 4,83,000 plus 7,14,800 minus 42,000 minus 18,01,800. 43,900 M plus. This is the total value. You should take number of shares. Getting it? How many shares? 80,000. Okay, ಈ ತರ ಮಾಡ್ಬಿಡುದಾ? Here 8 plus 7 15, 15 plus 6 21, 21 plus 2,100, 23,100 shares. In that 7,000 are sold. 23,100 minus 7,000, 16,000. 43,900 you had, no, divided by 16,100, you will get per share price. Per share price 269. What is the market price? 260. Should value it at whichever is less. What is less? 260. So we'll take a number of shares, balance carried over. How much? 16,100 shares into 260. What do we get? Different barata. Hey, idu balancing figure aitu. Balancing adu rate correct at 269 whatever you told. Pakka 269 ಬರುತ್ತಲ್ವಾ? 259 ಅಲ್ಲ ತಾನೆ? I am believing you people. I will do 16,100 into 260, 41,86,000. Now close the dividend column by transfer to P&L. Close the amount column by transfer to P&L. That's it. Everyone.
The question doesn't end here. That's it. They've asked us to do only this much. They've asked us to do only this much. Doubt idya? Doubt idya, ma'am? No. They've asked one more sub question saying that how much of the profit should be transferred to P&L. You transfer no dividend column, interest column. Adella serisi on P&L account extract you prepare. Dividend income, interest income from bond, profit on sale of shares or loss on reduce the profit ಇದೆ. Profit on sale of bonds and profit on sale of investments and loss on revaluation. Loss on decrease in the value of the investment because this is current investment. If it is non-current investment, we would have recorded it at cost. Here they're telling suggest the value at which investment in equity share should be reclassified in accordance with AS 30. They want to show it from current investment to non-current investment, long-term investment. Then what do we do? On the date when we are reclassifying it from current investment to non-current investment, we'll take the cost or fair market value, whichever is less. At that value, we will capitalize. What is the value? 180 rupees is the value at which it's quoted in the share market on 15th of May. We know it on 31st of March. After 31st of March, before 15th of May, is there any purchase? Is there any sale? Nothing. We have the 260 rupees per share as the value on what date? 31st of March. Assuming that there is no change, 260 will continue to be the value per share. But what is the fair market value as on the date of reclassification? 180. And 31st of March. This is on 15th of May. Divided by 16,100 ಮಾಡಬೇಕು. ಹಂಗಾರೆ ಇದು ತಪ್ಪು ಹೇಳಿದ್ರೆ 250 lakh 100. This 41 lakh 86,000 is wrong. You done something wrong, guys. Take your calculator. Do 15 lakh 20,000 plus 16 lakh 26,100 minus ಮಾಡಕ್ ನಾನು ಹೇಳ್ದೆ 42 42 900 ಅಂತ ಸ್ಟೈಲ್ ಆಗಿ ಹೇಳ್ಬಿಟ್ಟು ಕುತ್ಕೊಂಡ್ಬಿಟ್ರಿ ನೀವು ತಗೊಂಡಿಲ್ವಾ? ಮೈನಸ್ಸೇ ಮಾಡಿಲ್ಲ. ನಾನು ಹೇಳಿದ್ದೀನಿ 1520 plus 1626 100 plus 4,83,000 plus 7,14,800. 43 43 900 minus 42,000 minus 18,01,800. ತಬ್ಬಿಗಳು ನೀವು ಮಾಡೇ ಇಲ್ಲ ಸರಿಯಾಗಿ. 2,50,100 is correct. 2,50,100 you got, no, divided by 16,100. Market price is 250, 260. Which is less? The 250 100 only will take 160 na rate. 155 will take it 155 only, whichever is less. And reclassification date cost is how much? 155. Fair market value 260. Which is less? Cost. $155 is the cost per share. And then market price on 31st of March is 260. You will record it 155 or 260, whichever is less, which is 150 into 16,100 shares. You will take it at 25 lakh 100. Got it? This is on 31st of March. Till 15th of May, there is no other transactions. On 15th of May, fair market value is 180. Cost is 155, which is less. So when you capitalize this, when you treat it as a non-current investment, long-term investment, it will be shown at 25 lakh 100, 16,100 shares. And once you treat it as non-current investments, you will never compare at the end of the year to market price. It will be continue to shown at cost price unless such decrease in the price of the share is permanent in nature. Got it? That's with regard to investment account. Can we quickly revise what we've discussed so far in amalgamation? Amalgamation in practical sense is divided into several classifications like amalgamation, absorption, and external reconstruction. However, for the purpose of accounting under accounting standard 14, amalgamation is classified into two categories. One is amalgamation nature of merger. Two, amalgamation nature of purchase. Merger purchase classification is done based on AS14. For AS14, based on AS14. AS14 gives us 5 conditions. If all of the 5 conditions are satisfied, it is merger. Even if one among 5 is not satisfied, it is purchase.
Shall we quickly see what are these 5 conditions? Condition number 1 says that all the assets and liabilities of transferor company should be taken over by transferee company, and this will include reserves and surplus. After condition number 1, let's quickly see condition number 5, which is continuation of 1, which says that all assets of transferor should be taken over by transferee at book value. We cannot take it over at agreed value. However, there are exceptions. If you are changing the value of the asset for bringing in uniformity in accounting policies, then okay. Otherwise, if there is change in the value of the asset, it will become amalgamation in the nature of purchase. Got it? Then condition number 2 says that minimum 90% of the shareholders of transferor company should continue to be equity shareholders in transferee company. Exception is for the shares held by transferor directly by itself or through its subsidiaries in the transferee company. You get that? So in the transferor company. The next thing that we need to notice, how is the second condition fulfilled? The second condition is fulfilled by issuing purchase consideration to equity shareholders of transferor company by way of equity shares in transferee company. This also has an exception. For fractional part, if in case you give cash, it's okay. For other than fractional part, if you give cash, it will turn into amalgamation nature of purchase. Then we have fourth condition, which we are not going to look into in the problems that we're solving. That is, business of the transferor company should be continued by transferee company. If all of these 5 conditions are satisfied, then in the books of transferee company, we are going to follow pooling of interest method. However, even if one among these 5 conditions is not satisfied, it will turn into amalgamation nature of purchase, and we are going to follow purchase method. Accounting standard 14 doesn't recommend any accounting for transferor company. There we follow dissolution, liquidation or realization approach as per generally accepted accounting principles. Shall we now quickly see what are the accounting entries in the books of transferee under pooling of interest method as well as purchase method? Under pooling of interest method and purchase method, remember the story. First the box is received, then the box will be unlocked, assets and liabilities will pop out, then we pay the money, then the box will be kicked, we pay the money to liquidators, then the assets which are there below will be arranged after considering DRUMS, drums. It will be drum if it is merger, it will be drums if it is purchase. Let's discuss the entries quickly. The first entry, the box is received from the liquidators. When the box is received from the liquidators, that box is called as business purchase. So we write the entry as business purchase account debit to, very good, liquidators of transferor company account. Then we will open this box. When we open this box, from this box will pop out all the assets and liabilities. So assets account debit, liabilities account credit, and will also credit business purchase account. If it is amalgamation in the nature of merger, we are going to write all the assets and liabilities including reserves and surplus at book value. And difference between debit and credit will not be written to goodwill or capital reserve, instead it will be written to reserves and surplus. However, if it is amalgamation in the nature of purchase, we will not write all assets and liabilities. We are going to write only such assets and liabilities which are taken over at agreed value, and we will never write reserves and surplus in this case. If there is difference between debit and credit, debit will be goodwill, credit will be capital reserve. Capital reserve and goodwill both will not coexist in balance sheet. We will net it off at the end. This is the difference between pooling of interest method and purchase method. So we've opened the box, we've taken the assets, we've taken the liabilities, we've kicked the box. Now, liquidator who got the box is waiting. Let's pay the consideration to him. When you pay the consideration to him, the entry is, we would write the entry as liquidator of transferor company account debit, and we would give them equity shares, preference shares, debentures, cash. We can issue them at premium or at discount. If there is premium, we will credit security premium. If it is discount, we will debit it. Same will be the entry whether it is amalgamation nature of merger or purchase. Both the cases it is same to same. So we paid the PC also to them. Then what should we do? DRUMS. S won't come if it is purchase, merger. What is D? Debenture. Debentures of transferor company will be taken over by us in our business purchase entry. Those debentures are no more valid. The reason being that company itself is shut down. How can the debentures be functional? So we'll cancel the debentures. We do this by debiting debentures in transferor company account debit. Credit, we can give them debentures in our company. We can give them equity shares, preference shares, cash. Whatever we give, we credit it. If there is premium, we credit. If there is discount, we debit. So entry is debentures in transfer company account debit to equity share capital to preference share capital to debenture to security premium. If there is discount on issue, debit. You get that? This is the entry. Same would be there. Whether it is merger or purchase, there would be no difference. D over then R. Realization expenses. These realization expenses should be actually incurred by transferor. But if they don't pay, we pay it on their behalf. When we pay, usually we write expense to cash. Here we can't write expense to cash because it is not our expense. If it is merger, their reserves will become ours. We're paying it out of their reserves to them. So we write reserves and surplus to cash. However, if it is purchase, we don't take over their reserves. So what we pay to them is out of goodwill. We are not getting any benefit out of it. Or even if we get, it's not tangible. So if it is amalgamation in the nature of purchase, entry for realization expense paid will be goodwill account debit to cash. If it is amalgamation nature of merger, we write reserve account debit to cash. Understood? D over R over UMS. U, unrealized profit. Unrealized profit arises because one has sold goods to another. Transferor has sold goods to transferee, or transferee has sold goods to transferor, and these goods have been not sold to outsiders. They have retained with them. Against this, there is unrealized profit. If it is downward, as in the transferee company has sold it to transferor company, transferee has sold it to transferor, it is downward. In this case, stock will reduce, stock credit. Debit will be out of the profits of transferee. So we'll straight away write general reserve. General reserve account debit to stock. You can write P&L account, general reserve, or reserves and surplus, whatever is available. If it is downward, there is no difficulty. If it is upward, as in the goods has gone from transferor company to transferee company, we call it upward. Here also stock value will reduce. We credit stock. But what to debit depends upon what is the nature of amalgamation. What to debit depends upon the nature of amalgamation. If it is amalgamation in the nature of merger, then we write reserves and surplus because we've taken over their reserves. In that only profit is included. If we don't take over their reserves, that is amalgamation is in the nature of purchase, then we'll write goodwill account debit to stock account. Such decrease in the value of the stock will be debited to goodwill. D over R over U over M, mutual indebtedness, meaning one owes the money to the other. This is because of the debtor-creditor relationship that they have between them. So whenever there is debtor-creditor relationship between them, what do we do in that case? Reduce debtors, reduce creditors. Reduce bills payable, reduce bills receivable. Reduce trade receivables, reduce trade payables. So liability reducing we will debit, asset reducing we will credit. Entry will be TP to TR or BP to BR or creditors to debtors. By this our debtors creditors also will reduce. Last item, statutory reserve. This entry will come only in the case of amalgamation in the nature of purchase. This is because if we say amalgamation is the nature of merger, in the initial entry all by itself we have taken our statutory reserves. So we don't have to write another separate entry to account the statutory reserves. So what is the entry that we write? Statutory reserve will be credited. Debit will be given to amalgamation adjustment. We write the entry amalgamation adjustment account debit to statutory reserve. Statutory reserve we know will appear in reserves and surplus. Amalgamation adjustment will also appear as a negative item in reserves and surplus. It will also appear as negative item in reserves and surplus. At the end of the term, we will reverse the entry. We will write amalgamation adjustment will be credit, statutory reserve will be debit, and this will be reversed. So this would have to be continued for the period for which the transferor company was supposed to maintain such statutory reserve, 2 years, 3 years, or whatever. We are however going to do only one balance sheet after amalgamation, so it would not affect us much. After this, we would have to prepare balance sheet. When you prepare balance sheet, remember the old balance sheet plus these journal entries what we passed now will affect our new balance sheet. In the new balance sheet, remember to show disclosure for shares or debentures issued for non-cash consideration. That is on amalgamation. This is how the accounting is done in the books of. Now, very good. Let's see accounting in the books of transferor. In the books of transferor, it doesn't matter whether it is merger or purchase because the approach that we follow is realization approach or dissolution or liquidation approach. What do we do? First, I'll tell you the story and then we'll discuss the entries. First, we transfer the assets to realization. Then we'll transfer the liabilities to realization. Then pack the box, give this box to transferee, collect PC from them. Then if there is any assets that they have not taken over, we will sell it. If there is any liabilities not taken over, we will settle it. Then we'll identify realization expenses, record it if we have paid, pay preference shareholders by transferring preference share capital to preference shareholders, preference shareholder to whatever we're giving them. In preference shareholders to payment, if there is any difference, that would again be debited or credited realization. So far, we have not seen any question where there is difference between how much is supposed to be paid and how much is paid. Even if it comes very simple, if you know this, you do it. If you don't know it, no, Don't open two separate preference shareholder, equity shareholder. Open only one account, shareholder account. Transfer everything there, it will get settled. But you won't get full marks. If it is a 20 marker question, you would get 2 marks less because your realization profit will be incorrect and preference shareholder treatment is incorrect. So you would get 18 out of 20. If you know it, very good. If you don't know it, you can do this. So after that, you identify realization profit or loss, transfer to shareholder. For that, transfer entry is if it is profit, realization to shareholder. If it is loss, shareholder to realization. Then 3 items from the balance sheet are not transferred to shareholder. What are the 3 items? Share capital, reserves and surplus, accumulated losses. Share capital, reserves and surplus, accumulated losses will be transferred to shareholder. Your entry will be equity share capital debit, reserves and surplus account debit to shareholder account debit to accumulated losses. Once we do this, then only thing that's left is settlement to equity shareholder. We'll write equity shareholder account debit to whatever we give them. Equity shares in transferring company, preference shares in transferring company, debentures in transferring company, can be cash also. Once this entry is passed, entire ledger should get closed. That's what we discussed. Now we'll quickly discuss the entries once again. Shall we? First, for transfer of assets, entry is realization to assets. Asset is credit, realization debit. All the assets, whether taken over or not, should be transferred to realization at. Very good. Exception, 3 items. Share capital, reserves and surplus, accumulated losses. One more item, bank. If it is taken over, it will be transferred. If it is not taken over, if it is used to pay realization expense or settle some liability, will not transfer it here. You get it? Then transfer all the liabilities to realization. For this entries, liabilities account debit to realization. Again, don't worry about the agreed value. Write this entry at book value. Debentures is one place we need to be cautious. Be little cautious. They'll give redemption premium, they'll give issue premium, color items they give, but transfer it at book value. Get it? Once these 2 items are transferred, this realization box is passed to transferee, and transferee owes us money. Create transferee company account debit to realization. This will be for purchase consideration amount. After this, immediately we'll receive our PC. Whatever we receive, cash, bank, equity shares, preference shares, debentures, whatever we receive in that company, debit that and credit transferee company. So receivable from them is over, we have received this. All of this will be used to settle the liabilities not taken over or shareholders, that is equity and preference. Once this is over, we'll pay realization expense. If we pay realization expense, we'll write realization account debit to bank. If we receive it back from the transferee, we'll write bank to realization. That will be reversal. Got that? If any assets are not taken over, we will sell the assets, bank to realization. If any liabilities are not taken over, we'll settle the liabilities, realization to bank. This entry, bank to realization and realization to bank, for assets not taken over, sold, and for liabilities not taken over, settled, will be passed at the value at which we settle. Don't worry about profit or loss, it will automatically get adjusted in realization account. Once this is done, settle our equity preference shareholders account, transfer preference share capital to preference shareholder, any difference will be realization. Then pay preference shareholders debit, give them whatever needs to be given. Then close our realization account by identifying profit or loss, realization to equity shareholder or equity shareholder realization for profit or loss. Finally, last but one entry, transfer share capital and reserves to our shareholders. Right? Share capital account debit, reserves and surplus account debit to shareholders. If it is loss, shareholder account debit to accumulated losses. Then finally, payment entry, equity shareholder account debit to X% preference share, equity share, debenture, cash, bank, whatever you give. Once you pass this, everything will get closed. PC can be given under 4 methods: NATO method, lump sum method, PC method, intrinsic value. Be little cautious. You don't have to try and identify and then learn it separately. Language of the question itself will make you understand. It is not at all a problem if you fail to spot what method is it. There is no point in identifying what method is it. Till the time you are able to solve the problem correctly, it is all good. You all got this? Very good. Come on guys, let's have a very quick revision of Accounting Standard 17 segment reporting. Under this, we report certain segments separately. We all know we have profit and loss account to identify the profitability of the organization. But that profit is not sufficient for decision making. We want profit not for organization as a whole, but we want profit for certain specific segments. Because you remember, no, Wilfred Pareto uncle has told that 80% business will give 20% profit, 20% business might give 80% profit. Such organizations part which gives major profit needs better analysis for better decision making. Let's get started. Segments in this entity or segments in this standard is basically divided into 2. Business segment, geographical segment. Business segment means the business is divided into various segments based on the product or service, because the risk and reward from each of this product and each of this service is distinct from another product and service based on the product service differentiality, because the risk and reward on the product and service is different. If we divide the entity, it becomes business segment. However, product and service within the economic environment is giving us same risk and reward, but in a different economic environment, it is giving different risk and reward. Risk associated is different, reward taken from that product or service, the reward taken from that geographical segment is different. So like branch based accounting. So then we divide the organization based on the economic environment because of varied risk and reward. That becomes geographical segment. Entity has a personal choice to make whether it wants to divide its entity based on business or it wants to divide its entity based on geographical segment. It's its personal choice. But once it decides, then which of it is reportable is told by 17. 17 tells TRAM, a reportable segment is identified from a business segment or geographical segment based on T, turnover. Standard doesn't tell turnover, standard tells revenue. If the revenue from that segment is 10% or more, it is reportable. Then R, result. If the result from that segment is 10% or more, it is reportable. If asset from that segment A is 10% or more, then it is reportable. Last one, management by its discretion can call any segment as reportable. You guys get this? Now when we use this word, turnover, result, asset, management discretion, we need to see deep dive into these topics. When we say turnover, we take both internal and external. All the ordinary items will be considered except interest, except dividend, except profit on sale of investments, except any extraordinary items. And same is the case with regard to our assets. We take all the segment operating assets directly attributable to business or allocable to business. However, if there is any tax assets like DTA, these will not be considered. Both fixed and current assets are considered. Tangible, intangible is considered. And here also, if there is any tax expense and all, it will not be considered. And allocable or allocable expenses and revenues will be considered. You get this? And another important point is talking about result. Whenever we talk about result, based on which we'll identify reportable segment. Identify profit making segments and loss making segments. Profit making segments you write separately, loss making segments you write separately. Take the total of profit making segments, total of loss making segments, profit and loss. They bring both profit and loss closer. Check whichever is higher. Whichever is higher, on this you compute 10%. And that will act as basis for everything. This has to be taken in absolute terms. Let us say whichever is higher is loss. Don't take minus of that number. It is positive number. Compare it with all the numbers. It is result, not profit, not loss. You got that? Very good. So once we apply this, that becomes reportable segment. Another important point that you guys should notice, whenever a segment is reportable in the current year, it becomes reportable in the next year also based on continuity principle. If a segment is reportable in the current year because of turnover, result or asset based condition, then it is reportable in the next year also based on continuity principle, even if its turnover, result or asset doesn't exceed 10% criteria. However, the year after that, it's no more reportable. So continuity principle only for 1 year. Because it is reportable based on continuity principle in this year, is it reportable in the next year also based on continuity principle? No. And management discretion also doesn't count. Only turnover, result, asset based criteria. If it is reportable in the current segment, it is also reportable in the next segment. Everyone got this? Then I want you to note another point, that once you pick all these reportable segments, take the total of the external revenue from these reportable segments. If the total of the external revenue from the reportable segments is lesser than 75%, I'll repeat, total of the external revenue from the reportable segments, if it is lesser than 75%, then management by its discretion should pick such segments as reportable so as to bring the total reportable external revenue to 75% or more. You get this? Last point that you should note about reportable segments is, according to Accounting Standard Interpretation 20, if the reportable segment is only one, then you don't have to do reporting. Skip it. However, by management discretion, if you add one more segment as reportable segment, then you do it. This is not standard. This is ASI 20, which says that you don't have to report that segment separately. You guys get that? Then lastly, we'll talk about the disclosure parts. What are the disclosures? Let's say primarily you picked business segments and not geographical segments. For each business segment which is reportable, you need to disclose revenue, expense, asset, turnover, profit. What is the assets purchased during the year? What is the depreciation on that asset? and any other expenses related to that asset, cash and non-cash, this has to be disclosed separately for primary consideration. However, let's say we pick business segment, and later secondary consideration will be our geographical segment. So for each of these business segment, at each geographical location, what is the revenue, what is the asset, what is the profit, that has to be further disclosed. What if both are important? Then you would have to do matrix. Because one side you write primary, one side you write secondary consideration. At this location, this location, this location, this product, this product, this product, disclose everything. That's too complex. So it is better off that an organization picks biological, biological. Reportable segment based on geographical segment or business segment, whichever is of primary importance to them. You got that? Then finally, other disclosures are if there is any extraordinary item or prior period item, change in accounting policy or estimate as per AS5, that disclosure has to be done separately. Inter-segment pricing, what is the policy that they follow, is also supposed to be disclosed. And this is a quick revision of our entire accounting standard 17. I hope it was of some help to you. Yes. Objective is to do consolidation, banking, and NBFC. Oh, nice. Let's start with consolidation. The consolidation of financial statements is not optional, but it is mandatory. The reason being Section 129 of Companies Act 2013, when it defines financial statements, the definition of the word financial statements includes consolidation. So every entity, when it has a subsidiary, it is mandatory for it to consolidate the financial statements. Financial statements consolidation means consolidation of balance sheet, consolidation of statement of profit or loss, as well as consolidation of cash flow statement. All the three have to be consolidated. But that further, there are exceptions. If such holding subsidiary relationship is temporary in nature. Yeah, someone gave you one stock tip that this company share is dip, buy the dip, buy the dip. So you bought the shares without knowing that you bought more than 50%. Go rich, example. And your objective is to sell those shares after some time. You have no intention to have long-term control over such, what to say, company. Then you don't have to do consolidation. You had 40% of shares in that company, and the 31st of March it became 51%. Then April 15th you sold 30%. Should you prepare consolidated financial statements? Not required. Why? You have no intention to have long-term control over such company. And second one, you have long-term control over such company. You have long-term percentage of holding in that company. You have intention to hold it, but because of the market conditions and legal regulations, you can never exercise control over that company. Again, you don't have to do consolidation. For example, all your GST network is being made in GSTN. Heard of that? GSTN. GSTN is a Section 8 company registered under Companies Act 2013. GSTN is a Section 8 company, means not for profit organization. Company created for a purpose other than earning. So all your GST return, what you file 1, 2, 3, 3R, 3B, everything is there in the GSTR. And in the present date, no, what is the biggest what to say asset? It is not any inventory or it is not any land, building or anything. The biggest important asset is the idea and the business secret. It what I'm trying to resources, knowledge, what we call data. Data is the most significant asset in the modern time. Now, for any business which is sustaining the present time, who's your biggest competitor? If someone follows your model, if someone knows from whom are you buying, if someone knows to whom are you selling, if someone knows at what price are you buying, at what price are you selling, and in what quantities, in what month, entire data is available with GST. No, which month how much is purchased, where is season, which is not season, from whom do you buy, at what rate, what discount you get, everything is available in bills. Bill to bill data is uploaded to GST. When you file a GST, all the data is there with GST. Right? I'll tell you something very surprising. GSTN में percentage shareholding is there. No, whom do you think holds percentage of shares? What percentage and who holds? Huh? Surprisingly, more than 50% is held not by government. It is held by HDFC and Axis. Just imagine HDFC and Axis comes together and then says, we want data. They give GST data. They take the complete data and they start selling the data. Now there is one business which is doing really nice. You will identify now from whom are they paying, to whom are they selling. The entire their trade model can be copied. How much is their profit margin can be known only by the GST filing data that you done. You don't want your income tax data also, which is all wrong. I know.
So just by so much data, business model can be completely copied. So the entire nation will come for a halt. Entire nation's economy will go for a toss that way. So though more than 50% holding, I think now it is 49 and 51. 51 is held by government, 49 is held by private players. But that was not the case. For the first 2-3 years of GST incorporation, 51% was held by Axis and HDFC. 49% was held by government with state government, central government with state government. So can we impose restrictions and then decide what to do with the data? Shall we start selling the data from GSTN? We can't do it. So though you hold more than 50%, long-term restrictions are such that you can't exercise any control. You can't exercise any control. So if that is the case, then you can't treat it as consolidate. You can't consolidate that financial statements into yours. Now your railways also, they're starting PPP, no, public-private partnership model. When you say public-private partnership model, so in IRCTC, there will be major amount of funds coming from private. So the financial statements of IRCTC should be consolidated with whoever invests more than 50. No, they can't, because though they'll invest more than 50, if in case they do, we don't know the ratio. If in case they invest more than 50, still they can't decide. Railway road nam pakkan mane road alaki, idu railway station nam taata necessarily. They can't decide things. So I'm not telling you those small decisions. Even business decisions can't be taken by them. Getting it? So in such case, you don't have to do consolidation. Let's quickly start with consolidation of balance sheet. As and when we start doing the problems, I'll start explaining it. So these are the concepts that you need to learn. There are 19 concepts that I want you to learn. And over and above these 19 concepts, two concepts what I have not put into this is bonus issue cover. And two concepts I had missed in this. So those also I'll teach it to you once we dividend is eitherly. Dividend is also covered. Bonus issue is also covered. Okay, we'll start with the entire thing. So first we'll start with a fully owned subsidiary. Shall we do a fully owned subsidiary? So these are the two balance sheets we're trying to consolidate. These are the two balance sheets we're trying to consolidate. Consolidation is literal addition. We need to add one balance sheet to another balance sheet, line to line, line to line. So share capital of holding company is how much? 10,000 shares of rupees, one each, 1 lakh. No, so I'll write this 1 lakh. This 1 lakh rupees, whatever is there in the balance sheet of the holding company, I'll write it here. 10,000 shares of rupees 10 each. Then exactly in the same line, I have subsidiary share capital 50,000, 5,000 shares of rupees 10 each, 50,000. Am I right? I'll pick this from here. I'll write this also in the consolidated balance sheet. Liability side added. Then let's go to asset side. We have property, plant and equipment 50, property, plant and equipment 50. I'll add 50 plus 50. I'll write 50 plus 50. And then what do we have? Investment in subsidiary shares 50,000. Holding company has bought some investments. I'll write that investment in subsidiary company. Now the balance sheet will tell 1 lakh plus 50, 1 lakh 50, 1 lakh plus 50, 1 lakh 50. But what you need to understand here is the liability side, whatever the share capital that is there here, the asset side, whatever investment that's there here, it is the same. This investment is asset of holding company. This share capital is liability of subsidiary company. So in the till the time there are two different entities. You have asset, they have liability. But when you become one company in one balance sheet, that asset and liability is like mutual indebtedness. Similar lines. Do you get this? So what do I do? This investment is nothing but this share capital. I'll eliminate this share capital. I'll eliminate this investment. So in my consolidated balance sheet, I'll write equity share capital 1 lakh, PPE 1 lakh. That's it. This is how I prepare my consolidated balance sheet for a wholly owned subsidiary. Wholly owned subsidiary is 100% of that company I only hold. Get it? Now let's improvise the question a little. Let's make it not wholly owned, or it's a wholly owned subsidiary, but there is small difference. Here what happened here is 50,000 was the share capital and our investment was also 50,000. Come on here. How much is equity share capital here? 1 lakh. Ours is 1 lakh. What is subsidiary share capital? 50. Shall I write it together? I'll write here, see, 1 lakh and 50. Got it? I've added them and then everything. Then PPE 60,000, PPE 50,000. Together 1 lakh 10. I'll write PPE 60, PPE 50, 1 lakh 10. Got that? Then one more asset that is there in the holding company's balance sheet is investments. How much? 40. May I write? This 40,000 investment, I'll write in the balance sheet 40. Now the balance sheet will tally 150 plus 10, 160, 140, sorry, 1 lakh plus 50, 150, and then 1 lakh 10 plus 40, 150. But this investment here is representing this share capital. Do you agree with me? So we eliminated both and then prepared the balance sheet. But now the problem is here the share capital is 50,000 and here the investment is 40,000. If I eliminate this 40, I can deduct only 40 in this. I will be still left with 10,000. What is this 10,000 about? This is because the company has 5,000 shares. In this 5,000 shares, I own only 4,000 shares. Balance 1,000 shares is non-controlling interest, or what we call as minority interest. Shares what I don't own in the subsidiary but somebody else owns. So what do? I write that minority interest here in the balance sheet. I eliminate 40 here. I deduct 40 from this 50. Still what am I left with? 10,000. You get it? Okay. The next thing, if I redraft this, I'll write 1 lakh rupees share capital, minority interest 10,000, PPE 1 lakh. Presentation. Instead of scratching it, I do it little. Will you go to the next one? Next concept. See the same thing. Equity share capital 1 lakh, equity share capital 50. Shall I write them together? 1 lakh and 50. How much do I write in consolidated balance sheet? 1 lakh. I'll write 1 lakh and 50, 1 lakh. Got it? What do we have after that? PPE 60, PPE 50. Together 1 lakh 10. Let me write PPE 60 plus 50, 1 lakh 10. Am I going fast? Getting it? Then what do we do after that? Investment in subsidiary is there 40,000. I'll write this investment in subsidiary 40. Done. Now we've written this investment asset here. There is share capital here. Both are representing the same thing. I will scratch it. Shall I? I'll eliminate this 40,000 from this 50,000. What do I get? 10,000. It is not minority interest in this question. You know why? In the previous question, it was minority interest because out of the 5,000 shares, I held only 4,000. That 1,000 is somebody holding it. But in this case, 5,000 shares, what is there in the subsidiary? I am holding all 5,000 shares. So then why do we have 10,000 difference? Basically because this 50,000 is nominal value and I don't have to pay nominal value to buy. I might pay something more or I might pay something less. Here I paid only 40,000 to get the shares of nominal value 50. I paid only 40,000 to get shares of nominal value 50. So I made profit. I made 50,000 worth of capital I got, meaning 50,000 worth of assets is mine. I got 50,000 worth of assets by paying only 40,000 rupees. Profit, which is capital in nature. Profit, which is this capital profit of 10,000 is arrived at by eliminating 40,000 from asset and 40,000 from liability. That 10,000 capital profit will be capital reserve. So I'll write equity share capital 1 lakh. This 50 is eliminated. Capital reserve 10. PPE is 1 lakh 10 and my consolidated balance will tally. I'm gradually building it block by block. Got it? So in this question, what happened? We had to pay 50,000, but we paid only 40. We got 50,000 nominal value shares. That is assets worth 50,000 by paying only 40,000. In the next concept capsule, you know what's going to happen? You're going to get 5,000 shares whose nominal value is 50,000. That is right on the assets which are costing 50 by paying 60,000. So you paid more. You paid, shall we see how to treat it? Very simple. Share capital here 1 lakh, share capital here 50. I'll rate them both 1 lakh and 50. Then what do we have here? PPE 40, PPE 50. Together PPE 90. Got it? Then investments. How much is investments here? 60. Let me write here investments. Is there any outsider holding the shares? No, 100% subsidiary. So I'll eliminate 60 here and 50 here. Oh, not possible. I'll eliminate this 50 here and I'll eliminate this 50 from 60. I'm still left with 10,000. I'm still left with 10,000. I cannot write here as minus 10. I'll write it as asset. What is happening here? I'm getting 50,000 nominal value of shares by paying 60,000 rupees to them. I'm getting 50,000 worth of assets from them by paying 60,000. Then what does it mean? There is one more asset here worth 10,000 what I'm getting, which I don't know. I can't see. That is nothing but goodwill. Are you getting it? That's it. So you'll write 1 lakh rupees share capital, PPE 90, goodwill 10. Together 1 lakh, the balance will 10. Did you understand how will goodwill arise? How will capital reserve arise?
Okay. Then we'll go to next case. I will look at concept capsule number 5. At any point of time, if you think I'm going fast, you want a minute to stare at the answer, or you want me to repeat what I'm telling, please ask. Stop me there. Got it? Yeah. See here. Capital is 1 lakh, no problem. 5,000 shares in subsidiary, no problem. We have 4,000 shares at 60,000. We knew 4,000 shares at 50,000, 4,000 shares at 40,000. Now we have 4,000 shares at 60,000. Because we have only 4,000 shares, that means there is minority interest. And we paid 60,000 instead of 40. So there is goodwill also. So both minority interest and goodwill coming. So I'll first take share capital of 1 lakh, share capital of 50. I'll write it together. Now we'll not do that writing and scratching. Now we'll act little mature. I'll write my share capital in my balance sheet. Who's preparing the balance sheet? Holding company. Holding company will write only holding company's capital. Holding company will not write subsidiary's capital. Why? On the share certificate of the subsidiary company's name is written. This is not subsidiary company's balance sheet. So I can't write. I will write this 1 lakh rupees my share capital in my balance sheet. Subsidiary share capital of 50,000. I will write outside the balance sheet. Shareholding of subsidiary. 5,000 shares or rupees 10 each. Done. Whatever is written in yellow, that's the only thing that I've written. Rest of the items are assumed to be not there. Today, you want me to clear it and then do, I can clear it and then do it. This is fine. This will be a little quicker. So next item. What is the next item in the liability side? Nothing. Go to asset side. What do we have asset side? PPE. How much PPE? PPE 40, PPE 50. Shall I add them? Let's write in the balance sheet. PPE 40 plus 50, 90. Done. Come to the next line of the question. Investment in subsidiaries 60,000. See, this investment I will not take it to my balance sheet assets. Why? This has to be adjusted with this. Correct? Huh? So I'll take this outside. Shall I take this outside? How many shares are there? 4,000 shares. So right here, share capital is 50,000 rupees, which is 5,000 shares. In this, holding company has 4,000 shares. If it is 4,000 shares, what is the nominal value? 40,000. If it is 4,000 shares, how much is nominal value? So this 40,000 nominal value should be adjusted against that investment. So I will prepare cost of control table. We call it cost of control. Call it cost of control. So we'll adjust this liability and asset. Here it's there, no. He has to adjust this 60 with this 50, no. In this 50, I don't own completely. Only 40 of this and 60 should be compared. You did know 40, 60, 20 goodwill. That's cost of control. So I'll write this 60,000 investment asset. 60,000 is asset. And in this 50,000, 40,000 is liability. You take the net now. If 40 liability, 60 asset, which is more? Asset. How much is that asset? Goodwill, 20,000. Understood? Goodwill will write in balance sheet 20. Got it? Here, 4,000 shares out of 5,000 I hold. How much does minority hold? 1,000. 1,000 will be 10,000. This I'll write it in balance sheet as minority. Take the balance sheet total 110. Did you understand? Previously I used to do this scratching off here only. Now I've started to do as a separate table. Why? I would need it for the problems which becomes a little more complex. I would have to do a separate working. I don't do step 1, step 2, step 3, step 4 approach. Majority of you might have learned very different. So this I see it as, what to say, one kind of flow is what I bring it into. Yeah. If you're comfortable with whatever approach that you read, otherwise, please continue the same. Yeah. People who are open still to learn something, this is one. But ultimately, concept is same at the end. Just the way you present the working note is slightly. Got it? Next concept capsule. Okay. What is different in this one? We own 4,000 shares out of their 5,000. So there is minority interest. And we paid 30,000 for 40,000 nominal value worth of shares. So there will be capital reserve of 10,000. Shall I do it? Now, my share capital of 10,000 shares of rupees 1 lakh each. I'll write in my balance sheet. What do I do with subsidiary share capital of 5,000 shares of rupees 10 is 50,000? Separately, I should write to adjust. So I'll open one separate table where I'll write shareholding, share capital, 5,000 shares of rupees 10 is 50,000 rupees. Ashte, where ಏನು ಬರಿಬಾರದು. Just write so much. Then comes to next item, PPE. Our PPE is how much? 20. Their PPE is how much? 70 plus 50. Our PPE is 70, their PPE 50. Together 70 plus 50, 120. Done. Next item. Investment in subsidiary, 30,000 rupees and 4,000 shares. First focus on 4,000 shares. Focus on 4,000 shares.
So shareholding of subsidiary is 5,000 shares. In that holding has 4,000 shares, which comes to 40,000. So this 40,000 is nominal value of investments, which is liability. Against this, how much is the asset here in the balance sheet? How much is the asset? 30. I'll write here book value of investment is 30. Book value of investment is, so liability 40, asset 30. Which is more? Liability. How much? Liability of 10,000. That liability will be capital reserve. If it was asset, it would have been goodwill. I'll write this capital reserve in reserves and surplus 10. Got it? Then out of shareholding, 4,000 holding. Correct? 1,000 will be minority. That is 10,000. Minority interest I'll write in balance sheet 10,000. Now look at balance sheet. 1 lakh plus 10 plus 10, 120. 120 PPE, it's 10. Consolidated balance. Shall we slightly go to the next one now? Slowly after each concept capsule, I'm adding one new adjustment. You observe. Observe. What is the adjustment in this one? Reserves has come. There is a reserves and surplus of 10,000 in subsidiaries balance. Getting it? Whom does this reserve belong to? Holding and minority. Holding and, you getting it? This has to be split between holding and minority. And further, the holdings share in the reserves should be categorized as how much is pre-acquisition and how much is post-acquisition. Why? Pre-acquisition reserve, whatever is there, is capital in nature. Post-acquisition reserve, what is there, is revenue in nature. Pre-acquisition reserve should be adjusted against the cost of investment, and post-acquisition reserve should be taken to general reserve, not P&L account. You get this? I'll do it. We need to do one more table for reserves in this case. Let's start with equity share capital. How much is my equity share capital? Where do we write it? In our consolidated balance sheet. Shall I write? In my consolidated balance sheet, I'll write equity share capital 1. Got it? Let's go to subsidiary. What do we do with subsidiary share capital of 50? This has to be split. How much holding company and how much minority. So I'll prepare one separate working. I'll write share capital of subsidiary company. 5,000 shares of 10 each is 50,000. ಅಷ್ಟೇ ಬೇರೆ ಏನು ಬರೀಬಾರ್ದು ಇದೆಲ್ಲ ಆಮೇಲೆ this one all we don't know, we'll get to know later. Then what is there? Reserves and surplus of 10,000. Reserves and surplus of, there is some adjustment here. On the date of acquisition, reserves is how much? 2,000. So what do I do? Reserves of subsidiaries 10,000. Reserves of subsidiaries in that pre-acquisition is 2,000. Is capital in nature. Post-acquisition will be how much then? 8,000, which is revenue in nature. This 2,000 rupees pre-acquisition reserves is capital in nature. This will decrease the cost of. This will decrease the cost of. What do we do with this revenue reserve of 8,000? That will go to balance sheet. I will write in balance sheet revenue reserve 8,000. Straight away to balance sheet. Done? Is something. Then what do we have after that reserves? Balance sheet assets. PPE S2 50. PPE S2 60. 50 plus 60, 110. Balance sheet asset side, PPE 50 plus 60, 1 lakh. Come back to asset side. We have investment in subsidiary, 5,000 shares, 50,000 rupees. 5,000 shares. Let's do our share cap. Holding is how much? 5,000 shares, which is 50,000. So this is 100%. So minority is 0 in this question. Here I just want you to understand pre and post treatment of reserves. Then we'll do pre and post treatment of reserves with minority in the next concept. So 50,000 is nominal value of investment. What is 50,000? I will write cost of control table. Nominal value of investment 50,000, liability. How much is the investment cost? Here, how much is the asset value? 50. But we need to adjust pre-acquisition reserves of 2. Whenever we receive pre-acquisition dividend in investment account also, what do? We deduct it from the cost of investments. In the investment account credit side amount column, that's what we're trying to do. Book value of investment is 15. From that, I deduct pre-acquisition reserve of 2,000. So I will have 48,000 as my asset. Now asset is 48, liability is 50. Which is more? Liability. By how much? 2,000. Liability is capital reserve. In my reserves and surplus, I'll write capital reserve. Done. Check the balance sheet total now. 1 lakh 2 plus 8, 1 lakh 10 and 1 lakh. You getting it?
some cases in the presentation, what they would do is this 2000 pre-acquisition reserve, I'm deducting from the cost of investment. No, some presentations, what is given in some materials, no, they usually add it to this nominal value 50. They say share in the share capital, share in the pre-acquisition reserves, they add. It will give same answer. If I add, it will become 52 here, 50 here, 2000 liability capital reserve baratte. But that is not in line with accounting standard 13. What people do when they do that such approach is, we are totally forgetting accounting standard 13. We are only applying AS 21. AS 21 doesn't tell how to adjust cost of control. It only tells it's capital in nature. So what we do there is we are completely ignoring accounting standard 13. Accounting standard 13 says pre-acquisition profit, dividend or interest should be deducted from, correct, no, cost of investment. So we have to deduct. Answer will be same. You will get marks in the exam. You get marks in the exam by doing it. But if you ask me what's more appropriate, I will say deduct it from 50 and not add it to, don't add it to liability 50. Deduct it from cost of investments. Got it? Shall we do next one? Too much? Jasti aita? Artha agtidya? Very good. So now have a look. So what is happening in this one? We hold 4,000 shares. How many shares do we hold? How much do they have? 5. So 1,000 minority interest is there. Reserves is 10,000. So now this reserves doesn't completely belong to us. This reserves will belong to minority also to an extent. So what do we do? This reserves should be split into pre and post. Among the pre-reserves should be further split into holding minority. Among the post again should be split into holding minority. Holdings pre-acquisition reserves will reduce the cost of investments. Holdings post-acquisition reserve will go to balance sheet. What do we do with minority share? Minority share in capital plus minority share in pre-acquisition reserves plus minority share in post-acquisition reserves. We'll add all of it together and call it minority interest and write it in. Shall I solve? Have a look. So equity share capital, how much? 1 lakh. I'll write our share capital, our balance sheet. Then subsidiaries, 50,000. What do we do? I'll write it in share. 50,000. 5,000 shares of rupees 10 each. After that, this has to be split between holding minority. Right now we don't know. Then reserves and surplus of minorities, sorry, reserves and surplus of subsidiaries, how much? 10,000. In this, how much is pre-acquisition? So I'll write 10,000. Reserves of subsidiary 10,000. Split between pre and post. Pre 2, post 8. Pre 2 ಆದರೆ post ಎಷ್ಟಾಗುತ್ತೆ 8. Correct? Then PPE, how much hours? 50. How much theirs? 6. What's mine is mine. What's there is also mine. 50 plus 60. 110. I'll write here. PPE 50 plus 60. 1. Sir, but out of that 60, you don't own completely. I don't own completely, but I control it completely. And asset is based on control. So we write it here. However, to the extent I don't own, I'll write minority interest no later. So that this much assets is completely mine except this minority interest. Got it? Then we have investment in subsidiary. 4,000 shares, 50,000 rupees. So out of this 5,000, how much do I own? 4,000. How much is minority? 4,000 is mine, 1,000 is minority. Got it? So 40, 80%, 10,000 and 20%. This percentage is required now to share. So I was doing it from then only. 40,000 rupees is the nominal value of investment. I'll write in cost of control 40,000 lakh. Are you getting it? 10,000 minority interest computation will write share capital. How much is the cost of investments here? How much did we pay? 50. I'll write here in the cost of control book value of investments 50. This is asset. This is done. Next, what's after that? I think the question is over. Question is, now we have the ratio here, no? How much holding? 80%. How much minority? 20%. So here we have segregated this reserve as pre-acquisition to be 2,000, post-acquisition to be 8,000. So this pre and post should be again split between holding and minority. How much holding? How much minority? How much holding? How much minority? You can say that I'll put 2 more boxes here only. Here I put reserve, pre, post. Under pre, holding minority. Post, holding minority. I can do that way. What if there are 2 reserves? Reserve number 1, pre, post. Pre, holding minority. Post, holding minority. Reserve number 2, pre, post.
Pre holding minority, post holding. No, more reserve with that. It will look like some what is a fiber root system. Getting what I'm trying to tell? So it's nice to draw arrow marks like that, but it will not work out here. We'd have to save time. So what do we do instead? I'll take pre-reserves and post-reserve, prepare a table. So in my table, I'll write how much is pre-acquisition reserve, 2000. How much is post-acquisition reserve, 8000. Same thing, guys. Pre-2, post-8. Now we'll split between holding and minority. What is the ratio? 80 and I'll write here holding 80, minority 2000 into 80%. 1600. Holdings share in pre-acquisition profit. What is the accounting treatment? Should be used to reduce the cost of investment. How much is the cost of investments? 50. I'll reduce this 1600 from there, making it 48,000. Asset is 48,400. Liability is 40. Goodwill of 8,400. I'll write in balance sheet goodwill 8,000. Then how much is post acquisition share? 8,000 into 80%, 6,400. This 6,400 will go to balance sheet as revenue reserve 6,000. Minority share will be how much? 20% of 2,400, 20% of 8,000, 1,600. These both 400 and 1,600 will belong to minority. In my minority interest, they also get capital of 10,000, capital reserve of 400, revenue reserve of 1,600. Together, how much is minority interest? 12,000. This 12,000 I will post here minor. Done. Now see the total. 1 lakh plus 12,000 plus 6,000. 1 lakh 10 plus 8,000. You like this way of presentation? This chapter, what we did is this, whatever this box you see, no, that box was printed without numbers and without data. These two balance sheets were printed with numbers. People had to only fill these boxes in the, and later we did the big questions. Big questions they could do it themselves straight away. First question they could do it themselves. We did them also, but just this concept capsules will make our life very easy when we go to big questions. Yeah. Similarly, I did the concept capsule questions for partnership. Now trying to do similar thing for other chapter. So every chapter when we start, before we do question number 1, I want you to do some 15-20 small capsule questions. You do 15-20 small concept capsule questions. There other items won't be there. Only that adjustment item only will be there. So you become very comfortable doing it, and you will be able to cover more adjustments in less time. Lot of items are easy in the question. Only one adjustment is tricky. Just for that one adjustment, you do big question. If you do that, you won't be able to do many questions. So once you do this, you are aware of all the adjustments. Then you do big questions. Big question may you don't shiver because you already know that only adjustment difficult part you trained well. Got it? Yeah, it's like every time you want to get match practice, you don't have to play a 50 over game. What are you bad at? Ball outside the off stump. Then you bring one net bowler and then only for 10 overs you bat only ball outside your off stump. So you become really good at it. You go to the match, whether the ball is outside off stump or the ball is right over your head, you will be able to play. Let's see. Next illustration number or concept capsule number 9. See what's unique in this one. So there are 2 reserves. How many reserves? Tell me, what do we start with? First one, share capital. What do we do with share capital? Where do we write it? Consolidated balance sheet, liability side, share capital. Done. Next item. Hey, you should tell. I've done so many. I've done how many? I've done 8 examples. Subsidiary share capital. Where do we write? Outside the balance sheet, I'll write share capital. 5,000 shares of which 10 is 50,000. Ashte. Don't write more. What is after? Next item. General reserve. How much? 10 and 5. Where do we write? Outside the balance sheet, we write waiting to be split into pre and. So I'll open one more table here for reserves. General reserve 10,000. P&L account 5,000. Do we know the split? We don't. We'll come back later. Okay, now what is after that? Reserves over. Then PPE, how much? 50, 65. Total 115. I will write in my balance sheet straight PPE 50 plus 65. 115. The revaluation adjustment
Yeah, you see here, I have one episode list here. See, now we are doing illustration number 9. We're doing more than one reserve. Next will be negative reserve. After that, bonus issue, then dividend, then upward revaluation of PP, then downward revaluation, then the upward with depreciation, then downward with depreciation, then mutual indebtedness, then mutual indebtedness upward. Previous one was downwards, then debenture. Yeah. So the next time this will be in the theme of friends. So it will be like, okay, one with fully owned subsidiary, one with minority interest, one where there is no goodwill, one with capital reserve. So each of them is like one episode. So making it like full theme based. Be fun to do. Be very hectic to do. ಮಾಡಕ್ಕೆ it's for long hours. Be exciting. Done. So PPE we added. Next. Investment in subsidiary. How much? Investment in subsidiary 4,000 shares. First we'll deal 4,000 shares. Then we'll come to 50. Where do we rate 4,000 shares? Share capital of subsidiary ಬರ್ದಿರ್ತೀವಲ್ಲ, there will split 4,000 and so I'll write here holding 4,000. So minority will be 1,000. If holding is 4,000, that will be 40,000 rupees and then 80%. Minority will be 10,000 rupees and 20%. So shall I write this 40,000? Where do we write 40,000? Cost of control. Liability asset. Asset. So I'll write cost of control. Book value of investment is how much? No. Sorry. Nominal value of investment is nominal value of investment is 40,000 liability. What about this 10,000? Minority interest share capital 10,000. Done. So next investment value is how much? 50. This 50 where do we write? Cost of control, book value of asset. Book value of asset where do we write? Inner column 50. Inner column, everyone got it? Okay. What's after this? Come to next slide. On the date of acquisition, general reserve is 6, P&L account is 1. Sir, mathili 10 and 5 and 10 and 5 is on the balance sheet date. 6 and 1 is on the opening date. 6 and 1 is on the 12 rate. In the 10, 6 is pre, 4 is in P&L 5, 1 is pre, 4 is, shall we do that? In reserve sell rate, pre is 6, post is in P&L account, pre is 1, post is, so now we'll take these reserves together. So how much is pre? 6, 1 together 7. I'll write total 7,000 pre acquisition. Post acquisition 4. Can I say 8? This has to be split between holding and minority. Do we know the ratio? Yeah. How much? 80 and 20. Shall we share in 80-20 ratio? 80% of 7,000. 5,000. Where do we write this 5,600? Deduct it from cost of investments. Where is cost of investments? Ali andre cost of control. Cost of control, you would have written asset, no, book value of investment 50. From that you deduct pre-acquisition reserves 5,600. If you deduct 5,600, what do we get? 44,400. Done. Okay. Next item we go. 6,400 post acquisition for holding. Where do we write it? Balance sheet straight away. Reserves, revenue reserves 6,400. After that, minority 1,400 and 1,600. Where do we write? Minority in 1,400, 1,000 together 13,000. Where do we write this 13,000 minority interest? Balance sheet asset. And then here asset is 44,400. Liability is 40,000. Tell me what is more? Asset of 4,400. That will be goodwill. Where do we write? Balance sheet asset side goodwill 4,000. Everything is marked in yellow. Everything is closed. Getting it? Take this. Time 1 lakh plus 6,400 plus 13,000. 1 lakh 19,000.
400. Liability side, sorry, asset side, 115 plus 4, 190, 400. Understood? Okay, that's what I asked. Do you want me to teach like this? The other approach was this way. ಇಲ್ಲಿ ಬಂದ್ಬಿಟ್ಟು ಇಲ್ಲಿ ಹಿಂಗೆ one more approach was like this: consolidation. Consolidation, guys, this all the companies, what is their subsidiary, we merge, we add these two balance sheets together, you do one balance sheet, that is consolidation. And then basically tell what is control, what is non-controlling interest, what is minority interest, and then make you tell all these points. Consolidation of balance sheet, points to consider, ensure that the balance sheet dates are same, important date of identify date of acquisition, determine percentage of holding, explain it theoretically like this: how to treat reserves, how to treat bonus issue, how to treat dividend, tell orally statement. This is fine. Actually, the main adjustments will start now: bonus issue, dividend, devaluation of asset, and all of that. But now you got used to this format, no? Now you're familiar. Now you feel no, idu all barutte, adu illi barutte, idu illinda alliga. Now you will be able to place it much. Chalo, let's start with next question. Question number 10. See what's happening here. General reserve 10,000 and 5,000 is there, no? Here on the date of acquisition, general reserve is 6,000. Okay, post will become 4. P&L account, P&L account is 5,000, no closing date. On the opening date, it is 6. ಹಿಂಗೆ ಆಮೇಲೆ you did loss. ತುಂಬಾ ಚೆನ್ನಾಗಿ business ಮಾಡಿದ್ರಿ, you made loss of 1,000. 6,000 was the profit and loss account balance at the beginning of the year. End of the year, it became 5. Do you want to solve this? Solve this. 2 minutes. I've done 10. Sorry, I've done 9. I'm asking you to do 10th one. Don't copy the balance sheet. Only do the answer. Little bit of writing. Stop the recording. People in the class were solving it. For the people who did it from home, this is the answer for concept capsule number 10. 10, the question is here. The answer is here. You can pause and check if you want, and I'll also show the reserve analysis. That's it. Doubt. No doubts. Which part? Minus 1,000 here. See, reserves is 5,000 on the balance sheet. In that, on the date of acquisition, it is 6. From 6, how did it become 5? Minus 1. That is, during the year, there is loss of 1,000. So this becomes our post acquisition. 5 minus 6. Then simple. 6, 6, 12. 12,000 pre-acquisition. Post acquisition, 4 minus 1. That will become 3. Okay. Now then you split that 88-20 ratio. If you do it in 80-20 ratio, 9,600. 4,000 post acquisition minus 1. 4,000 plus minus 1. Plus minus 4,000 minus 1. I hope that was the only doubt. Ratio stay further. Why would we treat 9,600? 2,000 not required. Okay. Shall we go to 11th one? 11th one, bonus issue. Bonus issue. Interesting. Have a look. And bonus issue, if it is made by holding company, it doesn't affect much. It is interesting when bonus issue is made by subsidiary company. And if that subsidiary company's bonus issue is already accounted, then we don't have anything to do. If they have not accounted, they'll tell after the balance sheet date, now they're making bonus issue, asking us to do the accounting entry. Then it becomes, okay, what do we do? Bonus issue madadaga. Capitalization of reserves of subsidiary. Subsidiaries reserves will decrease. Holding subsidiary share capital will increase. We'll take money from this reserves, 52 share capital. So, should we deduct it from pre-acquisition reserves? Reserves they will be deducted, or post-acquisition reserves? Order of bonus issue. First CRR. CRR will be pre. Then it will be security premium. If it is post, can be post. We don't know.
So it depends upon the reserve order. CRR, security premium, capital reserve, general reserve, and then P&L. Usually it will be from pre-acquisition reserves. You deduct it. Are you getting it? And then pre-post normal analysis. Then it will get added to capital. What do we do capital? Just here. That bonus issue is there, no? That should also be shared between holding and minority. Why? Holding also will get bonus shares. Minority also will get bonus shares. What do we do with holding share of bonus? Huh? Cost of investment minus or plus? I'll tell something. You should not adjust cost. You should not adjust cost. Why? Accounting standard 13. Accounting standard 13. What does it do whenever there is bonus shares? Does it affect amount column? It should increase nominal value column. So now bonus issue should be added to liability nominal value of investments. We'll add it to liability. We write no cost of control, nominal value of investment, book value of investment. Pre-acquisition reserves we deduct from book value. Bonus issue we add it to nominal value. Nominal value will increase. What about subsidiary? Sorry, what about minority? Take it to minority table, add it and put it to balance sheet. I hope you understood. I showed you some story now. We'll see the story. Let's start. Equity share capital 1 lakh. Where would this go? Balance sheet. Balance sheet. Then equity of subsidiary. What do we do? Split. Outside we'll keep it and then split it. Split it between holding and minority. How much? Then reserves of subsidiary. Sorry, reserves of holding 20. This will write like that only in the balance sheet. Don't change it. General reserve 20,000. General reserve. Okay. Subsidiaries general reserve 20, subsidiaries P&L account 5 should be split as pre-post holding minority adjustment for bonus everything. So we'll write it outside. I'll write it outside as what to say general reserve 20, profit and loss 5. We don't know pre-post. We'll just write and wait. Okay. I'll write reserves. General reserve 20, P&L 5. Do we know how much pre, how much post? Not right now. When do we get to know? After balance sheet in the adjustment. Yeah? Next item. What's after this? Assets. PPE 70, PPE 75. 70 and 75. Shall I add them and write? 145. Next when we do questions, we'll do it based on revaluation of. But then I will not give you adjustment of separate questions. 70 and 75. 145. Understood this? Amela. Investment in subsidiary 4,000 shares 50,000 rupees. 4,000 shares 50,000 rupees. First concentrate on 4,000 shares. First concentrate on here equity share capital of subsidiary done outside. I'll split holding 4,000 shares 40,000 rupees 80%. Subsidiary 1,000 shares 10,000 rupees 10%. This 40,000 where do I write? Cost of control, nominal value of investment, inner column 40. Why inner column? Bonus issue to be adjusted. Then what do we do with this? Minority is 10,000. Minority interest, share capital 10,000. Done. Come back. 50,000 rupees is book value of asset. I'll write in cost of control. Is something. Book value of investments, cost of control 50,000. Then balance sheet is over. Shall we go to adjustments? First one. General reserve and P&L account. Pre-acquisition is how much? 15 and 1. 15 and I will write in reserves and surplus. Pre-acquisition 15. Post-acquisition 5. And this one. Pre-acquisition 1. So post will be 4. 5 minus 1. Here 20 minus 15. Understood this? Any doubt? Previously we used to take this 15 and 1 and write it in resource allocation. Now we don't do that. Why? There is some adjustment. What is the next adjustment? Subsidiary company announced bonus issue of 1 share for every 5 shares. 1 share for every. So listen to me carefully. Bonus. Bonus. Shares held if it is 5. Bonus will be 1. What is share capital of subsidiary? Have a look at share capital of subsidiary. How much is their share capital? 5,000 shares. How many shares? Now, if their shares is 5,000, how many shares will be given as bonus? 1,000. How? 5,000 into 1 divided by 5. 1,000 shares will be given as. What is the value of each share? Nominal value 10. So bonus shares is 1000. Nominal value per share is 10. Can I say reserves required is 10,000? From where do we take reserves? We'll start with CRR. Is there CRR? Next, security premium. Is there security premium? Next, capital reserve. Is there capital reserve? Next, general reserve. Is there general reserve? Yes. And is there 10,000 in general reserve? Yes. So shall I take 10,000 from general reserve? Yes or no? So 15,000 general reserve. May I took 10,000. I took 10,000. This 10,000 will become my bonus issue. 10,000 is 1,000 shares of rupees 10 each. This should belong to holding and minority. Holding and tell me how much will holding get? 80%. Sir, 80. Here we did no. That is the reason we compute here 80-20 percentage. Got it? Now come on here. Holding will get 80%. That is 800 shares, 8,000 rupees. Think and tell me. I've already told you. What do we do with this 8,000 rupees? Cost of control. Very good. What do we do in cost of control? Add to what? Nominal value of investments. We add it to nominal value of investments. Here in cost of control, we have nominal value of investments 40,000. Correct. To this, I'll add bonus issue 8,000. How much will it become? 48,000 liability. Then what do we do with minorities 20%? That is 2,000. Add to minority interest. Minority interest is here. Bonus issue 2,000. So bonus issue is over. Anything else left in the question? No, everything is over. Reserve analysis, distribution of reserves, cost of control computation, posting to balance sheet. Ashte baki. Will do. Reserve. How much is pre? 5 and 1,000. Correct? Totally 6,000. 6,000 pre-acquisition. What about post? 5,000, 4,000. Together 9,000 posted. Holding will get 80%. 80% of 6,000. 4,800. What do we do? Adjust it from cost of, very good, cost of investments. Pre-acquisition reserves 4,800. I'll adjust. 50 minus 4,800, 45,200. Got it? What do we do with post-acquisition? 7,200. Balance sheet, I'll write revenue reserve 7,000. Minority 1,200 and 1,800. Write in minority interest 1,200, 1,000. Take the total of minority 15,000. 15,000 will write here. Illi. Liability 48,000, assets 45,200. What is more? Liability of how much? 2,800 liability capital. I'll write capital reserve of 2,800. Check 20,000 plus 2,800 plus 7,200, 30,000. 130 plus 15, 145, and it is 145 anta. No sir, 130. Time alla. Balance sheet total. 145. Okay? Chetan doubt idya? Sarana? Saran doubt idya? Sir, inna artha ಮಾಡಿ. Then also has to call Chetan. Sorry for now, sorry for then, sorry for future. Let us go to next concept. Hey, anything that you got stuck here? You understood? Observe the reserve part. You do pre-post first. From pre, you eliminate bonus issues reserve. Whatever is there will be taken to analysis of reserves. You should do everything in one table. Now you split it into multiple tables. Usually, ICS statement, they do it all in one table. One table inner column they do, and then outer column, and then they split. That's how it is in the middle. Yeah, I used to find it very difficult to understand from this. So then I made for my understanding, but unfortunately, I never wrote consolidation in my exam. Because when I wrote IPCC, consolidation was not there. When I wrote final, I didn't understand consolidation. I should teach step 1, step 2, step 3, step 4 approach. Ooh. I did not understand. So I used to do amalgamation. A consolidation or amalgamation. Once I read, first time I read, the day before the exam, I could not revise. It went over my head the day before exam. Then I stopped. Then I cleared writing only amalgamation. Next example. Pakka next example hogoda. Let's go to next one. Dividend. Dividend. Who's declaring dividend? Subsidiary. If hold, doubt amma. Subsidiary is declaring dividend. If holding declares dividend, no problem. Deduct cash, deduct reserve. Khatam. Subsidiary declares dividend, you know what will happen? Holding company, what should they do? Holding company, what should they do? That dividend received is received in cash. You cannot write cash account debit to dividend income to P&L. The reason is such dividend what we receive can be from pre-acquisition profits. If such dividend received is from pre-acquisition profits, such dividend should be adjusted against the cost of investment. If it is from post-acquisition profit, it should be taken to P&L. Got it? When they give dividend here, we need to check whether they've declared dividend but they've not written entry. They want us to write journal entry, or they've declared a dividend, they have paid a dividend, they have accounted a dividend, and the holding company has taken it wrongly to P&L. So are they asking us to do updation of books of accounts for dividend, or are they asking us to do rectification of wrong treatment of dividend in the books of holding company? The question. If they've already paid dividend, if they've already written entries for it, and the holding company has wrongly included in P&L instead of treating it as reduction in cost, then we'll deduct from profit of holding, deduct it from cost of investment in the balance sheet assets. That's it. Minority no adjustment, cash no adjustment, nothing adjustment. If in case we have to pass journal entries, reserves of subsidiary which is free has to be reduced. Cash balance of subsidiary has to be reduced to the same extent. Cash balance of holding should be increased to the extent holding receives cash. And so to the same extent, we decrease the cost of investments. Minority interest will never get affected. Why? We give them cash, they take cash and they go. So we don't have to add it to minority interest. However, if it is declared but not paid, then we would have to add it to minority, we would have to adjust it with cost of investment. But however, that used to be done previously. Under limited what is say revision that is made in accounting standard 4, events occurring after balance sheet date, dividend is not an adjusting event. Remember, adjusting event, not adjusting. Dividend is not an adjusting event. Dividend should be recorded only when it is declared, not when it is proposed, because the shareholders have a right to either accept it at the same rate or accept it at discounted or deny the dividend. So proposed dividend we should not adjust. So proposed dividend is ignore madi, or you write it in the consolidated balance sheet also as a liability proposed. So let's see it here. Equity and liabilities, 10,000 shares of rupees 10 each, 1 lakh. Where do we write? Balance sheet, 10,000 shares of rupees 10 each, 1. Then subsidiaries, 5,000 shares of rupees 10 each, 50,000. What do I do? Outside the balance sheet, I will split holding and minority. How much holding, how much minority? Kuttila. We'll get to know later. Reserves, 10,000, 5,000. What do? We should write and then split. Right now we don't know split. We'll write it outside the balance sheet as reserves. How much general reserve? How much P&L account? Write so much and P. What's after that? 10 and 5. PPE. PPE 50. PPE is 65. 50 plus 65. 50 plus 65. 1,15,000. I will write in my balance sheet asset side PPE 50 plus 65. 1,50,000. Done. After that 50 plus 65, 1,15,000, what do we have? Investment in subsidiary, 50,000. That is 4,000 shares. How many shares? So what do we do with 4,000 shares? 4,000 shares here we split, no? Holding 4,000 shares. Correct? 4,000 shares is 40,000 rupees. 40,000 rupees will become nominal value of investments. Here, nominal value of investments. 40,000. Okay. Then minority will be 1,000 shares. 10%, sorry, 20%. This I'll write in minority interest. Share capital. Understood this? What is after this? Then on the date of acquisition, general reserve and P&L, 6 and 4. I'll write in analysis of reserves. Pre is 6 and then post will be here. Pre is 4, so post will be one last adjustment. Subsidiary declared dividend of how much? 10%. How much is their share capital? Subsidiaries 50,000. Declaration of dividend at 10%. How much is 50,000 into 10%? 5. So 5,000. Let us write here 5,000 rupees. Anybody with 5,000?
Dividend, we'll deduct it from reserves, 5,000. We'll deduct it from reserves, 5,000. Got this? This dividend of 5,000 is pre-acquisition dividend. Why? It is given out of pre-acquisition profit. It is given out of pre-acquisition profit. Share it between holding and minority. How much will holding get? 80%. That is how much? 4,000. That is how much? 4,000. This 4,000, what do? We should adjust it against the cost of investments. Shall we deduct it from cost of investments? How much is my book value of investments? 50 plus pre-acquisition dividend. What do we do with minority? 1,000. We are assuming that this is not proposed, declared, due to be paid, not paid. If we assume to be paid, we'll deduct it from cash. We are assuming that it is due to be paid. So this 1,000, what do I do? 1,000 I'll write here, minority dividend 1,000. Done. Question another baki diya. Question over. Now come on, let's finish reserves. So how much is pre-reserves? 1,000, 4,000. Together 5,000. Post 4,000, 1,000, 5,000. Share it between holding and minority, 80-20. How much 80? 4,000. 4,000 will be deducted from cost of investments. I'll do here pre-acquisition reserve, 4,000. Pre-acquisition profit. Then what about this holdings 4,000? Post balance sheet. Balance sheet, revenue reserve. Minority 1,000 and 1,000. Where do we do? Minority interest. Capital reserve 1,000, revenue reserve 1,000. Done. Ta-da, that's it. Come on, we will close this. This is over, this is over, this is over. Illi. Goodwill continue. Liability 40,000. Asset 50 minus 8, 42,000 asset. Asset is more or liability is more? How much? 2,000. We'll write in the balance sheet asset side, goodwill 2,000. And here minority interest is 13, right? Minority interest 13 in the balance sheet. Now take the 1 lakh plus 4,000 plus 13,000. 1 lakh 4 plus 13, 1 lakh 17. Liability side, sorry, asset side, 115 asset plus 2 goodwill, 1 lakh 17. Done. Pakka. Any doubts? What if dividend is already declared and paid? And they mention in the question, dividend received from subsidiary is taken in P&L account by holding. If they give question like that, what do you do? Deduct from P&L of holding, deduct from cost of holding, that's it. Minority will not get adjusted. Reserves of subsidiary will not get adjusted. Why? If they tell that dividend declared and paid, subsidiaries reserves is already deducted, cash is already deducted, minority has already received, holding is already received and included in cash. There they are asking us to only do rectification in such question. Getting it? Such question also can come. There you would have to only eliminate from reserves of subsidiary, reserves of holding, and eliminate from cost of. Did you understand the concept? That is much simpler. Here you don't have to do operation, only rectification. Can I go to next one, or should we take break? Next one. We are doing example number 12, concept capsule number 12. I think we have till 20. We have till 19. I don't mind. I can take. Asking you. Ball is in your court. We'll finish. We'll take much more time to finish. We'll take about 30 minutes at least. If you want to do all concept number 13 to 19. Or if you want to do little fast, you say, sir, we'll sit for another 20 minutes, sir. You please finish it and then we'll take break. We'll do it. Okay? Yes? Because I don't want you to compromise. You will say, sir, I was hungry, sir, so I didn't observe revaluation of asset. I don't want you to tell that later. Shall I do? Nice. PPE was revalued by 75,000. Same to same like previous one. What's happening now? Asset is now revalued. Asset is now revalued. We'll start. First one. Our capital is our capital. 1 lakh. Where do we write our capital? Consolidated balance sheet. I'll write share capital. Then subsidiary share capital is how much? 50,000. Where do we write this? Outside the balance sheet, I'll write subsidiary share capital 50,000. That is 5,000 shares of rupees 10 is 50. We have not split this yet. We'll do it later. After that, reserves and surplus of subsidiary 10,000. I'll write reserves and surplus of subsidiary
10,000. Do we know the split? No, we don't. What is after that? PPE 50 of holding. Subsidiary right now is 60, but there is adjustment. So I'll write 50 plus 62. 50 I'll write. 62 I don't write. I'll just keep this on hold. Shall I keep it on hold? Or I should write 50, 62 in the inner column and then add revaluation. We'll do it later. Then investment in subsidiary. How much? 4,000 shares. So in the subsidiaries shares of 5,000, 4,000 is holding, that is 40,000. 40,000 I'll write in cost of control, nominal value of investments 40,000. Minority will be 10,000. This I'll write in minority interest share capital. Done. Next, what do we have after that? 50,000 is book value. I'll write in cost of control, book value of investments 50. Done. What's after that? On the date of acquisition, reserves was 2. On the date of acquisition, how much was reserve? So we'll split our reserves. Pre-acquisition is 2. Post-acquisition will be 8. Done. Amele, what else is there in the question? Last one. PPE was revalued to 75,000. So here we have 50. Here we have 60. This 60 should be taken as 75. So in the balance sheet, it will be 50 plus 75, 1,25,000. But what is the actual value? 60. What is the value at which you're taking? 75. So how much are we increasing? As per accounting standard and property, plant and equipment, when we revalue the asset upwards, what do we do? Asset account debit to revaluation reserve. Asset account debit to. So PP is 60, revalue to 70, add asset 15,000, add revaluation reserve 15,000. So now we have revaluation reserve 15,000. Sorry. Now we have revaluation reserve 15,000. Remember, revaluation is done on consolidation, but this is adjustment to the values, that is excess depreciation that is charged in the previous period. So now tell me, this revaluation reserve is pre or post? Always pre. Revaluation reserve is always. So I'll write pre-acquisition 15,000. Now tell me, what is the total pre-acquisition profits? 2,000 here, 15,000 here, totally 17,000. 8,000 here, 0 here, totally 8,000. Got it? Now we have 17 and 8 holding minority 80 and 20%. How much is 80%? 13,600. What do we do with 13,600? Deduct it from the cost of investment. What about holdings post acquisition 6,400? You go to balance sheet, revenue reserve 6. Then what do we have after that? Minority 3,400, 1,600. We'll write in minority interest 3,400. Everything's done. Minority interest 15. And then here our 50 minus 13,600 is 36,400. Which is more? Liability is more, 3,600. That will be balance sheet reserves and surplus capital. Total 113, 119, 124, 134. Sorry. 119 plus 09 plus 15, 124. 124, 600 plus 400, 125. Valid. Understood? Now we did upward revaluation. We did what? We increased the value of the PPE from 60 to 75. So we did plus 50. We did plus 50. Next one going to be minus. PP is how much? 60. PP should be revalued to 55. From 60, we are bringing it down to 55. If you bring it down to 55, you know what will happen? Revaluation reserve will be minus 5. Revaluation reserve will be that minus 5 pre-post we should do. How much is pre? Minus 5. Minus 5 post 0. Got it? Do this. Let's see. Should I just show answer or solve it? It tallies at 1,12,600. It will tally at 1,12,000. It tally at 1,12,600. Got it? You got it. Reserves. You would want to see. Jag. Udar. Remember. We'll do revaluation of asset with depreciation. Easy. Revaluation of the asset with depreciation. Same question. One adjustment is the value of the asset is 54. Asset is to be revalued to 75,000 and depreciation should be provided at 10%. Depreciation should be provided at, okay, now 54 worth of assets will become 75,000. 54 worth of asset will become, so you take so much, you add so much to PPE, you take so much to revaluation reserve. Revaluation reserve will be pre total, holding minority, holding part decrease in cost, and then holdings post acquisition balance sheet. Minorities pre-post together in minority interest. That much we know. Rest everything is simple. Tell me, what do we do with depreciation of 10%? Postally minus part. How much? Tell me how much. I have put the numbers. 21,000 into 10%. Little 54,000 is after charging depreciation already. Some people say we'll charge depreciation on 75,000. Should not charge on 75. The reason is 54,000 is after charging depreciation. Got it? So the value of the asset was 60. We have charged a 10% depreciation, brought it down to 54. If the value of the asset is 75, we should charge depreciation on 75. That is 75,000, sorry, 7,500. But in that, on 60,000, already 6,000 depreciation is charged. Only on that additional increase 15,000, we should charge 10%. That is 1,500 rupees depreciation only. You get it? You get it? Again, how much is depreciation in this case? 1,500. Sir, how, sir? Very simple. What is the value of PPE? Before. They are telling it to revalue, it to be revalued to what rate? 75. 54 is not becoming 75. 54 is after depreciation. Before 54 before depreciation will be 60. 60 is becoming 75. 54 is not becoming 75. 54 is not becoming 75. 60 would have become 75. If you do 54 minus 75 and then do, in the balance sheet you should write 75,000 and then deduct 7,500 and then write. Whoever used to do 54 minus 75 and then that much used to charge depreciation, in the balance sheet used to write 75,000 minus 10%. So the way you present in balance sheet, the way you do in adjustment in pre-acquisition, post-acquisition reserve was not matching. For that moment you would get happiness, but later when you see correct to depreciation. The logic is 54,000 is 90%. That is after charging 10% depreciation. Before 10% depreciation, PPE was 60. 60 is now becoming 75. Increase is 15,000. On that 15,000, we should charge depreciation. How much is 10% depreciation on 15,000? 1,500. 54,000 minus 1,500. What do we get? 52,500. 52,000 or other way. 75,000, no revalued figure, into 10%. How much? 7,500. 7,500 total depreciation will not deduct from profit because already 6,000 depreciation was charged. We only charge 1,500 to what? Post acquisition profit. Post, pre-post we do not. Post is there, from there we deduct. Sir, why post? See, revaluation pre means after revaluation we charge depreciation, that will be post. If it is, this is what? Downward, sorry, upward. Then downward revaluation if we do, ulta. That depreciation is there, no? We will not deduct it, we will add. Should I show the entire answer? Should I solve point to point or just show the answer? So 54, you understood, no? 54 is after depreciation of 10% from 60. So 54,000 is 90%. 100% was 60. Now that 60 is getting revalued to 75. In balance sheet, I will do 75 minus 10%. And in what to say, in reserves adjustment, what do I do? 54, 60 and 75 difference. 15,000 will 10% depreciation. 1,500 should be adjusted. Shall we see it? Observe it. In the balance sheet, I'll write 75,000 minus 7,500 depreciation. In our table for adjustment, depreciation will be 1,000. How? Book value is 60. Already depreciation charged 6. So it is 54. Revised depreciation 7,500. So to be charged depreciation is 1000. Done. And this 1500 is deducted no here. Understood? Once then we'll get capital reserve, revenue reserve, same holding, subsidiary holding, sorry, holding minority split, minority interest, and the cost of control complete. For the other party, for the next question, here look at this. What is PPE? 54. PPE after 10% depreciation. So before depreciation is 60. It is revalued to 55. So there is downward revaluation of, that downward revaluation in revaluation reserve, it will be negative. And we have charged depreciation on 60, that is 6000. We should have charged depreciation on 5500, sorry, 55,000, that is 5500. We charged 500 depreciation extra. That 500 depreciation will be added back in post acquisition. Here depreciation 500 I'll add, and in the balance sheet I'll take 55,000 minus 10. Understood? And that what to say, revaluation reserve, that will be minus 5, completely free. Done? Sir, over? No, I think still we have 3. One is mutual indebtedness, then unrealized profit, then debenture. Now only related. Tell something. Now 10 minutes. Mutual indebtedness. What do you mean mutual indebtedness? One company owes money to the other. Holding goes to subsidiary or subsidiary owes to holding. Why? Because of debtor-creditor relationship or bills payable, bills receivable that is there with them. Individually, no problem. In the consolidated balance sheet, eliminate from bills receivable as well as bills payable, or eliminate from debtors as well as creditors. Easy. Mutual indebtedness is not problem. Unrealized profit is interesting. Mutual indebtedness is not difficult. Mutual indebtedness is easy. We deduct from asset and liability. Unrealized profit is interesting. What will happen in unrealized profit? One has sold the goods to other, and one of them has booked profit. One of them is showing the cost stock at higher value. If the stock is sold, no problem on unrealized profit. Unrealized means holding has sold goods to subsidiary and subsidiary has not sold to outsider, or subsidiary has sold goods to holding and holding has not completely sold it to outside. The stock is still there. The stock is gone out, no problem. No problem. The problem is only when stock is still there. So in the consolidated balance sheet, stock will be at higher value. Stock will be at, profit will also be booked in the same books. Should eliminate profit, we should eliminate stock. Should eliminate profit, we should eliminate. From whose stock should we eliminate? Whose profit should we eliminate is what we're trying to discuss. Whose profit and whose stock? How do we get to know? Depends upon who has sold goods to whom. We call it downstream, upstream. These are the words that is used in the material. We can tell the same thing. Downstream means holding has sold goods to subsidiary. Downstream means holding has sold goods to. So who has closing stock? Subsidiary. Who has booked profit? Holding. From whose stock should I reduce? Subsidiaries stock I should reduce this. A lot of them, what they do, no, they take holding stock, subsidiary stock total, and total say they reduce. Don't do that. You should show the disclosure from whose stock are you eliminating unrealized profit. So take subsidiary stock, eliminate that unrealized profit, and then take it out. Holdings profit is there, no, in reserves and surplus balance sheet. From there we eliminate that unrealized. Got it? They will say goods costing 10,000 rupees were sold, of which only 20% is still remaining unsold. So adjustment should be only for 20%. 10,000 into 20%, 2,000. On that profit margin, that should be adjusted. Got it? This is easy. Why? Downstream. From whose reserves are we adjusting? From whose stock are we adjusting? Now upstream. Subsidiary has sold goods to holding. Subsidiary has sold goods to. In whose closing stock should we do adjustment? Holding. In whose closing stock should we do adjustment? In whose profit should we do adjustment? Now subsidiary profits ಏನೇನೋ ಆಗುತ್ತೆ, pre, post, holding minor. From where do we deduct? Pre. From where do we deduct? Pre. Pre-acquisition profits of subsidiary. From that we eliminate, and then we do the stock. Got it? Then last adjustment. Debentures. As a last adjustment. What do you mean by debentures? Debentures is acknowledgement of debt that is there for subsidiary. Such acknowledgement of debt of subsidiary can be held by holding. Can be held by, if it is held by holding, like how we do share capital, we write share capital and then do holding minority, holding share, we take cost of control, nominal value, book value, difference, goodwill or capital reserve, same to same. Debentures of subsidiary, holding, not minority, others. Not minority. Okay, control illa adರಲ್ಲಿ. Not controlling interest, non controlling interest. It is others. Debentures of subsidiary, holding, others. Holding portion, whatever is it, nominal value you get, right, below cost of control only, right, nominal value of debentures. In the holdings balance sheet, book value will be there 12,000, right, book value 12,000. Book value asset 12, nominal value 10, liability. Which is more? Asset is more, 2,000 goodwill. This goodwill 2,000, that cost of control, whatever goodwill or capital, so together you write it to balance sheet. What if book value is less and nominal value is more? Capital reserve. This capital reserve, that share adjustment में capital reserve or goodwill, what you get, together you post it to balance sheet. I'll show. So you understood now how to treat that. See, debentures of subsidiary split like this. 1 lakh. Here we do cost of control for shares, do cost of control for debenture also. I'm going to say include in the same thing. Here we got, for debentures we got 10,000 rupees capital reserve. For shares we got goodwill 8,400. Which is higher? Liability, take net capital reserve 1,600 to balance sheet. And this subsidiaries, whatever, this other debentures, whatever we have, 2,000, 20,000, 2,000 debentures, write it to balance sheet liability side 20,000. Ashte country. Yeah. And when we do consolidation, please check whether both the balance sheets are on the same date. If both the balance sheets are not on the same date, you need to update the balance sheet and then do it. You need to update the balance sheet and then one more trick is, whenever they give reserves and surplus, sometimes the acquisition need not have happened on the beginning date. Year end is 31st December. Date of acquisition is 1st of January. ಯಾರು ಹೇಳಿದ್ದು 1st of January acquire ಮಾಡಬೇಕು? You could have acquired on 15th of April, 15th of May, 23rd of March. You can acquire on any other day. Then what should you do? Let's say you acquired in the middle of the year. They've given entire year's profit and beginning of the year's profit. Beginning of the year's profit is pre. Profit earned during the year has to be split based on months. Month till date of acquisition is pre, after date of acquisition is post. That is one more trick that can be asked. And that's it. They don't have anything else in consolidation of balance sheet. Consolidation of balance sheet, about 23, 24 questions, the solution is there. This, what we did is now is concept capsules. After this full-fledged problems, like the ones that's there in ICA study material, that questions also we can solve it the exact same way. But the point is, there we write balance sheet and notes to accounts also. After that notes to accounts, our any question in the ICA study material what you show, we can do the answer same way how we did now. See this, this, and then this. Possible or not? Any question, you tell the question, we can do the answer the same way with notes to accounts. Here we added and straight away wrote no balance sheet. In the exam, when you're doing consolidation question, you should also prepare notes to accounts. Should also prepare the consolidation of PL now only or later. Let me finish it off. Consolidation of profit and loss account. Holding and subsidiaries profit and loss account should be brought together and then written together. What can happen is, holding company is controlling the subsidiary company. Holding company should take decisions on behalf of the subsidiary company. Holding company will take board meetings to take decisions for subsidiary company. So holding company is incurring lot of money to manage subsidiary company. So holding company will charge management fee. Holding company will charge management fee to subsidiary company, and subsidiary company will pay it. Whenever subsidiary company will pay management fee, for subsidiary company it will be other expense. For holding company it will be other income. Separate P&L accounts, or expense, your income, okay. Consolidated P&L account, eliminated from other expense, eliminated from other income. Got it? Second one, holding subsidiary might have buyer-seller relationship. Holding might have sold goods, subsidiary might have purchased goods. For holding, because it is sale, it will be there in revenue from operations. For subsidiary, because it is purchase, it will be there in purchase of shit, purchase of stock in trade you have. When they are separate, holding ಗೆ sale, subsidiary ಗೆ purchase, okay. When they are one, it cannot be. So what do we do? From the holdings, revenue from operations, from the subsidiaries, purchase of stock and trade, we eliminate. Sir, can't it be ulta? Yes. Subsidiary could have sold goods to holding. Then eliminate from subsidiaries revenue from operations and holdings purchase of stock and trade. Whenever there is unrealized, whenever there is this mutual indebtedness and goods sold by one to other, check if all the goods are sold. If all the goods are sold, no problem. If certain parts of goods are not sold, on that profit is booked by the other person. So what do? We eliminate it from the profit when we eliminate it from the stock. We just discussed. Stock when we deduct, no. Closing stock will reduce. The closing stock will reduce. In the statement of profit or loss, changes in inventory we do no. There will be reduction. Changes in inventory only reduction. Closing stock value will reduce. Changes in inventory is found as opening stock minus closing stock. When closing stock reduces, that changes in inventory value will further decrease. We should not forget but adjust it. Then whenever interest is to be given by holding to subsidiary for debentures, for subsidiary it will be what to say borrowing cost, that expense, interest expense. For holding it will be other income. Should eliminate it from both places. Same with regard to dividend. I think that's it. There will be no other adjustments for statement of profit. Cash flow consolidation is the easiest thing. For one there will be outflow, for the other there will be inflow. Outflow, inflow. Got it? That's the easiest one. But I think the rest of it you will be able to handle. I hope we were able to do decent justice to the topic of consolidation. Yes, we were supposed to do banking and NBFC before break. Shall we start with banking companies?
Let's quickly revise accounting standard 22, which talks about taxes on income. Though the standard talks about taxes on income, we are not going to discuss about indirect taxes in this standard. All we're going to discuss is only and only about direct taxes. The way we compute tax amount that should be paid as per Income Tax Act 1961 is also told under Income Tax 1961. So the income as per books of accounts, which is prepared as per Accounting Standards and Companies Act, is not the taxable income. How to determine taxable profit on which tax has to be paid is given by Income Tax Act 1961. So the taxable profit which is computed as per Income Tax Act 1961 multiplied by tax percentage will give us current tax. Current tax is the amount that should be paid. On the other hand, amount that is determined as profit as per P&L account, that is based on accounting standards, is the amount on which we apply tax percentage to determine tax expense. In short, tax expense is net profit as per P&L account multiplied by tax percentage. Taxable profit multiplied by tax percentage is current tax. Tax expense which is computed on accounting profit is the amount of expense. Current tax which is computed as taxable income multiplied by tax percentage is the amount to be paid. These won't be same, they will be different. The reason for the difference between taxable income and accounting income, which will lead to difference between tax expense and current tax, can be categorized into two. One, permanent difference. Second one, temporary difference. Permanent difference is the difference which will arise in one period which will not get reversed in the subsequent year. On the other hand, temporary difference is a difference which will arise in one accounting period and it will get reversed in another accounting period. To give an example, depreciation. Depreciation under accounting can be done under WDV, SLM or production units method. On the other hand, under tax system, unless it is an electricity distribution or manufacturing entity, we have to follow WDV. Because the method can be different, the amount of depreciation will be different between taxation and accounting. Because the expenses by way of depreciation is different, profits as per tax records, profits as per accounting records will be different. When these profits are different, on this the tax amount what we compute will also be different. So the tax paid and tax expense will be different. This is only short term difference. This will get reversed in the subsequent years because over the entire useful life of the asset, we are going to charge a finite amount of depreciation. Depreciation will be same throughout the life. It might be charged little less in 1 year, little more in 1 year, but it cannot exceed the cost, it cannot be less than the cost. So that's the reason we call depreciation as timing difference. Or another expenditure which is temporary difference is preliminary expenses, which is regulated by section 35D of Income Tax Act 1961. As per accounts, if I incur any preliminary expenditure, I will charge it to my P&L account in very first year. Entire 50,000 what I have incurred as preliminary expense is expense in year 1. However, as per tax, only 10,000, that is 1/5 of that 50,000 is allowed as expense every year. So in accounts, I charge 50,000 to my P&L account in 1 year. In tax, I write 10, 10, 10 as expense over 5 years. Because of which profits under each of the years will be different. This is temporary difference. Now what is permanent difference? Example can be something like 40A2 or 40A3 or 35 scientific research. 40A2, if you make excessive payments, like you have appointed a clerk who happens to be your relative, he is a person with skill set which deserves salary of 15,000. Let's say you give him salary of 20,000. You made excessive payment of 5,000. As per accounts, we don't care about excessive expense or excessive payment. 20,000 per month salary will be our expense. However, as per tax, only 15,000 per month is allowed as an expenditure. 5,000 rupees, which is an expense paid to the employee in excess of his skill and caliber, is disallowed as an expenditure, and this is permanent disallowance. Similarly, similar to this is 40A3, wherein the cash is paid for an amount exceeding 10,000. Under tax, it is not an expense because it is cash payment. Under account, it's still an expense because we don't care about tax provisions when we start booking our expense in accounts. Because of these differences, profits will be different as per accounts and tax. On that, the tax that we compute also will be different. Between these tax differences, current tax and then tax tax expense as per accounts and current tax payment as per tax, whatever difference arises, we can create deferred tax asset or we can create deferred tax liability only if the difference arising is temporary difference. If the difference arising is permanent difference, there is no possibility of creating deferred tax asset or liability. Whatever is our current tax as per income tax will be accepted to be tax expense and it will be charged to P&L account. However, if the difference is because of temporary difference, the difference arising between our current tax to be paid and tax expense will be booked as deferred tax. Tax expense, what we charge on accounting profit, is what is paid this year, current tax, plus what is deferred and to be paid in later years. So by this we can conclude that there is a formula for determining deferred tax which goes like tax expense is equal to current tax plus deferred tax. Tax expense, what will be charged to P&L account, can be paid this year by way of current tax or can be deferred to be paid in the later years, that is deferred tax. If in case in this formula we substitute our current tax and tax expense, we can find deferred tax liability or deferred tax asset. After substituting tax expense and current tax, if deferred tax happens to become positive, that means there is further expense to be booked beyond our current tax payment. There is further expense to be booked. Such an expenditure, it is not current tax because we are not paying it now. We would have to end up paying it later. Meaning our tax expense is much more than current tax and that would lead to our deferred tax liability. Tax on accounting profits is more than tax on taxable profits. Tax expense is more than current tax and we create provision for this amount, we pay this amount. To the extent we don't pay now, we would have to pay later. It is some money that we are saving now, but we would have to pay later. So right now it is an expense which is not paid, which will lead to deferred tax liability. On the other hand, if our tax expense is less and we end up actually paying more, that excess amount paid will become our deferred tax asset. If in case in this tax expense is equal to current tax plus deferred tax formula, when we find deferred tax by substituting tax expense and current tax, if we get deferred taxes deduction, that means out of the amount that we have paid as current tax, expense is much lesser. Such a decrease in the amount is the money that we have paid now, which we will save later years, in the later years. So that would lead rise to deferred tax asset. In short, the formula is tax expense is equal to current tax plus deferred tax. In this, if the deferred tax resulting is positive, it is deferred tax liability. If the deferred tax resulting is minus, then it is deferred tax asset. The next thing that I would want you to note is there is another way of remembering this entire logic. It is if the tax expense is the expense that is computed based on accounting profit, tax payment is the payment that is determined based on the taxable profit. If in case our expense is more than payment, I mean to say tax expense is greater than current tax. What is happening? Expense is more, payment is less. we have to further pay, that is deferred tax liability. If in case our expense is less, that is tax expense is less, whereas current tax that we have paid as per tax provisions is more, that will become deferred tax asset. Obvious, isn't it? When the expense is more than payment, outstanding expense is liability. When the expense is less but the payment is more, it becomes prepaid expense, that is our asset. A beautiful shortcut to remember the entire thing that we've learned so far is yay, tell. Yay is AEA, tell is TEL, AEA. If accounting expense is more, it is asset. If tax expense is more, it is liability. AEA, accounts expense, if it is more, it is asset. If tax expense is more, it is liability, and this will solve a lot of your problems. Then deferred tax asset recognition should be done little wisely. You would have to be prudent, you would have to make a prudent understanding of the business scenario and then record it, because assets cannot be overstated. You would have read this in accounting standard 1, which talks about prudence when you're picking your accounting policy. Prudence says that we cannot overstate our profits and assets. And whenever you record deferred tax asset, it is an asset, it is a resource which is going to give you future economic benefit for the amount that you paid over and above your current tax, over and above your tax expense in the current year. You will create deferred tax asset only when there is a reasonable certainty that in the later year, the situation will reverse and we can adjust this deferred tax and only pay the lesser amount. Are you guys getting this? Right now our accounting expense is more, so we are creating deferred tax asset. In the later year, accounting expense should be less, that is tax expense should be more, for the reason of creating deferred tax liability. If you have created deferred tax asset in year 1, in year 2 we don't create deferred tax liability, we will reverse the deferred tax asset previously created. If there is a possibility in the future that accounting expense which was more in year 1 will become less in year 2, only then we would have to create deferred tax asset. If not, you should not create deferred tax asset. We call this reasonable certainty. However, if in an organization there is huge unabsorbed depreciation or huge accumulated losses which can be carried forward, what happens in this case is, in the future years, even if you make profits, that profits will be adjusted against unabsorbed depreciation. That profits will be adjusted against the carry forwarded losses, because of which the taxable profit becomes less and the payment becomes less, which will never give rise to scenario of utilizing deferred tax asset. So if an organization has huge accumulated losses or huge unabsorbed depreciation, then before creation of deferred tax asset, don't just check for reasonable certainty, check for virtual certainty, meaning there should be proof and concrete evidence that the deferred tax asset what you are creating in the current year will get reversed. I repeat, deferred tax asset creation is subject to prudence. It can be created only if you expect reversal of deferred tax asset in the later year. When you are creating deferred tax asset, please check for reasonable certainty that there is a possibility of reversal. However, if there is huge accumulated losses or unabsorbed depreciation, reasonable certainty is not sufficient. You have to check virtual certainty, that is proof with evidence. That's with regard to deferred tax asset recognition. So what would be the accounting entry whenever you're trying to account for deferred tax? Initially, whenever we take that expert's tax computation, to that extent we'll write tax expense account debit to provision for tax. When we write tax expense account debit to provision for tax, we're only going to debit the current tax amount. Current tax amount is the amount that should be paid to income tax department, and I'm crediting the same with my provision. After I make this provision only to the extent of current tax, that is taxable income multiplied by tax percentage, I will compare this taxable income with my accounting income. Accounting income into tax percentage, when I do, what I arrive at is the tax expense that I should be debited to P&L. If the tax expense what I compute as per accounting profit is more than the current tax, then I would have to create further expense. So I debit my tax expense account and credit deferred tax liability. But though I increase my expense by debiting tax expense, payment will be only to the extent of current tax. So to the extent I won't pay, it will become deferred tax liability. On the other hand, if my tax expense, that is on accounting profit, happens to be lesser than current tax, then what should I be doing? I should decrease my tax expense. Current tax, what is debited, is the tax that I pay, but my accounting expense is less. I should decrease this expense. In order to decrease this expense, I will credit my tax expense and debit deferred tax. So my payment is more than the expense as per P&L. Over here, what is happening? The expense is more than the payment, so it is deferred tax liability. And next, we need to set off our current tax and deferred tax. If it is legally enforceable that we can set off, it is arising because of the same purpose, then I will do set off. If not, if legally enforceable right to set off exists, then I will do set off. If not, I won't be doing any set off. Deferred tax asset and deferred tax liability, if it is computed under the same law for the same item, we can do setting off. If not, we cannot be doing the set off provision. Then let's talk about the minimum alternate tax and normal tax. Minimum alternate tax. See, with regard to deferred tax computation, don't ever worry about minimum alternate tax. First, finish off your entire deferred tax asset, deferred tax liability computations. Only when you're done with your deferred tax asset, deferred tax liability computation, then start with MAT. Because the standard 22 says that don't apply MAT in computation of deferred tax. So finish off your deferred tax, then start with MAT. MAT is regulated by section 115 JB of Income Tax Act 1961. As per the provisions of section 115 JB, we compute book profit for the purpose of MAT. On this book profit for the purpose of MAT, which you actually don't have to compute, will be given to us in the question. We'll apply MAT rate. MAT rate will be lesser than the normal tax rate because MAT profit will be more than the normal taxable income. So MAT rate will be around 10%. Book profit will be almost equal to accounting profit. So let's get back minimum alternate tax. So we'll apply the MAT rate on the book profit as given under section 115 JB. On that book profit, when we apply MAT rate, we will arrive at minimum alternate tax. As the name says, it is the minimum money that should be paid in alternate way other than the taxable income. Meaning what? If the taxable income multiplied by tax rate, whatever we find as per normal income tax rates, if it is less than the MAT, then we should pay MAT. If the taxable income multiplied by tax rate, what we determine as per normal tax provisions, is greater than the MAT amount, then we pay normal tax. The problem doesn't exist when we pay taxable income multiplied by tax rate, that is tax as per normal rates, is greater than MAT, then there is no problem. If the taxable income multiplied by tax rate is lesser than MAT, then this amount what you are paying in excess of the normal taxable income into tax rate, that amount is allowed to us as MAT credit, minimum alternate tax credit. And in the later year, when the taxable income multiplied by tax rate as per normal tax rate exceeds MAT, then minimum payment will be this much. To this extent, difference between these two, whatever MAT credit you have availed previously can be utilized and you can pay only MAT. Let us say MAT is 100, normal tax is 90. We have to pay 90 normally, but we paid MAT of 100. So 10 rupees what we paid in excess of tax, normal tax, will be MAT credit. In the later year, if normal tax becomes 15, normal tax becomes 15 and our MAT is 10, that 5 what we are paying in excess of minimum money, that can be utilized from the MAT that we have already paid. So though normal tax is 15 and MAT is 10, I won't pay 15, I'll pay 10. 5 of MAT whatever is available will be, whatever was credited previously will be utilized. If MAT is over, then we would have to end up paying the normal taxable income. And this is with regard to our minimum alternate tax in comparison with normal tax. The journal entry will be provision for tax will be debited, MAT credit when you are creating it, you are debiting it, and then you credit bank. MAT credit is like asset. Later when you utilize MAT credit, you will be crediting the MAT credit amount. Got that? Then if MAT credit is greater than normal MAT, this is what I was just trying to tell you people. And MAT has to be created only when there is a MAT credit can be availed, only when there is a reasonable certainty that it will reverse in the future year. If you think, see, this is your tax, normal tax, this is MAT. Right now, what your normal tax is less and MAT is more. You end up paying MAT. This MAT will become your expense unless until there is this scenario, whereas your taxable income will exceed MAT in the later years. If you expect taxable income and normal tax to exceed MAT, where you can avail your MAT credit, if that scenario is possible, you will avail MAT credit. If the possible scenario is this and you never expect the situation to go this way, then don't create MAT credit. Book the entire amount of tax that you pay as your expense. So don't book any MAT credit. Again, prudent estimate is what we're trying to do. And the last point is with regard to tax holiday. In the case of startups, a special feature is allowed by the Income Tax Act of 1961, which says that a startup need not pay tax for 5 years in the first 10 years. So when tax holiday period is allowed to any of a startup or any entity, then they need to recognize their deferred tax liability only and only if it will get reversed beyond that tax holiday period. If that deferred tax liability is getting created during tax holiday and it is getting reversed during tax holiday, then there is no point in creating. No, tax holiday period you don't pay any tax. If deferred tax liability is getting created during tax holiday period and it gets reversed beyond tax holiday period, only then you need to create deferred tax liability. So this is the point that I want you to note with regard to deferred tax liability along with tax holiday. I hope you understood this quick revision of Accounting Standard 22, Taxes on Income. Entire chapter for our discussion, I am dividing it into 3 parts. These are the 3 varieties of questions that you will get in the examination scene also from this chapter. Part 1 or topic 1 is Schedule 3. This is where they would expect you to prepare financial statements, statement of profit or loss and the balance sheet. And the topic 2 is dividend. So when the company wants to give dividend, you would read in law as to how exactly are the provisions relating to dividend. Here we're going to see the accounting side of it, but still the questions might seem like it's a law based question and not an accounts. What is the maximum permissible dividend amount that can be given is the accounting that they won't ask you to pass journal entry to pay dividend, but the questions will be as to how much dividend can be given, can this much dividend be given, from where can this dividend amount be given, and other things. And the last topic that can be questioned from the chapter of financial statements unit 1 is managerial remuneration. How much of managerial remuneration can be given is the, or they'll tell the amount and they ask us whether this amount is fine with law or not, or how to compute what is the maximum permissible managerial remuneration. So these are the 3 topics. Let's start with the first one, that is form and content of balance sheet. So we all know that part A or part 1 talks about balance sheet and part 2 talks about statement of profit. Unlike schedule 6, revised schedule 6 and schedule 6, the first part spoke about statement of profit or loss and the second part spoke about balance sheet. So whenever there is a question in the examination requiring you to prepare financial statements, both balance sheet and P&L, should always prepare balance sheet first and then P&L. You would say that, sir, without preparation of statement of profit or loss, I will be able to close reserves and surplus in balance sheet. I will be able to close the balance sheet. Presentation will be balance sheet first, P&L next. But preparation will be P&L first. After closure of P&L all by itself, we'll be able to close our balance sheet. So whenever there is a question on preparation of balance sheet, write your balance sheet format completely. Write your P&L format completely. Then go to prepare notes to accounts. You will first finish your notes to accounts, then finish your P&L, and then finally your balance sheet. And unlike your PU based examination, there is no need to write all the items. For example, in a specific question, there is no long term borrowing, there is no debentures in the question. Should you be writing this in the format? Not required. However, if you are not able to judge, let's say you need to finish this, it's a 15 marker question. You kept yourself a target of 20 minutes to finish the question on financial statements in the examination. You sit, read the question 2 times, check what items are there, what items are not there, and you are not very confident with regard to the aspect as to which whether that item is there or not. Then blindly write everything. If you think so, then blindly write everything. It's still fine. And note numbers can be changed. If long-term borrowings is not there, then note number 1 will be share capital. Note number 2 will be reserves and surplus. This you would have never seen in your life in any of the balance sheets that you've done. Very rarely you would see it in your practical life also. So 1 and 2 will go to this. If long-term borrowings are not there, your note number 3 will be deferred tax liability. And if deferred tax liability is there in the question, it would be a straightforward item again. You don't have to prepare notes to accounts for it. You will skip note number for this and then straight away write note number for long-term borrowings. Other long-term liability. Hope you got that. So I hope I shouldn't be wasting the time making people read the format of balance sheet. Should I? Should I? I'll quickly tell you certain disclosure requirements what you should keep in mind. Can we get started? So you know the format of balance sheet. You know that the trial balance will be given. From the trial balance, you will post the items to balance sheet. What we need to remember when we're preparing balance sheet is item wise. I'll go on telling the disclosure requirement. Starting with shareholders funds, share capital. Whenever shares are issued for a non-cash consideration, that might be in the process of amalgamation, or that might be in the process of bonus issue,
or that might be for any asset acquired and consideration given in non-cash format, that is by way of shares or debentures or preference shares being converted to equity shares during the year. If any of these things have happened during the year, after you disclose your paid up capital, it is your responsibility to write it in the notes to accounts that out of the above mentioned 10,000 shares, 2,000 shares were issued for non-cash consideration. That is by way of capitalization of reserves bonus issue, or by conversion of debentures to equity, or by conversion of preference shares to equity shares, or in exchange of plant and machinery which was acquired. So you should disclose it whenever shares are issued for non-cash consideration, or during there if any shares are bought back. Any shares are bought back. Again, you would have to mention that out of these many shares were bought back. And you should always disclose authorized capital called up, issued, subscribed separately. And in majority of the questions, if authorized capital is given, you would write it. If it's not given, still write authorized capital as heading. Don't write any amount. Draw 2 lines and then start the rest of it. If in case you write authorized capital, remember when you take the total for share capital, you don't include the authorized capital. Got it? And it is again a mandatory requirement that whenever reserves and surplus notes to account is prepared, every item that is coming into reserves, every item that is going out of reserves should be disclosed. Appropriation of reserves should be openly disclosed. Let's say during the year, there are some shares forfeited, out of that you made profit, and that is transferred to capital reserve. You should mention what was the balance of capital reserve at the beginning, how much of money is transferred to capital reserve during the year. Let us say security premium or capital redemption reserve is received during the security premium is received, or capital redemption reserve is created. You should tell how much was the opening balance, how much was created during the year. If in case any part of CRR, security premium or capital reserve or P&L balance is used for bonus issue, again you need to show that deduction from that in your notes to accounts. Guys get this? And usage of security premium, you know it is limited. It can't be used for everything and any purpose that you want. It is limited to the purposes mentioned under section 50. Close that window. One's washing clothes. I feel like syncing the words that I say to the beat in which they are talking, beating that. So money received against share warrants, so you'll never come across. Share application money received pending allotment. If only if it's mentioned in the question, we'll consider it as a part of our balance sheet. But majority of the times you would never. And long-term borrowings will always carry your debenture portion. Whenever there is anything other than debentures in long-term borrowings, any loan taken from statutory financial corporation or any NBFC or bank, there might be some adjustments in the question which would say that interest is accrued, interest is outstanding. Don't include interest with loan. Interest has to be disclosed as a separate item. I hope you remember that there are certain questions where in the adjustments they would say interest of so much is outstanding. This is because when you compute interest on the loan, it will not be compound interest, it will be simple interest. If in case by mistake you include the interest into the loan amount, next period when you compute the interest will be computed on the loan amount plus interest amount. That for that reason we need to disclose the interest separately and the loan separately. When you're dealing with liabilities, the point of doubt that you will get is whether to disclose a liability as a non-current liability or to disclose a liability as a current liability. Sometimes they'll very evidently tell you that it is debenture or it is a long-term loan taken, or sometimes they will just tell term loan taken. So whenever there is ambiguity, there is no clear-cut information whether a particular liability is long-term or short-term. That is left to your professional judgment at that point of time. Because in a realistic scenario, you'll talk to the client, get to know the information, and then write. In the examination, you can't question the examiner. So all you would have to do at that moment is take a brief step, write it as non-current liability, and then go on. If it is short-term, they would have to mention that it is short-term. So I would recommend you to take it as non-current unless they mention that it is current. Sir, would it be wrong if I take it as current? Not wrong at all. If you want for your comfort, this is not required. If you want for your comfort, at the end of the entire question and after you finish all the notes to accounts, to mention that loan from state financial corporation or short-term loan from this person, as they have not mentioned whether it is current or non-current, it is assumed to be not repayable within the period of 12 months and assumed to be non-current. Your balance sheet will still tally at the same amount. Sometimes it might so happen that ICA study material they have taken a specific item as non-current. A similar question, same name, what is available in RTP or MTP or suggested answer, they would have taken as current. So don't let that confuse you, because suggested answer what is given to you is not the suggested answer what is given to the person who will correct the paper. The person who's correcting the paper, there will be more than one correct answer given. Either of the correct answer, if it is written by you people, you will get full marks. So throughout whatever preparation you've done, believe it and trust it. Don't let last minute some suggested answer trick you people and then put your entire confidence low and question your preparation. So after that, deferred tax liability again, if it's only available in the question, we'll do write it. Other long-term liabilities and long-term provisions again. If it's there, we'll write. Otherwise, we don't. And if there is any liability which is from related party or which is from any subsidiary or holding, it should be disclosed separately as a separate line item. We can't mix them all together and then write. They just say loans, long-term loans, and they'll give 1 lakh rupees. In the adjustments, they do mention out of that loan from related party is 10,000. Loan from this particular cooperative society is this much. So if in case they give such specific detail, you would have to show that separately in your notes to accounts, and you can't write it all together. And MSME and non-MSME trade payables should be disclosed separately. Similarly, when you talk about trade receivables, outstanding for greater than 6 months, outstanding for lesser than 6 months has to be disclosed separately. And talking about non-current assets, property, plant and equipment, we need to disclose the original cost of the assets, accumulated depreciation till the date of which the financial statements are prepared, and the closing balance separately. Hope you got that part. And if there is any capital asset being in under construction, that has to be disclosed separately. And any items like preliminary expenses, miscellaneous expenditure, share issue expenses, or expenses are not considered to be intangible assets. I hope people are slightly aware of age 26, para 54, conditions and criteria to decide whether an item is intangible asset or no. So if there is any such accumulated losses, P&L account debit balance, preliminary expenses, share issue expenses, any of incorporation expenses, any of these, there is no place for those items in the balance sheet asset. They would have to be deducted completely from our reserves and surplus. What if reserves and surplus is insufficient? It's totally fine. Reserves and surplus is one item in the balance sheet which can appear in the negative form. So you can write reserves and surplus as minus 10 lakhs. Totally fine. But any of such incorporation expenses or preliminary expenses should be written off in the very first year of incorporation, irrespective of the fact whether there is profit or got it. From what do you deduct? Let's say there is preliminary expenses. From which amount do we deduct? There are some 3-4 reserves. Which reserve do you deduct from? Write all the reserves. No, there only you write this item also as minus and then show it. Don't have to specifically try and show which item has to be deducted. You have inner column, outer column. In the inner column, you'll write balances of all the reserves. Write this item as negative item, and then outer column will become negative. Yeah, don't try to take a call there and try to mess up your. And talking about inventory, you need to specifically disclose how much of inventory is in raw material form, how much in work in progress form, how much is in finished goods form, and how much is stores and the spares consumable. Talking about trade receivables, we did talk. Cash and cash equivalent. Cash and cash equivalent definition that is given under Schedule 3 as well as under Accounting Standard 3 are not same. They are very different. So don't try to merge them. Whatever is cash and cash equivalent as per AS3 is not this. They are different. Here it includes cash balance, bank balance, and everything else. When you write bank balance, if in case it is so mentioned in the question that any balance which is there in the bank is not in a nationalized bank. It is not in a nationalized bank. It is not in a bank which is, it is not in a scheduled bank as per RBI. You need to disclose it separately. You cannot write all the bank balances together. All the scheduled bank balances, all the unscheduled bank balances has to be shown separately. Then that's it. And we all know the P&L format. So P&L format, you will have revenue from operation, other income. And then expenses side will have cost of material consumed. And I would say purchase of stock in trade, changes in inventory. Changes in inventory is always opening minus closing, not closing minus. If you do opening minus closing, it becomes negative. It is totally fine. Write the amount as negative in the amount. Okay. This expense side is like the debit side. This is like the income side. So sales and income will come on the credit. Opening stock purchase will come on the debit. Closing stock will come on the credit side. So when we write changes in inventory, this is debit side. So closing stock is moved from the credit side to debit side. So when it is moved from credit to debit, that will become negative. So we would be writing this changes in inventory as opening minus closing. So this is one part where you might do a very silly mistake to make your entire profit go wrong, because of which your reserves and surplus is wrong and your balance sheet. That then employee benefit expenses is anything related to employees. Finance cost is all the interest based expenses. Depreciation and amortization expenses. If in case there is a question wherein you are supposed to do balance sheet as well as PL, for this specific item you won't prepare a separate note. You would have already prepared a note for tangible assets, and in that tangible assets, that accumulated depreciation is there. That accumulated depreciation, you'll write the opening accumulated depreciation, depreciation made during the year, closing accumulated depreciation. There, the depreciation for the year's total column, whatever exists, that same amount you will straight away post it here. So remember that you don't have to prepare a separate notes to accounts for depreciation column. This would be eaten away from there. And any other expenses which you don't know to put under any of these categories should be written in other expenses. One simple item that can be tested when it comes to other expenses. Tell me, where do you write director's salary, director's fees, or sitting fees, or managing director's salary? Would you write it in employee benefit expenses or would you write in other expenses? Director is acting like an employee of the organization if he is managing director. Otherwise, you should write it in other expenses. Sitting fees, other expenses. Managing director's remuneration or salary given. Managing director is an employee to the organization. Full-time director is an employee to the organization. If they just say director, other expenses. If they say just say director, it is other expenses. If they specifically mention managing director's salary, managing director's remuneration, you write it in employee benefit expenses. Getting it? If in case they say manager, there can be a manager now without being a director. He has equal powers as much as a managing director. In that case, where do you write? Manager is an employee. By employment agreement, he gets the post. So then you write it in employee benefit expenses. In this chapter, when the question comes, it's not based on computation. It's only based on presentation. Balance sheet tallying is very easily possible. If in case a specific item which is supposed to be shown in this category is shown under a different category, though your P&L is giving the same profit and your balance sheet is tallying, you will still lose 1 mark or 2 marks. So this chapter or this unit in this chapter is based on presentation. It is not based on computation. So when you're practicing problems on this chapter, don't solve problems. This is one chapter what I can very confidently tell. Look at the answer. Look at the answer. Try and place whether this item am I able to place it at the right place. Once you understand where to place the right item, you are done with this. So don't waste time practicing problems on this unit of the chapter the day before the exam or the week before. For this part, preparation of financial statement. Yeah, got it? Let's go to the next part. So do you want me to solve a problem on financial statements? I initially had a plan. Now if something has to be skipped, I thought I'll skip preparation of financial statements. I hope that's fine with you all. Let's go to the second topic that is there in this chapter. This is on dividend. So with regard to dividend, we will not be questioned on accounting how to write the journal entry for dividend. Previously, there used to be questions on grossing up the dividend and computing the part. But right now, the question will be whether it is legitimate and as per law or not. So section 2 subsection 35 talks us about dividend, and dividend says that definition says dividend includes interim dividend. So there are two types of dividend. One is the final dividend. The second one is the interim dividend. Final dividend is the dividend which is declared in the general meeting. There, the recommendation is made by the board, the approval and then declaration of dividend is done by the shareholders. However, interim dividend is authorized, declared, and completely decision is taken by the board of directors. This is happening between two AGMs, between two annual general meetings. So there are four items which are discussed in the annual general meeting, which are called as ordinary business. That is ADDA: accounts, directors, dividend, and audit. So other than this, anything else that is supposed to be discussed will become special business. These four will become ordinary business. So before this general meeting, there will be a board meeting where the financial statements will be adopted, accepted, audit report will be accepted, and board of directors will decide. In that particular meeting, they will propose or recommend dividend. This will be declared in the can be declared in the general meeting at the same rate or can be slightly decreased. You're getting this? We all know that the dividend is declared out of the profits of the organization. Whenever organization has profits, we give a part of it to the shareholders as dividend. But can a company give a profit which is not earned as dividend? Maybe because they've accrued the profit, the contract is due for any market condition to impress the investor, to ensure that the belief system in the market about the company in the shareholders' mind is not tampered. Can they still issue dividend? The answer is yes. It is allowed as per the provisions of that, but there are certain restrictions. I put little bit of parts what is there with regard to dividend part also in this version. I'll be sharing this sheet to you all later so that you can read the context what is required here. So section 123 tells how to give dividend. Dividend will be given only after paying depreciation. If you have not provided for depreciation expense, you can't provide dividend. And for say current year, previous year dividend has to be given, or it can be given out of the profits which is received as subsidiary from the government. If in case a company is a company which is taking up only government contracts and the money has to be released by the government at the specific completion of the project. So if the company has accrued profit but is not able to give dividend because the government has not given us enough money, in that case government will allow some special subsidy using which directors can be paid salary, using which shareholders can be paid dividend. One of the best examples is the case of ILFS, which used to take all the infrastructure development projects of the government. So there's a beautiful case law, what you can read after your exams are over. So you would understand the theoretical and very practical approach to this part. So using that, when the dividend has to be declared, it is fine when you have profit. The point comes to be where when the dividend, I will skip these parts. I would have discussed this in detail, but I'm rushing. I hope this speed is fine. It is fine. Let's quickly get into that part wherein we'll discuss how to declare dividend. Yeah, this is the important part. How to declare the dividend when there is no sufficient profits. So declaration of dividend is out of the profits, current year profits or previous year profits, or the profits received or the subsidies received by the government for that purpose. If in case there is inadequate profits, company can still declare dividend, but it has to comply with certain provisions given under section 125 and dividend declaration rules 2014. What does it? Okay, not 125. Dividend declaration rules 2014. What does it say? Four conditions. Condition number one: the rate of dividend cannot exceed the average of the last 3 years. The last 3 years, whatever dividend is given, you add all of them, divide by 3. Then whatever rate you get, that is the maximum. Let us say out of the last 3 years, dividend is given in only 2 years. Then what do? You take only those 2 years. Denominator will be 2, not 3. Denominator will be 2 and not 3. So that is how we compute the rate of dividend. This is and conditions. This is not or conditions. You have to comply with all the conditions. The second condition is, no matter what you do, even if that average rate is still high, still the amount of dividend that you give cannot exceed 1/10 of paid up capital plus free reserves. And for this purpose, when you say free reserves, it is only P&L account balance. It doesn't include security premium. It includes P&L and general reserve. And that concept of security premium inclusion, if in case you're getting confused, security premium is not free reserve. Security premium is considered as free reserve only and only for buyback. That we'll discuss in tomorrow's class in advanced accounting. So does security premium form part of free reserves? No. General understanding is free reserves is such profit which is available for distribution of dividend. And section 123 says no, dividend can be given out of current year profits or previous year profits. So you can take P&L account balance and general reserve, nothing other than that. If dividend equalization fund is there and it is not restricted to specific class, then such dividend equalization fund also is included in free reserves. But however, don't expect such high-fi questions in examination. That wouldn't. And the third condition is amount withdrawn for the purpose of dividend. No, that whatever that 1/10 we take no here from this. From that, first we should pay off the losses that is there in the current year. After that, what is left over only can be used. I'll show this to you with the help of numbers right after I finish this concept. I'll repeat once again. When we do 1/10 of paid up capital plus free reserves, we get no 1/10 of the funds that can be used for dividend issue. You can't straight away issue it as dividend. From that, first you should make good the current year losses. After you make good the current year losses, what is left only can be. And the last condition is after you pay dividend, your reserves will decrease because you're paying it out of the accumulated profits. When you pay dividend out of the accumulated profits, after payment of dividend, such a decreased reserves should be minimum 15% of the paid up capital. Be minimum how much? 15% of the paid up capital. And when you say paid up capital and all of this, we are not considering shares application received pending allotment, money received against share warrants, all that is not considered. Only number one, share capital, paid up capital will be considered. What about call scenarios? Paid up capital is after deduction of called scenario. No, called up minus call scenarios is paid up capital. What about calls in advance? Will it be included? No, that will also be not included. The reason very simple. Calls in advance is not part of it. We have not called. They paid before we called. That's the reason it's called calls in advance. On that calls in advance, we won't give dividend. On calls in advance, we give only interest. Get this? Paid up capital doesn't include calls in advance. And does it include calls in arrears? No. From called up, after we deduct calls in arrears, only we get paid up capital. This is very much foundation topic, but can affect you a little here. Such questions are again very, very rare, but can come that adjustment. I hope you understood that. At any point you don't understand or I don't make sense of what I tell, you can easily ask me and ask me to repeat and I'll surely do it. Shall we quickly see illustration number 21 from our material? How many of you are not from Yashas Academy? You don't have the material. How many? How many? You don't have to worry at all. I'll show the question here on the board. You can just look at the board and then you'll see the question. I'll see the question. I'll show you the question on the board. I'll underline it and then show. And rest of you are lazy also. You don't have to worry. You don't have to. How many of you didn't get? Few of you didn't get your book, or few of you don't want to open your book also. You can sit back, relax, and then stare at the board, and I'll show it to you here. If you can help me, just tell me the page number. That will be very helpful. 21st question. It's around 50th page. 55. I'm almost there. Yes, there we are. Can you all see the board? Can I start with question number 21? So they've given some information wherein X Limited provides you that equity share capital is 100 lakhs, free reserves is 20 lakh, loss during the year is 1 lakh. So current year they have not made profit to give dividend. So can they still give dividend? Yes. But they would have to comply with the issue of dividend rules 2014. So they've given the rates of dividend in the previous years. Rates of dividend for the past 8 years is given. So you take the recent 3. You take the recent 3 years. Management recommends a dividend of 8%. So in this question, they've told us 8%, and they're asking us whether 8% is okay or not okay. Sometimes what happens, they won't tell this 8%. They will ask us how much is the maximum permissible dividend rate. So either of the questions, our approach is same. If in case they tell a specific percentage, after we do every condition, we should check whether 8% amount, is it within limits, not within limits. We should be comparing. If in case they don't give 8%, it is very nice. Under each of the conditions, you compute the rate of dividend and then take whichever is less. That is the maximum permissible dividend that they can. Are you getting it? If in case they specifically mention a rate, compare each of the conditional dividend with that rate of amount that they have mentioned. If it fulfills all the conditions, yes. If it doesn't fulfill, then no. If in case though they don't mention the rate, under each of the conditions you compute the maximum permissible dividend rate, and out of all the conditions, whichever is less is the rate of dividend that we should be issuing. Got this? You should still continue to do other conditions. Yeah. It is, there is no precedence of one over the other. Even if one condition doesn't satisfy, you cannot do. But they'll give you 4 marks. So you'd have to do other conditions also. And this is not, there's no specific rule that first condition will be satisfied only, then we'll go to second. Just 4 conditions. We'll check all 4. And we'll mention the reason why we do 2, 3, 4 is, let us say first condition is not satisfied. Let's say the 4th condition is also not satisfied. And the limit under 4th one is much lesser than first one. So you would have to mention what is the maximum permissible dividend rate. For that, we'll do all that. So let's start. The first condition is rate of dividend cannot exceed average of the last 3 years. So what is the average of last 3 years? 9, 10, 11. So 9 plus 10 plus 11 divided by 3. You would have to little bit of, you would have to write few sentences also. You cannot straight away start your answer, please 9 plus 10 plus 11 divided by 3 is equal to 10, tick mark. And then second condition. You would have to write condition number 1, dividend rate not to exceed average of last 3 years. You would have to write that statement. And then take last 3 years dividend. And then say average dividend of the last 3 years is 10%. What are they proposing? 8%. Is it within the limit? Yes, it is within the limit. First condition is satisfied. Shall we see the second condition? What is second condition? Amount to be utilized for the purpose of dividend should be 1/10 of paid up capital plus free reserves. So how much is paid up capital in this case? 100 lakhs. And free reserves is 20 lakhs. When we take 100 plus 20 and then do 1/10 of it, we'll get 12 lakh. From that 12 lakh, we have to deduct that current year loss of 1 lakh before we go ahead. Don't do 100 plus 20 minus 119 into 10%, 19. Your answer will be incorrect if you do that. See, distributable dividend now is 11. If you do 100 lakh of paid up capital plus 20 lakh of free reserves minus 1 lakh, you will get 119, then you will do 10% of it. No, that wouldn't work. You would have to take the previous year's reserves, excluding the current year loss. You would have to take the accumulated profits. On that, you take 1/10. I'm going to say paid up capital plus free reserves into 1/10. Whatever you get, from that you deduct the current year loss, whatever is there. After that, what is remaining on that, no, first you do 1/10 and then you deduct the previous year loss. That is the distributable profit. And based on that, you can compute the rate of dividend that you can. There are 2 ways now. Once you compute this 11 lakh to be the distributable dividend, either you can deduct this 11 lakh by paid up capital of 100 lakh. You will get the percentage. What is 11 lakh divided by 100 lakh? Into 100 also you should do 11%. But dividend rate that they're recommending is 8%. It is fine. This is one way. Other way is you already have 11 lakh no here. They have told 8%. Do 8% of 100 lakh and compare it with 8 lakh.
Are you getting it? So here distributable dividend, you have it in amount. You compute the amount that they're proposing, 8 lakh. See, is it within limit? Or you convert this distributable dividend 11 lakh. If you want to distribute 11 lakh for 100 lakhs of paid up capital, what percentage will it become? 11%. So 11% is the maximum distributable dividend. 8% is what they're proposing. It is within limit. So compare percentage with percentage or amount with amount to whatever is comfortable to you. There is no specific guideline. You would have to do like this one. But do a pre-decision as to what will you do. Okay? Then we want my recommendation. ಏನ್ ಬೇಕಾದ್ರೂ ಮಾಡಿ ನಿಮ್ಮ ಇಷ್ಟ ಬಟ್ ಮಾಡಿ ಅಷ್ಟೇ ಓಕೆ then the third question is amount withdrawn should be first utilized to write off the current loss. That's what we did. And then the last condition is balance in reserves after such withdrawal should be minimum 15%. Now let's say we are distributing 8%. How much is 8% of 100 lakh? 8 lakh. When you distribute 8 lakh out of the free reserves, when you distribute 8 lakh out of the free reserves is how much? 20 lakh. From 20 lakh, current year loss will be minus 1. It will become 19. If in case you issue 8% of 100 lakh, that is 8 lakh. So 20 minus 1 minus 8. What will we be left with as balance? 11 lakh. So 11 lakh is the balance. Is it 15%? Minimum 15% of paid up capital. It is not. Paid up capital is 100 lakh. On 100, when you compute 15%, it comes to 15 lakh. But what will be available is 11 lakh. So it doesn't satisfy condition number 3. Can we issue 8% dividend? They have not asked in this question what is the maximum permissible limit. They've just told very generally comment upon the management decision. So they are not asking you what is the recommended percentage. Your answer will stop at the point telling where 8% is not possible. But sometimes they expect you to tell what is the maximum permissible dividend. So then you should continue. What is the maximum permissible? So according to first one, there is huge limit, no problem. Second condition, no problem. Third condition, out of 20 lakhs, how much should be still there? 15 lakh. How much is accumulated loss? 1 lakh. So 20 minus 1. How much is it? 19. In 19, 15 should be there after you give dividend. In 19, if 15 should be there, how much can you give? 4 lakh. 4 lakh out of 100 lakh is 4%. So maximum permissible dividend rate is 4%. We have to write such recommendation. Are you getting this? How do we find maximum permissible dividend? Free reserve 20 to be maintained 15. So what do we get? 5 lakh. In that current year loss of 1 lakh, if I deduct, we get 4 lakh. 4 lakh divided by 100 lakh is maximum permissible limit is. I hope this is clear with you all. If in case you want, you take this loss here only. Free reserves less free reserve to be maintained less loss, and straight away take 4 lakh and divide by 100 lakhs. There is it. Okay. Or no? I don't have enough time to solve the question from the detail and then write. So I am running you through the answer. Let's now quickly revise the topic of buyback of securities. Buyback of securities is opposite of issue of shares. In the event of issue of shares, shareholders give money and company will give the share, following the blue line. Buyback is opposite. Shareholder will give the share back to the company and company will give the money. Why does a company go for buyback? Very simple. To increase its earnings per share, because the numerator being earnings available to equity shareholders, denominator being number of shares, we compute earnings per share. In order to compute earnings per share, either you would have to increase the numerator or decrease the denominator. By decreasing the denominator, by buying back the number of shares outstanding in the market will be less. By this, the earnings per share available will become more. And to avoid the hostile takeover where someone is acquiring the shares of your company to take over control of your company. Or in order to increase the promoter holding to take a major decision where the directors want to take the decision but shareholders are not in the favor of it. In such a case where the shareholders might not vote for such decision, promoters want to increase their holding and then go for buyback of share. And if in case the company's share price is dipping way below where it should be, and if company believes the true value of the share is much higher than that, company will support the price of the share by offering buyback. And as we've discussed in the past, buyback price per share will be much higher than the market price prevailing in the market on that date. And lastly, if in case the company has no option or no better strategy or no better project to invest the money in, it will let the shareholders realize their gain by whoever wants to sell the share. Let them give it back to the company and company will offer them a price. That is to liquidate their shareholding that they have in the company. And this is regulated by provisions of Companies Act. The base to provisions of buyback is section 67.
It says that shares cannot be bought back by company. However, it is allowed under three provisions. Section 55, which talks about redemption of preference shares, is now shifted to foundation, and reduction of capital, which turn in internal reconstruction. And what we're discussing in this chapter is buyback of shares. So buyback of shares is actually not allowed as per section 67. However, if a company wants to buy back shares, it has to follow the rules given under section 68 of Companies Act 2013. Section 68 of Companies Act 2013 says that BB is allowed, but in order to do BB, there should be one approval. We'll discuss the provisions first and then come back to that. So the provision goes like this. If in case a company has to go for buyback of shares, there should be authorization in the articles of association. Only then it has to go for buyback. If there is no authorization in the articles of association, company would have to pass a special resolution to amend its articles of association. Then it will go for buyback. And though there is power in articles of association, in order to do buyback, in order to execute buyback, it has to pass a resolution. Is that resolution board or special resolution? Depends upon the percentage of buyback. If the company is buying back 10% or less percentage of shares, then the company can just do it by passing board resolution in the board meeting. However, if the company is buying back more than 10% up to 25% of shares, then it needs a special resolution in the general meeting of the company. However, if the company intends to buy back more than 25% of the shares, it has to override Companies Act, which is illegal, which is not possible. So basically, a company cannot buy back shares beyond 25%. In order to buy back a share, the share should be fully paid up. A partly paid up share cannot be bought back. Then, doesn't look. In order to buy back a share, company share should be fully paid up. And in order to go for buyback, company has to fulfill certain conditions. These conditions are called as DRS test, debt equity ratio test, resource test, and share outstanding test. Debt equity ratio test says that the maximum amount that the company can buy back is to ensure that the debt equity ratio does not become bad than 2:1. After the buyback, equity will reduce. Such reduced equity, if you do into 2, so much of debt should be there and you cannot have debt more than that. So debt has to be maximum 2 times equity after buyback, or equity has to be minimum half of the debt after buyback. This is the first condition. Debt equity ratio test cannot be more bad than 2:1. Debt cannot be more than 2 times equity after buyback. Second test is resource test. It says that maximum amount of money what we can use for buyback cannot exceed 25% of PUC plus free reserves plus security premium. The Companies Act only says free reserves, but whenever they say free reserves in buyback context, will include security premium also in the context of equity. Then the last test is share outstanding test. Share outstanding test says that the maximum number of shares that can be bought back is number of shares outstanding multiplied by 25. You can't exceed this. And this entire buyback has to be completed within a period of 1 year. So this is how we'll remember the entire thing. So whenever the company wants to do buyback, the sources of funds can come from only three places. SPF, security premium account, proceeds from fresh issue or free reserves. Compiling that together, this is the chart. So BB, in order to happen, you need to apply sunscreen, which is SPF. So SPF, sources of funds, security premium, proceeds of fresh issue, and free reserves. Cannot take from other than this place. And in order to get married, they ensure that there is no child marriage. The share should be fully paid up. Then it should take approval. If the age gap between the bride and the groom is less than 10, close family people say yes, sufficient. Board resolution is sufficient. If the age gap is more than 10 years, oh my God, what will four people tell? Everyone should accept. Everyone should be eagerly waiting for that wedding. Only then it's allowed. So it will take special resolution if the percentage of buyback is more than 10. If it is more than 25 years of age gap, no. It will become a public nuisance. Don't get married. So more than 25% share buyback is not allowed. And whenever you are taking such a big decision, no, review the decision like MS Dhoni does. DRS, debt equity ratio test, resource test, share outstanding test. Debt can be maximum 2 times equity after buyback. Resources used for buyback, security premium, paid up capital plus free reserves plus security premium cannot exceed 25%. And share outstanding, number of shares bought back cannot exceed 25%. How to do this test is a very tricky part. There are questions in ICS study material where they will tell how many shares we should buy back. And then those many shares will write simple journal entry. Writing journal entries is very simple. Share capital is decreasing. Same thing if you want to read it in the form of section, I've given it here in the chart. You can read it later. So I'll come back to CRR also slightly. We'll finish this journal entry part. Yeah. Whenever you're buying back the share Share capital is decreasing, so we'll debit share capital. And cash has to be decreased, so cash will be created. Journal entry is share capital debit to cash. However, we'll route it through a dummy account called as shares bought back account. My journal entry will be equity share capital account debit to bank, which will be routed through dummy account called shares bought back, which is credited here, which is later debited. So journal entries will become equity share capital to shares bought back to bank. If in case we pay slightly more than nominal value, that amount is debited to premium on buyback. This will be adjusted against security premium if available. If security premium is exhausted and we paid much more than that as premium, we can adjust that against free reserves, general reserve and P&L account also. So we write the journal entry equity share capital account debit, premium on buyback account debit to shares bought back account debit to bank or cash account. Then premium on buyback, whatever was debited, will be adjusted against security premium first, then with free reserves. So the entry is security premium account debit, free reserves account debit to premium on buyback account. Ultimately, after you do this, still section 67 should be there haunting you that capital of a company cannot reduce. The only and only way by which the capital of a company can reduce is by way of capital reduction, which is approved under the scheme of court. That is only capital reduction, internal reconstruction. Other than by that way, capital cannot reduce. When you do buyback, share capital account here is debited, because of which our capital is reducing, which cannot happen. So what do we do? To the extent of which our share capital is reducing, we create capital reduction reserve. What is capital reduction reserve and why do we create it? This is to comply with provisions of section 69 subsection 1 of Companies Act 2013. Section 69 subsection 1 of Companies Act 2013 says that capital cannot reduce other than by way of capital reduction, approved under the scheme of the court under internal reconstruction, by way of redemption of preference shares or by way of buyback of equity shares, what we're discussing in this case, if the share capital reduces. To the extent of nominal value of share capital reducing by way of buyback or redemption, we create CRR. From where do we create CRR? Taking the money from free reserves. Free reserves are general reserve and P&L account. We debit general reserve, we debit P&L account and credit CRR. To the extent of nominal value of preference shares redeemed or equity shares bought back. What can we use this CRR for? CRR can be used only and only for the purpose of bonus issue. When we do bonus issue, as you already know, the share capital will increase back to the same. Now, this question might come in your mind. Sir, should we create CRR in all the cases when we're doing buyback? Answer is no. You don't have to create CRR when you are buying back equity shares, and in order to source the finance, you are not taking the money from free reserves, but you're taking the money from fresh issue. That fresh issue cannot be equity shares. It has to be a different class of shares, like preference shares. Let's say you are buying back equity shares, and in order to buy back equity shares, you issued preference shares. 1 lakh of equity shares is bought back. 1 lakh of preference shares is issued. So 1 lakh preference share capital, equity share capital decrease, 1 lakh preference share capital increase. On the whole, share capital is not decreasing. In this case, you don't have to create CR. However, let's say your equity share capital bought back is 1 lakh. For this purpose, you are issuing preference shares only to the extent of 20,000. So equity share capital decrease 1 lakh, preference share capital increase 20. There is still decrease of 80,000 in capital. So you would have to issue shares to the extent of 80,000. So how do we remember this in the exam? Very simple. Write the journal entries for buyback. Write the journal entries for issue of shares. Write the journal entries for sale of investments or whatever. After rating everything, before you identify CRR, see the journal entries. Wherever you return capital credit, that means capital is increasing. Wherever you return capital debit, that is capital is increasing. Take the net difference. To the extent capital has decreased, you create CRR. If equity share capital is debited by 1 lakh and preference share capital is credited by 20, that means equity share capital is decreasing by 1 lakh and preference share capital is increasing by 20. Net difference is 80. 80,000 you take it from general reserve and P&L account and then create CRR. I'll get back to what I was telling. The questions are very simple and easy. If they tell how many shares are to be bought back, we'll write it this very simple way. For that amount, we pass the journal entry. Questions become interesting where they won't tell how many shares to buy back. They will ask us find out as to how many shares should we buy back. They'll tell we want to do maximum buyback possible. Please help us with this and tell us how much is the maximum buyback that we can do. If in case they offer us buyback and they don't tell how many shares can we buy back,
In this case, ICA study material answers are a little complicated. They take X, they take Y, they solve simultaneous linear equation. Oh my God, it becomes way too complicated. Simplified way of this is, I told you this, after buyback, equity will decrease. The decreased equity should be minimum half of debt. Or after the decrease in equity, debt cannot exceed 2 times. So 2:1 is the ratio. Am I right? So do it the very simple way. What is the maximum possible shares that we can buy back? Equity is PUC plus free reserves plus security premium. PUC plus free reserves plus security premium. In excess of 50% of debt can be bought back. In excess of 50% of debt can be bought back. So PUC plus free reserves plus security premium minus 50% of debt. Divide this by nominal value plus buyback price. Nominal value plus buyback price, because in buyback price there is nominal value and security premium. Nominal value and security premium in buyback price. Nominal value will decrease share capital, security premium will decrease security premium. Buyback premium will reduce security premium. Why do we add nominal value again to denominator? Because to the extent of shares bought back, we'll create CRR. When we create CRR, free reserves will decrease, CRR will get created. That CRR which is newly created is not part of equity. Equity is PUC plus free reserve plus security premium. There is no place for CRR in this. So what do we do? Very simple. In order to find maximum permissible buyback complying debt equity condition, do PUC plus free reserves plus security premium minus 50% of debt divided by buyback price plus nominal value per share, you will get the maximum possible number of shares. No X, no Y, no simultaneous linear equation. I've explained the logic. If you want, you listen to it again. If you don't understand the logic, vomit this formula, you will get the answer right. It will save a lot of time. I bet it will save a lot of time. Trust me on this. Second one, resource test. Resource test is very simple. Take paid up capital, free reserve, and security premium. Add all three. Multiply it by 25%. If you multiply by 25%, whatever you get, that is the maximum resource which can be utilized. If you divide that by buyback price per share, you will get the maximum number of shares that can be bought back. I'll repeat, you will take paid up capital plus free reserves plus security premium, multiply that by 25%. That is the maximum resource that can be utilized for buyback. You divide that by buyback price per share, will get the maximum number of shares that can be bought back. Last and final test, share outstanding test. Easiest of all. Number of shares which are there multiplied by 25%, you will get maximum shares that you can buy back. Take whichever is least among these three and that is allowed for buyback. Don't forget to check the cash available. Even though all the three tests will allow you to buy back certain number of shares, check whether do you have sufficient cash to do this buyback. And that will help us identify the number of shares that can be bought back, which is an examiner's favorite question of late. And by this, we've completed the entire discussion of buyback. I hope it was helpful. I hope you people understood what's the buyback. Cool. So how cool a chapter is this? This is not just a chapter. It is much more than just a chapter. The reason being, a lot of us know post qualification we do specialization. People do specialization, and when you do specialization, people who are doing articleship already know. Specialization can be in audit. Specialization can be in taxation. In audit also, people do a little bit of specialization. But in the modern times, the specialization has come down to another wing called as M&A, mergers and acquisition. Previously, people post qualification used to take up the specialization field, but in the last 2 3 years, the developments are so big that students at articleship level are getting an opportunity to work completely in M&A, mergers and acquisition. They do 3 years of articleship exclusively in M&A. It's going to be not just a chapter, but a very big career opportunity or an entire wing what you can dedicate your entire career into. Let's quickly get started with M&A. Oh, sorry, amalgamation of companies. What you are learning here as per accounting standard 14. But when you come down to CA final, you will learn this as per Ind AS. There we call it combinations. And here when they say amalgamation, though the name of the chapter is just amalgamation, this will include acquisition, merger, and external reconstruction, all the three topics together. And in final, when you call it combination, it will include everything. Mergers includes mergers, acquisition, external reconstruction, including small changes like your internal reconstruction is also part of the chapter combination. So this is the weightage of the chapter. 20 marks
have come from this chapter before. 15 marks is also very usually expected. There are situations where they've given two questions, one of 10 marks and the other of 5 marks also from this very chapter. And getting started, what to expect from the chapter? You can expect few theory questions based on difference between amalgamation and merger and amalgamation. There are two types of amalgamation, in the nature of purchase and merger. That difference they can ask, or they can also ask you difference between amalgamation, absorption, and reconstruction. Different types of amalgamation, like I just mentioned, or computation of PC questions can come under multiple methods: NATO, net assets taken over method, or lump sum method, or under intrinsic value method. Only PC computation, that will be for 5 marks. Or they can ask you to prepare accounting entries. Accounting entries can be in the books of transferor or can be in the books of transferring. Probability of ledger accounts is slightly less. More usual and more often is about journal, but ledger questions can come. And if they ask a 20 marker, they can ask you to prepare balance sheet post amalgamation in the books of transferring. Or sometimes for a 15 marker question, they'll ask you not to do accounting in the books of transfer. They can ask you to do accounting only in the books of transfer and balance sheet of transfer after amalgamation. So these are the variety of questions that can come from it. And quickly jumping into the topic of amalgamation, the definition is given as per accounting standard 14. And it says that amalgamation is amalgamation as we discussed under Companies Act 2013. The term amalgamation is not defined under Companies Act 1956, Companies Act 2013, or Income Tax Act 1961. Sorry, all the three defines it. There is not, merger is not defined, but generally what we basically mean is that it's combination of two or more entities decided to come together to take advantages of certain trade advantage, like conglomerate merger, different product, or backward merger. You merge with the producer or you merge with the person who buys the goods, take an advantage in the market. So with regard to this topic, amalgamation, absorption, and external reconstruction are slightly different, but we'll learn accounting for all three. When we use the word amalgamation, the best example can be Idea and Vodafone. Idea and Vodafone coming together. So in amalgamation, more than one company will be liquidated, and another new company will be. So absorption is where one company acquires another company. So one company will continue its existence. Only one of the company is liquidated, and the company which is continuing will acquire that company which just got liquidated. So the example can be Vodafone and Hutchinson SR, Vodafone acquiring Hutch, or Flipkart, Myntra, Jabong. Flipkart acquired Myntra and Jabong, and Flipkart was acquired by Walmart. The brand name still continues. So, or external reconstruction is where one company is liquidated with an intention of incorporating another company. So basically, there is the same company is acquiring the same company, but they just change the name of the company. Like they create one new company. The objective of the new company is to acquire that old company, what is going to be now. So that's what we call as external reconstruction. External reconstruction is very much similar to your internal reconstruction. Internal reconstruction, what do we do? The name of the company remains same. Within the financial statements, you do all the changes. Within the same body, the organs are replaced. Same old vintage car. Inside, you overhaul the entire car, change the seats, change the engine, change the tire, change the tube, almost redo everything except chassis. That is internal reconstruction. External reconstruction, what we do? We buy a new chassis, keep the old engine, old chair, or say old seat, old steering, everything. So all the assets and liabilities will be transferred to a new company, which is now created. That's our external reconstruction. Example is UTI Bank getting converted into Axis Bank. And like I just mentioned, what is meaning of amalgamation? Two or more companies are wound up and new companies formed to take over this. In the event of absorption, an existing company takes over the business of one or more companies which are going to be liquidated now. And in external reconstruction, one new company is formed, takes over the business of another existing company. And what are the companies involved? In the event of amalgamation, minimum two companies are involved, or minimum three companies are involved, because two are getting amalgamated to form one new company. Vodafone was there, Idea was there, then we had something called V, another new company. In the event of absorption, two companies are sufficient. One company will continue to be there, that will acquire the company which is getting liquidated. And in the event of external reconstruction, again, two companies are involved. One is getting liquidated and one is getting created. And liquidation. In the event of amalgamation, how many liquidations will be there? Minimum two. Minimum two, no? Both will get liquidated to form a new one. And in the case of absorption, minimum one liquidation. If one company is acquiring the other, one company is liquidating because the other company is acquiring it. In the event of external reconstruction, again, how many liquidations will be there? Only one liquidation. And incorporation. The event of amalgamation, is there any incorporation of a new company? Yes, one new company is incorporated. In the event of absorption, there is no incorporation. In the event of external reconstruction also, there is one company being newly incorporated. Objective in the event of amalgamation and absorption is take advantage of large scale production and avoid competition. So a lot of times when you want to go for merger, you need to take approval from Competition Commission of India also. And in the event of external reconstruction, it is to reorganize the financial structure of the company. This external reconstruction is not same as your internal reconstruction, but only thing is within the same balance sheet you make changes. Here we don't make changes within the same balance sheet. So that changed balances will come in the new balance sheet. But is the in the company which is newly incorporated. That's our external. So I hope you are able to place small differences between absorption, amalgamation, and external reconstruction. Yes. Going further ahead, the parties to the process of amalgamation, absorption, and external reconstruction are two. One is transferor company, other one is transferee company. Transferor company is the company which is transferring all of its assets and liabilities to other company. This transferor company is what we call as small company. And transferee company, the company which is acquiring the business, acquiring the assets of such small company. The big company is called as transferee company. You can write it small. I've written it in caps so that you understand the differentiation between the other. The one who's receiving, is calling the assets and liabilities will have the word EE in their name. So I hope you are able to differentiate between transferor. Under accounting standard 14, we learn how to account in the books of transferee company only. Accounting standard 14 doesn't tell us how to do accounting in the books of transferor. Whatever accounting we learn, whatever accounting we do under transferor companies, that is under our liquidation approach or dissolution approach, is all based on generally accepted accounting. It is not based on accounting standard. So accounting standard 14 talks about accounting for amalgamation. It tells us how to deal with amalgamation, absorption, as well as external reconstruction in the process in the books of transferee company only. Transferor company, what do we follow? Generally accepted accounting. For this purpose, AS 14 classifies amalgamations into two categories. To help us do accounting in the books of transferee company, all the amalgamations are classified into how many categories? Two. One, amalgamation in the nature of purchase. Second one, amalgamation in the nature of merger. So based on the practical scenario, we call it merger, acquisition, and absorption, external reconstruction. And for the purpose of accounting, as per AS 14, how many types of amalgamations do we have? Only two. One is merger, other one is purchase. Now, how do we call whether a particular process of amalgamation is merger or whether a particular process of amalgamation is purchase? This depends upon the compliance to the conditions given under accounting standard. So these are the two processes of amalgamation. Why do we have to classify an amalgamation into merger or purchase? Because accounting what is prescribed for merger is much different from the accounting that is prescribed for purchase. So we have two different types of accounting. So in order to accommodate ourselves and then apply both, we need to segregate it into. Yes. Yeah. Going further. So classification is based on compliance of 5 conditions which are given under accounting standard 14. So what are these 5 conditions? So first one, if all the 5 conditions that is just given, which we'll discuss after this, if all of these 5, not or, and all of these 5 are satisfied, then it will become amalgamation in the nature of merger. Even if one out of these 5 conditions, even one out of these 5 conditions, if it is not satisfied, we'll call it amalgamation in the nature of purchase. And if it is amalgamation in the nature of merger, the accounting method that is followed is called as pooling of interest. What is the accounting method that we follow? Very good. Now we'll see what are those 5 conditions. The conditions are given as per para 3E of accounting standard 14. Condition number 1 says that all the assets and liabilities of transferor company should be taken over by transferee company. The word says all. There is no discrimination. This asset won't be taken, that asset won't be taken. All the assets and liabilities of the transferor company should be taken over by transferee company. And the next condition is minimum 90% of the shareholders of the transferor company should continue as shareholders of transferee company. How is this possible? This is possible because you need to give them the purchase consideration in the form of shares only. You cannot give them cash. These two conditions comes up because people use amalgamation as an eye-washing technique to transfer assets. If in case you transfer a specific asset to me, it might attract a lot of tax loss, long-term capital gain and everything. So what you do is you create the company and you transfer that asset to company and you transfer the shares of that company to. And whenever I want to sell that asset, I won't sell the asset. I'll sell the shares of that company. And in that company's balance sheet, I'll keep the asset at its book value only. So if in case this eye washing is basically done, it can evade a lot of tax laws. And such a transfer itself is regulated by Competition Commission. And they also say that here the intention to transfer should not be the intention to transfer a specific asset, but it should be intention to transfer the business. So to call it amalgamation in the nature of merger, you need to transfer all the assets and liabilities that is there, and the existing company shareholders should continue to be the shareholders in the new company. If the old company shareholders and new company shareholders are not same, then it is actually not sale of, it is not what to say merger, it is purchase. One set of people purchase another business. Very good. So then the third condition says that here when we say 90%, no, the shares of transferor company held by transferee company or subsidiaries is not included in 90. So before this merger process starts, either by way of subsidiary, one level subsidiary or two level subsidiaries, if you already hold some shares in transferor company, post amalgamation to compute this 90%, you cannot count that shares that you hold through subsidiary. Other than through subsidiary, whatever you hold, no, only that's count. And then the next third condition is consideration what should be given to the shareholders of transferor company to equity shareholders should be executed or released by way of equity shares in transferee company. I am transferee company. I am acquiring another business called transferor company. When I give the shareholders of that company purchase consideration, I should give it in the form of equity shares of this transferee company. How much? Entirely, except for the part of fractional shares. What is this fractional shares? Let us say the ratio is 2 shares in the new company for every 3 shares held in the transferor company. And there's a specific shareholder who has 5 shares. If he has 6, I can give 4 shares. If he has 3 shares, I will give him 2 shares. He has 5, sir, 3.5 shares. I can't give 2.5, 3. It's already a share. It cannot be further shared. So to that whole number, I give shares. To that fractional part, proportionately I'll give. So that fractional part is ignored. Other than that, consideration to shareholders of transferor company should be settled by way of equity shares in transferee company only. There should be no cash given. This is the third condition. And the fourth condition says that business of the transferor company what I acquire, I should continue such business. Should be an intention to continue such business. I should not acquire that company with an intention of looking forward for their accumulated losses to write off against my year. Usually that is also an intention. We think we buy a company to have an advantage of large scale production, to have access to raw material, to have access to front customer, or to have access to higher markets. That might not be the case. Certain scenarios, this can be a company which has huge accumulated losses, huge P&L account debit balance, that the company is able to go for winding up. If they go for winding up and they sell all of their assets, they might not even get enough money to settle their liabilities. Let's say there is a company which has 200 crores deficit, 200 crores loss, P&L account debit balance. So if they go for liquidation, the realization from their assets will not be sufficient to pay off their liabilities. Let's say I am a company which has 1000 crores profit, just 1000 crores profit. I will say I'll acquire their company. They would say that their company is worth negative money. If you want to acquire their company, you don't have to pay them any money. But I'm willing to pay 50 crores to acquire their company. They'd be more than happy. I'd pay 50 crores, acquire their company. You might be wondering, why would I want to acquire a company for 50 crores whose net worth is negative? I don't want their assets, I don't want their liabilities. When I acquire it for 50 crores, their losses will become mine. So they have 200 crores loss. 200 crores loss adjust against my 1000 crores profit. How much? I would say 30% plus surcharge on the 200 crores by paying only 50 crores. So that should not be the intention. To call it amalgamation in the nature of merger, I should continue their business. If it is amalgamation in the nature of merger, their losses are my losses. I can take over and adjust against mine. If it is amalgamation in the nature of purchase, their losses are not my losses. I will only take over their assets and liabilities, not their accumulated losses. I cannot adjust. There is no condition for me to continue there. So if I want to adjust their losses, I should continue their business. Because only and only if I continue their business, if I take over all their assets, if I take over all their liabilities, if their shareholders continue to be shareholders in my company to the extent of 90%, I give PSU to them only in the form of equity shareholders. Then it will become amalgamation of giving me rights to acquire and then take all this. So the fourth condition is that the business of the transferor company should be continued by transferee company. And the last condition is assets and liabilities of the transferor company should be incorporated in the books of the transferee company at book value. At book value. Let's say there is a specific land which is bought by the transferor company for 1 lakh 10 years ago. As on the present date, its value is 1 crore. But no, when I acquire, I should acquire it at 1. I should incorporate it in my books of accounts also at the same book value. If the transferee company has done revaluation before amalgamation, then no problem. That revalued figure will be their book value. But when I acquire, I should acquire all the assets and liabilities at their book value, including reserves and surplus. And I should incorporate them in my books of accounts. At what value? This is when we call it amalgamation nature of merger. If we don't continue their business, or if 90% shareholders don't continue, or we don't give PC only in the form of equity shares, or any other condition, if it is not satisfied, one asset you didn't take over, cash you didn't take over, or one specific asset you didn't take over, or one specific liability you ask them to settle it by themselves. If in case you do that, then it will become amalgamation in the nature of purchase. You get this? However, here I told no, all the assets and liabilities should be incorporated in the books at their book value. There is one small exception. If the accounting policies followed by transferor and transferee are not same, they are different. Let's say I follow a specific method, like I follow first in first out method for valuing inventory. My subsidiary, that transferor company, follows weighted average method. And when I put both the stocks together, there should be unified accounting policy. So I recompute the value of inventory of transferor company under the method that I follow. I change their weighted average method to first in first out method, change their inventory and then include. That will not be considered as change in book value. It's no more merger, it is purchase. That won't be. So changes in the value of the assets and liabilities of transferor companies allowed if it is to bring in uniformity in accounting policies. This. So if all the 5 conditions are satisfied, merger. Even if 1 out of 5 is not satisfied, it is very good. According to accounting standard 14, in the event of merger, transferee company should follow pooling of interest. What is the method called? However, if it is amalgamation in the nature of purchase, we need to follow purchase method. What do we call it? Got it. And accounting in the books of transferor company, nothing is told. AS14 says, I don't know. You don't have to follow what I say. So then what we follow is generally accepted accounting principles. We call it dissolution approach or our realization. Call it either our realization approach or very good. You get this? So what is purchase consideration? Throughout we spoke, no, purchase consideration should be given in the form of equity shares in the transferee company. Call it merger. What is purchase consideration? When you purchase some item, you give some consideration, something in return. That is purchase consideration. In the event of acquisition of an entire business, you give consideration to whom? To the owners of the company. So whatever is given is purchase consideration. Now, if I give debentures to equity shareholders of the transfer company, is it PC? If I give equity shares to equity shareholders of transfer company, is it PC? If I give purchase consideration in the form of preference shares to equity shareholders, is it PC? If I give equity shares, debentures, and preference shares to preference shareholders of transfer company, is it PC? Yes or no? Now some people are saying no, some people are. If I give equity shares to debenture holders of the transfer company, is it PC? If I give debentures to debenture holders, if we give preference shares to debenture holders, so we give. Is it the question of whom are we giving, or is the question of what are we giving? Very good. The question is about whom are we giving. So there are 3 kinds of people in transfer company. One category of people are equity shareholders. Another category of people are preference shareholders. The third category of people are debenture. So as a transferor company, I have 3 people to whom I should pay money: equity shareholders, preference shareholders, and debenture holders. To pay all these 3 people, transferee company, which is buying my company, will give money or will give shares. They will tell this is to equity shareholder, this is to preference shareholder, this is to debenture holder. They can give consideration in the form of cash, bank balance, or they can give equity share, preference share, or debenture. Because my company is closing, even my debenture holder should either receive cash or he should receive debenture of transferee company. Whatever that company gives to pay to my equity or preference shareholder is part of my PC. irrespective of the fact whether it is equity share, preference share, or debenture. But whatever is given to pay to debenture holder is not part of PC, even if it is in the form of equity share of the transferee. Are you getting it? It doesn't matter what are we giving. Only thing that matters is to whom are we giving. Shareholders are the owners of the company. They own that company. Their company we buy. So whatever we give them is PC. So PC is anything that's given: equity share, preference share, debenture, check, cash to equity shareholder, equity share, preference share, debenture, check, cash in the from the transferee company to preference shareholders, but not debenture holder. This is not part of PC. This they're not debenture holder. Whatever we pay to debenture holder is not part of PC. Anything in any form paid to equity shareholder and preference shareholder is part of our. Hope you understood. So this PC can be computed in multiple ways. PC can be computed in multiple ways. So there are three prominent methods. One we call as lump sum method. So this is one of the easy methods. How lump sum amount is given and that lump sum amount will be given to us in the question. So we don't have to compute. Whenever they give that lump sum amount, 10 lakhs PC, 15 lakh PC, they'll also tell us how is the 10 lakh distributed, how much equity shares in it, how much preference shares in it, or they'll either give it straightforward or they'll give one hint in this ratio, in this proportion. That is what we call as lump sum method. We also call this payment method, but there is slight difference between payment method and lump sum method. In payment method, they'll also tell how to distribute. In lump sum method, only the lump sum will be given and we need to figure out how to distribute among the shareholders. Equity, how much preference, how much to each shareholder, what ratio. We might have to figure that out. But in our problem solving, lump sum method and payment method are almost in problem solving. Practically, there is slight difference. And next comes another method called as net asset method. Under this net asset method, they won't tell the lump sum amount, nor will they tell how it is distributed. They will tell the revalued figures of each asset, or they'll tell how much of revaluation is to be done for each asset. They say this land and building is to be taken over at 20% higher price. This machinery is taken over at 15 lakh. Sometimes they'll give amount, or sometimes they'll tell how much higher price, how much lower price. So when they tell all of this, we'll take all these assets at the revalued figures, all these liabilities at these revalued figures. When you deduct both of them, you'll understand the amount of consideration that you need to pay. Are you getting it? And if it stops there, that amount has to be distributed either in that proportion that they mention or we need to figure it out. Sometimes they'll ask us to do it under net asset method. Tell us the revaluations. Also tell the total amount of purchase consideration. Then we need to compute the net assets that we take over with the purchase consideration that they mention. We might end up giving little more or we might end up paying little less. If we pay over and above the assets that we get, it means there are certain assets that we are getting but we don't see. Why? The reason is it is not visible and it cannot be touched also. It is an intangible asset. We call it goodwill. If in case we pay slightly less, it means we're getting more assets for lesser price, which is our profit. And such profit is capital in nature, so we transfer to capital reserve. Are you getting it? Capital reserve or goodwill should not be there in the balance sheet in the event of merger. Come only in the by way of purchase. Like merger may I and you together, like we are going to become us. Then there is no profit, there is no loss. So it will be adjusted against the reserves acquired. But in the case of purchase, that's not the case. You acquire one more business. When you buy, there can be profit. So net asset method, they'll tell you the revalued figures, and using that revalued figures, we compute the amount to be paid or. And lastly, we have intrinsic value method. What is the last method called? This is a beautiful method. Under intrinsic value method, what happens is, now let's say I am acquiring your company. When I acquire your company, to the shareholders of your company, I will give consideration. I can give consideration in the form of cash. I can give consideration in the form of check. I can give consideration in the form of equity shares, preference shares, or debentures in my company. So in your company, we're doing valuation. Your assets, land will be this value, plant and machinery this value, inventory this value. We're doing a lot of discussion. Fine, we do all of that. Then we arrive at some number, 10 lakh rupees is the value of net assets of your. We agree. And then we also valued goodwill. You told 3 years purchase, I told 2 years purchase. We agreed at 2.5 years purchase, super profit method or capitalization. We applied some method, we computed goodwill, 2 lakh rupees goodwill also we added. So totally net assets is 10 lakh, 2 lakh rupees is goodwill, 12 lakh rupees I should give it to you in the form as a purchase consideration. This is agreed. Let us say we want to keep it in the form of merger, or I want to not give it in the form of cash. I want to give it in the form of equity shares of my company. So I will say each share of my company is 50 rupees. So I'll divide 12 lakh by 50 and I'll decide number of shares. Here, Who decided that 50 rupees is the price of each share of my company? You are questioning. You are saying it's not 50. Prove me, tell me the math that it is 50. I will say 50 is a nice number, so it is 50. So you are questioning my credibility, saying, how is it 50? So what do? Now, similar to the way I revalued all your assets and then put a new tag, you will question each asset in my balance sheet. How much is this? Its value is not this much. Write it down to this much. Write it up to this much. So we'll redo my balance sheet again. We'll redo my balance sheet, transferee company's balance sheet. All the assets at revalued figures or agreed values. All the liabilities at revalued or agreed values. We'll identify the total net worth or capital of my company. Divide it by number of shares that is there in my company. We'll arrive at some number. Let's say that comes to 35 rupees. That means intrinsic value of each share in my company is 35. So the price at which I will issue the shares to you should be 35 and not 50. So like how you do computation of revalued figures of assets, revalued figures of liabilities, asset minus liabilities, net assets. We do it only for transferor company. Under intrinsic value method, we should do for transferee company also. You're getting it? Transferor company's net assets will be their PC. That should be issued by dividing the transferee company's net assets divided by number of shares. That rate per share will come. No? That will be the issue price at which the shares are issued. So the net assets of transferor company divided by net asset per share value of transferee company will give us number of shares to be issued under intrinsic value. That net assets what we call compute no under net asset method. Under this intrinsic value method, we call it intrinsic value of the company or intrinsic value per share of the company. We call it intrinsic value of the company or intrinsic value per share of the. So when we say intrinsic value, we are trying to tell the balance sheet value. After revaluing the assets in the balance sheet, what is the value of each share that is there in the balance sheet? That will help us identify the. Did you get this? So more or less everything is same. All the methods here no. More or less it is same. It's not very distinctive, but there is slight difference between each of them. Got it? I'm not literally reading out the same sentences what is there. Making people understand it in a little lighter tone, because if you go on reading all of that and they would do the definition and all initially it's there, we won't be able to do this quick. This chapter we do it for 4 days, 5 days. We're trying to do entire all the chapters within 1 day. Then we have to run. I hope that's fine. At any point, if you find it too fast and you want me to go slightly slow, do tell me. Now, what is the difference between purchase consideration and net assets? Just discuss this. If in case our purchase consideration is more than the net assets that we took over, so we're paying for some assets which we cannot see, we cannot touch. That's what we call as goodwill. And if in case our purchase consideration what we're paying is slightly lesser than the net assets that we took over, we call that as capital reserve. This capital is this profit is capital in, and if there is goodwill and capital reserve already existing, that will be adjusted, net off and then shown in the balance sheet. We don't write them separate. And then we need to learn accounting. Accounting, my presentation is not yet ready. Shall we discuss the accounting in the books of transferor company and accounting in the books of transferee company? Ready? This is similar to your dissolution or realization, what you do in the case of partnership. First, we're learning accounting in the books of transferor. Transferor is the company which is getting liquidated, which is getting closed down, whose assets and liabilities are now taken over by transferee. In this process, I told you accounting standard 14 doesn't tell us any accounting. Accounting is done as per generally accepted accounting. As per GAAP, what are we going to follow? We're going to follow either the realization approach, or it's also called as realization approach, or it's also called as liquidation approach. So under this approach, what we do, we transfer all the assets and all the liabilities at their book value to realization account, irrespective of the fact whether these assets are taken over or, let me repeat, transfer all the assets and all the liabilities to realization account at book values, irrespective of the fact whether these assets are taken over or, if it is amalgamation in the nature of purchase, there might be some assets which are not taken over by transferring. Still transfer these assets to realization. If it is taken over by transferee company, good. If it is not taken over by transferee company, against this we'll receive cash, we'll sell it, or it might not realize any money. So we'll write the entries and then close it, because if I don't transfer to realization, it will be there in balance sheet. There is no need of balance sheet because there is no going concern concept. No, you are not going to do business next year. So you are either they are going to take the asset, or you are going to sell the asset to somebody. Okay? Or worst case, you will give it away free. You can't keep it with you because you are not there next year. Your company is dead. So all the assets and liabilities will be transferred at book value to realization account, whether taken over or exception is cash and bank. Cash and bank is not transferred when it is not taken. So we usually used to crack this joke in PU, cash and bank cannot be transferred to realization because cash cannot be sold. Here it is not sold, it is taken over. If in case it is amalgamation in the nature of merger, you will transfer cash also to realization account, and such cash is also taken over by transferee company. That and fictitious assets and accumulated losses, if it is there, no, that again are not transferred to realization. Why? We'll transfer it to equity shareholders. Like how you do in partnership. If there is P&L account credit balance or general reserve, we don't write to realization. We'll write to partners capital account credit side. Here partners are not there, shareholders. We open an account called equity shareholder account. We'll transfer equity share capital, accumulated losses, accumulated profits, reserves, and realization profit or loss, everything to equity shareholder account, and settle them by the consideration what is received from transfer. You understand this? I'll be sharing this PDF to you people after class. So it is totally okay if you don't copy anything. And if you're copying, I won't stop. Wherever you feel like noting down something you want to note down, you can. But I'll share this PDF with you people later. So then agreed value, if it is given, don't consider. Revaluation account only agreed value per unit. Let's say this building agreed value is given. So when you transfer it to realization account, should we do it at book value or agreed value? Book value. Assets are there in the balance sheet, liabilities are there in the balance sheet. We are killing that balance sheet, we are closing that balance sheet, we are tearing that balance sheet. To close that balance sheet, all the assets which have debit balance should be credited, all the liabilities which have credit balance should be debited. If you debit liability, credit will be realization. If you credit asset, debit will be realization. Hope you got it. You transfer all the assets and liabilities. And when you transfer all the assets and liabilities, for transfer of assets, the journal entries, realization account. For transfer of all the liabilities entries, liabilities account debit to realization. So all outside liabilities should be transferred to realization, except share capital, reserves and surplus. Don't transfer share capital and reserves to realization. Share capital and reserves and surplus will be transferred to shareholders account. Where will it be transferred to? Understood. Assets and liabilities transfer. Then we'll write the purchase consideration due. See, this realization account is like a box. We're packing everything that the transferee company wants in a box. We'll put all the assets they want, all the liabilities they want. We'll pack this box. We'll give this box to them, and they are supposed to give us purchase consideration. Purchase consideration is receivable. It is asset to me from transferee company. So I'll write transferee company account debit for receivable. What should I give them? Realization. This box, what I packed with assets and liabilities. So the entry will be transferee company account debit to realization or purchase consideration due. This purchase consideration will do a separate working note computing it and then write such amount here. After we write PC due, we will now receive PC. PC can be received in the form of shares, equity shares, preference shares, debentures, cash, whatever form we receive, we'll debit all of them. And then credit will be given to transferee company. Here we have debited transferee company because it was receivable. Here we received, so that will be closed by crediting. And whatever we receive, we will debit. And I told you, no, equity share capital and then reserves will be transferred to shareholder account. After we write this PC and dispose the assets which are not taken over, settle the liabilities which are not taken over, if any, we get realization profit or loss. That also will be transferred to shareholders account. After that, whatever balance is there in shareholders account, no, will be equal to this. This cash, bank, equity shares, preferential debentures, what we have received in PC, we give it to such shareholders, and that will be the closure of our shareholder. So certain assets which are transferred to realization account, if it is not taken over by transferee company, that will be left with us. We will sell it. We will sell it. If we sell it, we receive consideration. Usually write the entry as cash account debit to asset, to P&L for profit, debit P&L for loss. Here we won't debit or credit P&L, and we won't credit asset. Why? Asset account is no more there. Asset is closed now by transfer to realization. Our journal entry is cash account debit to realization. Cash account debit to, this entry should be passed at selling price. Entry should be passed at, sir, but asset is 10,000, it is sold at 12,000. It's okay, don't worry, write 12,000. Initially, when you transfer to realization, you did at 10. Now, if you write consideration 12, automatically realization profit when you compute, there 2,000 gets adjusted. We are not trying to find item wise sale by profit. Why? If you are going to be there for next 2-3 years, there is a point that is required for decision making. What decision will you do? You are dead. Correct or not? When you are dead, each of the body part will not be burned separately. Full together, onde se the kerosene of suttadashe. So you are not going to identify profit or loss on sale of each asset. You will write the sale consideration to realization account, and there only you will get the profit or loss, including every item's profit. Yes. And whenever they don't tell whether that asset is sold or not, let's say there are 5 assets. There are 5 assets: land, plant and machinery, motor vehicle, furniture, and inventory. And they say that the transferee company takes over inventory, furniture, land and building, and then motor vehicle. They don't take over plant and machinery. Transferee company is not taking over. And they don't tell anything. Usually in PU, you used to do that it is assumed to be sold at book value. But that's not what you should do here. If they don't tell that a specific asset is sold for some consideration, we will assume it is sold for 0 rupees. We'll assume it is sold for 0 rupees. Don't write any sale entry. Or if you want to write for 0 rupees. Why? Conservatism. Why? If it is profit, they should tell. If they don't tell, it is loss. So unless they mention that a specific asset is sold for a specific value, if it is not taken over, we'll assume that it realizes nothing. However, opposite for liability. If in case there are 5 liabilities, transferee company is taking over 4 liabilities. One liability is not taken over. Liability is, we'll assume that this liability is settled at book value. We'll assume that this liability is settled at book value unless specifically mention that it need not be paid. Got it? Read this. Entry to be passed at selling price. Ignore cost price or book value. Don't try to account for profit or loss on sale. In the absence of specific mention about selling price, assume selling price as that, and the journal entry will be you receive consideration of bank account debit to realization account. Got this? Then settling liability is not taken. I told you unless they mention that it is not settled, you'll always write the entry for settlement at book value. Entry is realization account debit to bank. Read this. Entry to be made for settlement value. Ignore book value of liability. Don't try to separately account for profit or loss. Let's say liability is 10,000, you paid 8,000. Don't try to book 2,000 profit. Just write the entry as realization to bank 8,000, 8,000. 2,000 will straight away get affected to our realization profit or loss. What we then, in the absence of specific mention, unlike assets, what do we assume here? Settled at book value. There, what do we assume? 0. Here we assume. Get the difference? Used to do it differently, no, in PU. That is right for marks in second PUC examination. But practically, this is right. Got it? Very good. So then liabilities which are not taken over is paid, assets which are not taken over is settled. If there is any realization expenses incurred, we should write that. Because to sell the assets, to settle the liabilities, we might incur expense. No? Now there are 2 parties involved. The company which is getting liquidated, company which is acquiring. Either of them can pay this liquidation expense. Either of them can pay this, and either of them can bear this liquidation expense. Let us say I am transferor company. I am the small company which is getting liquidated. I pay realization expense. Bank account or cash account credit, debit such expense to realization. All the profits or losses, all the expenses or incomes arising on liquidation should be booked in realization account. So I'll write the entry realization account debit to cash or bank for payment. And I'm only bearing it. I'm only bearing it. If in case it is paid by transferee company, will I write entry? Transferee company will write entry. What entry will they write? They will write goodwill to cash because they can't write realization account. They're not selling anything and they're not getting anything. So they're paying on my behalf. So they'll write goodwill to bank. This is when they pay, they bear. What if they have paid it, but I should bear it? I should have paid, but I don't have cash. On my behalf, they've paid. They will say that it is receivable from me and I would have to pay them. It will become almost like part of PC. You're getting it? Or if I pay it, I write realization account debit to bank, assuming that I am only bearing it. If I paid, but that the company is saying, I am acquiring your company, no, your cremation charges I will pay. So if the transferee company says that, then it is no more our expense. Correct or not? They will bear the expense. So they will give us money. So they will give money, bank account debit. It is no more my expense. It is reversal of expense, or it is like income. I will credit realization. So when I pay realization to bank, If I only should bear, already I have written it to realization, so I don't have to write any entry, no specific entry for borne by transfer. If it is reimbursed by transferee, we receive no bank account debit to realization. So basically, the entry what I wrote here is reversed. They pay. What if transferee company pays? If the transferee company pays, I write no entry. This is no entry. That one movie was there. No. So if transferee company pays, I write no entry. If transferee company has paid on my behalf and I need to repay to that company, then I have to write no realization. Whether I pay directly or he pay and I pay him, to me it is same. I'm paying. We get realization expense. We'll discuss this in the books of transferee company slightly. And finally, this realization profit or loss, whatever is there, will be transferred to partners' capital. Before that, purchase consideration payable to preference shareholders, purchase consideration payable to equity shareholders will transfer. Will close their capital account, will close realization account, will close reserves account, will close accumulated losses account, and transfer everything to preference shareholder and equity shareholder. Capital credit balance, reserve credit balance, and if there is accumulated loss, debit balance. Realization profit, credit balance, realization loss, debit balance. Reverse them and credit preference shareholder and credit equity shareholder. You getting it? After we do it, then we just pay that consideration whatever we received to equity shareholder and preference shareholder. So this will be the entry. Equity share capital will transfer to equity shareholder. Finally, we'll pay equity share. One thing that you should remember is realization profit or loss will be adjusted to equity shareholder, not to our preference shareholder. First, settle our preference shareholder. Transfer whatever belongs to preference shareholder to preference shareholder account, like preference share capital, arrears and dividend if there is any, premium on redemption if it's supposed to be paid. Such premium and all, if the provision is already made and it's there in the balance sheet, very good. If you have not made provision, then debit it straight away to realization. Debit it straight away to realization. You credit everything to preference shareholder, pay to preference shareholder. After you pay preference shareholder, then identify realization profit or loss, and then transfer reserves, transfer share capital to equity shareholder, and then settle. And this is how the accounting is done in of transferor company. You understand this? Is this as per accounting standard 14? No. This is as per generally accepted account. Any part of this which you have doubt in and you want me to repeat? Ah, very good. So what I want you to note here is, in the question further, they can ask ledger account. We discuss journal entries. They can ask you to prepare ledger. They won't tell what ledgers to prepare. Sometimes they say prepare necessary ledger accounts. When they use the word necessary ledger accounts, please prepare realization account, transferee company's account. This is for purchase consideration. Prepare preference shareholder and equity shareholder. You understand? These are the 4 ledgers that you should prepare. When they say necessary ledger, they specifically mentioned what ledgers to prepare. Prepare what they've asked. If they don't mention, then prepare these. We go ahead. I will discuss accounting entries in the books of transferee company. When we are discussing accounting entries in the books of transferee company, we have 2 methods. It can be amalgamation in the nature of merger, or it can be amalgamation in the nature of purchase. If it is purchase method. If it is merger, pooling of interest. You will see accounting entries simultaneously under both methods next to each other, so that we get comparison. Got it? First one, for business being acquired. When you acquire the business of the transferor company, so what is it? You are purchasing the business. So we debit business purchase account. We debit business purchase account. And against that business what we purchase, we should give consideration to whom? Liquidators of transferor company. So entry will be business purchase account debit to liquidators of transferee company. This is actually transferor. Okay. Business purchase account debit to liquidators of transferor company. And the same entry will come in the case of pooling of interest also. There's not going to be any change in this set. After this, that business purchase is like box. He called it realization. I call it business. The box that he packs by putting all the assets and liabilities and then tape. He calls it, I call it, now I'll open that box. When I open that box, from that box pops out all assets and all liabilities. He would have put assets and liabilities into that box at book value. When I open it, it will be all at agreed value. It will be all at, so when the transferor puts assets and liabilities into realization, he will put it at book value. He will pack it, he will give it to me. In the books of transferee, that box is called as business purchase. When I open that box, everything should be recorded at agreed value. So I'll record all the assets that I'll credit all the liabilities. And business purchase, whatever is debited here, no, will now be credited. Got it? So these assets are at agreed value, liabilities are at agreed value. Assets minus liability. What do we get? Net assets taken over. Assets at agreed value minus liabilities at agreed value. What do we get? Net assets taken over. And this entry is written at PC, no? Here we wrote business purchase to liquidators for PC due. Am I right? So NATO and PC. If NATO is less, PC is more, then what happens? PC is more, no, credit is more, debit is less. You're paying more than what you bought. That will give rise to goodwill. If in case you pay less, it will become profit. That will give rise to capital. So goodwill or capital, it is not both. It is not both. And whatever working note that you do to compute NATO, after that you do PC computation. There you compute no goodwill or capital. Then when you write this journal entry, check goodwill or capital that you get here. This should match with that. The moment this matches with that, it means that everything that you're doing so far is correct. All the working notes that you do know for amalgamation, PC computation, NATO computation, all this under mutual indebtedness adjustment that you do, unrealized profit adjustment that you do, all these working notes that you do adjusting all of this, impact of this will be given in transferee's book and never in transferor. None of those items will come in transferor's books. All of this will come as an impact where in transferee company's books. Why? He's dying. Did you do working note to kill someone? No, working notes are done to present the items in transferee company only. Just remember this. Good. So we write asset account debit, goodwill if it is any, capital or if it is any, two liabilities, two business. This is in the event of purchase method. In the event of pooling of interest method, there cannot be anything like goodwill or capital reserve. The reason is there is no you, there is no I. It is us. We both are now together. I can't say that I acquired you and then I paid you more and there is goodwill, or I acquired you and I paid you less, there is capital reserve. There can't be things. Getting it? So what do? We write all the assets at book value. The value at which they packed is the value at which I record. Same values we record. So there can be no difference. There can be no difference. So I open the assets. Assets are at the same value in which he packed. So I'll write all the assets. I'll write all the liabilities. If in case still we paid more than that as purchase consideration due to some reason, such goodwill or capital reserve, it doesn't matter. It has to be adjusted through resources. It has to be adjusted through of whom? Of transferor company. We acquire that company's reserves. No, we adjust goodwill or capital reserve against that reserves of transferor. Sir, why can't we do it under purchase method? Under purchase method, we don't take over their reserves. No? Reserves are transferred to their shareholders. Here, they only become shareholders here. No? So to that extent also they get shares. Then after this, debenture holders of that old company who are there, they should be given debentures or they should be given cash or given something in the new company. Why? The debenture what they hold, which has the name of the old company, is no more valid. Why? That company is not there. So usually we can give them debentures in the new company or give them shares or settle them by way of cash. So in this liabilities, what you would have credited here, no, there will be liabilities in the form of debentures of transferor company. So that we will debit. Are you getting it? So debentures of transferor company. Whatever is included in this liabilities. So we'll debit it and then we can give them either debentures, we can give them preference shares, we can give them equity shares, we can give equity shares or preference shares or debentures at premium, or we can give them cash, or if it is not equity shares and preference shares cannot be issued at discount. Section 53 will restrict. If it is debentures, we can issue them at discount. We can issue them at slightly discount. You get this? This is the entry in the books of transferee company under purchase method. What about pooling of interest method? Same to same. No difference. Entry will be same to same. No difference. In this context, he will tell one dialogue called same. I thought I'll keep the material little later. But I should have typed same to same, no difference. Here I put this image because if you remember 2019 World Cup inauguration, when they asked, how do you feel about India, Pakistan? Virat Kohli spoke for good 2 minutes explaining the entire scene. And then this Pakistani captain, only thing that he had to tell was, my answer also same. No difference. That is the English that he. Okay. Oh, Babar uncle knows little bit English. Yeah, not batting. And our cover drive is better. Yeah, cover drive is not that great. It's good, but king. Let's go ahead. Then discharge of purchase consideration. So as transferee company, we give purchase consideration to transferor company. Am I right? So when we do give consideration, it is given to liquidators. In the first entry, when we purchase the business, we have credited liquidators of transferee company, sorry, transferor company for the consideration to be paid. Am I right? Here we have created it because it is payable. Am I right? When it is paid, I will debit it. I will debit it. And I can give them equity shares, I can give them preference shares, I can give them debentures. There can be issued at premium or you can pay them slightly cash. This is showing the meme. 2019 World Cup. 23 World Cup. He doesn't know who's Babar Azam. What did he show? Okay, fine. And you're showing him the screen time. 5 hours straight. What did you do? 2 movies. Studying on phone. Nice. So for discharge of purchase consideration, you debit liquidator account because that liability is reducing. Whatever consideration you give, you write it. One more important point. Whenever the shares are issued in the transferee company at premium, here we credit premium. You're getting it? When we write entries in the books of here, when we write entries in the books of transferor, when we write books entries in the books of transferor company will give us purchase consideration. When we receive PC here, when we write equity shares in transferee company, security premium we don't write separately credit. You're getting it? Let's say 1 lakh is the nominal value of the shares. It is issued with premium 1,20,000 rupees. The value of the shares in PC. Here when I write preference shareholder account debit to equity shares in transferee company, or here when I write equity shareholder account debit to equity shares in transferee company, I will write 1,20,000. I will not write 2 equity shares in transferee company 1 lakh, 2 security premium 20. No. To transferor company, it is not premium. It is premium to transferee company. They in their balance sheet have to show nominal value and security premium separate. Here, this is the cost of acquisition. We'll record it at cost. Getting it? In the initial entry, when we receive PC, we would have written one entry, no? Transferee company account debit. Here, equity shares in transferee company, preference shares in transferee company, debentures. Here again, we'll write it at a price including premium. Or if debentures are given to us at discount, we'll write it at discounted price. Don't write it at nominal value. Nominal value and security premium differentiation is in the books of transferee company. Remember this, because a lot of them end up doing this very silly mistake. It might sound to you, ಇದೆಲ್ಲ ಹೇಳ್ತಾ ಇದ್ದಾರೆ ಅದೇ ಮಾಡೋದು ತಪ್ಪು. Yeah, there was an kind of adventure sport called as building a metal tunnel, sitting inside it, and then jumping from the top of a cliff. People used to do it with waterfalls. We break a small tunnel, we call it capsule. They sit inside that capsule, a small metal tunnel, and then they put themselves into the water, flowing stream of water, and that capsule will fall from the top of a waterfall, and people survive. It was an adventure sport, 1940s, 1920s, in 18th century and all. People used to do this. There was a guy who survived fall from what is that river? Nile River. What is that waterfall? Big one. Niagara waterfall. He survived a fall from the top of Niagara waterfall. And after that achievement, he was called as one of the bravest man. Survived the fall from the tallest waterfall in the planet. And then one fine day, after that, he was walking on the street. Someone had thrown an orange peel, not even banana peel, orange peel. He stepped on the orange peel. The liquid out of the orange peel, what came out, made the surface flat, and then friction was lost, because of which couldn't pick up the feet and then keep further. It slided. When he slided forward, no, the legs, because of imbalance, his head fell back. Then his head hit the pavement, because of which he got hurt here and then he died on the spot. The man who survived the fall from the top of the Niagara Falls died because he stepped on an orange peel. So it is not the Niagara waterfalls jump that will kill you. It is all these small things that will kill you. Most difficult, complex adjustment you might be able to crack. Some silly mistakes is what will cost you 2 marks, 3 marks. So be cautious, because the easy catches are the most difficult catches. Old grade. Fine. Next, realization expense of the transferor company. It is paid by transferor company. No problem. We don't write entry. If we paid, we need to write the entry. If it is purchase method, then we call it goodwill account debit to cash. Why? To be in their good books. See, whose expense is it? Realization expense, transferor's expense. Who should pay? Transferor. We are paying them. Why? To be in their good books. What good books are there? Books are only wound up. But still, you write goodwill account debit to cash or bank. But you don't get anything. No, you only get their goodwill. If in case, what to say, it is amalgamation in the nature of merger, we can't write goodwill or capital reserve. Let's say you write goodwill account here. Then what should you do? Again, that goodwill should be adjusted against reserves. No. So instead, straight away write reserves account debit to cash. Okay? Then mutual indebtedness. Is it one owes the money to the other? Either transferor owes money to transferee or transferee owe money to transferor. They owe money to each other. Against this, no, till the time transferor and transferee are two different companies, no problem. When they become one company post amalgamation, then you cannot show that asset and liability because you are one. You should pay yourself. Should you pay money to yourself? No, you should eliminate it from the asset as well as the liability. This is for debtor, creditor, or bills receivable, bills payable. We eliminate both. How do we eliminate both? Liability will be debited, asset will be credited. Creditor account debit to debtor account, or bills payable account debit to bills receivable. Same to same entry is done in the books of done in the, if it is the amalgamation nature of merger also. This is going to be no difference. That then comes unrealized profit. See, this debtor creditor relationship or bills receivable bills payable relationship between the transferor and transferee comes because one has sold goods to the other. One has sold goods to the other, and that person who purchased has sold these goods to outsider. No problem. I am transferor. I sold goods to my transferee company, and my transferee company sold all of these goods to an outsider. No problem. No adjustment required. Those goods are not there. Problem starts when transferor has sold goods to transferee. Transferee has not sold it to outsider, but still there in the balance sheet. Or transferee has sold goods to transferor, and transferor has not sold these goods to outsider, but it's still there in the balance sheet. That's when the adjustment. The reason being, the selling company would have booked profit. The buying company would have recorded at the price which is slightly more than the cost to other company. I sold 100 rupees worth of goods to 120 to the other company. I have booked 20 rupees profit, and that company is recorded the stock at 120. If they sell it to outsider at 130, no problem. I record profit of 20, he records profit of 10. The problem starts when he has not sold it outside. The problem is again not there when we both are distinct companies. When we became one single company, then I have recorded in the amalgamated balance sheet, I have recorded the stock at 120 rupees, whereas the cost to myself is 100. And the 20 rupees cost value increased. That 20 rupees is booked as profit in the same balance sheet P&L account. So in reserves and supplies, there is profit of 20, and the balance sheet asset side, inventory shown at 20 rupees higher price, which is not fair. So we'll reduce the value of the inventory by 20, and we'll also reduce the reserves by 20. So the stock value will be reduced. Am I right? So stock account will be credited. Stock account will be debit, will be goodwill account. If it is amalgamation in the nature of purchase. If it is merger, we cannot use the word goodwill. So we'll straight away write it to P&L or general. If in case you write goodwill, is it wrong? No. Again, that goodwill has to be adjusted with reserve. Got that? Next, statutory reserve. Because of any statutory requirement, if the transferor company is forced to continue some reserves, there is some foreign currency translation reserve or some dividend equalization fund or some other fund, what they should continue to maintain as a reserve. Now, when they die, I take over their business. Just before the transferor dies, transferor keeps their hand in the books of hand in transferee's hand and say, "This is my promise. Please fulfill this promise because I am not able to fulfill." Like you see in retro movies towards the climax. So transferee has taken up the responsibility. You're getting it? So then now transferee's company's responsibility is to load, aim, and shoot for the rest of the movie too. So what does the transferee company do? They'll maintain it. Now, how to do entry for this depends upon whether it is amalgamation in the nature of merger or amalgamation in the nature of purchase. If it is amalgamation in the nature of merger, you don't write any entry. Why? We take over all the assets and liabilities, including reserves and surplus. No, when we take over reserves, we've taken over their general reserve, We've taken over their P&L account. We've also taken over their statutory reserve. We maintain it. There is no problem there. However, if it is amalgamation in the nature of purchase, they won't give us reserves. We take only their assets and liabilities. Now we would have to record it. What do? I'll record statutory reserve by crediting it. But I'm not going to receive anything against it. So this will be created by way of amalgamation adjustment. So I'll write amalgamation adjustment account debit to statutory reserve account. This entry will be passed and reserve will be shown in the financial statements for a period of 2 years, 3 years, whatever is the balance period for which the compliance was supposed to be made by transferor. Once that compliance period is over, then this reserve will be reversed. We'll write statutory reserve account debit to amalgamation adjustment account. Now, there is lot of controversy with regard to this amalgamation adjustment account. Where do we write this amalgamation adjustment? See, the statutory reserve, we know we'll write it in balance sheet, reserves and surplus. Where to write this amalgamation adjustment? Initially, when this came, long ago, before Companies Act 2013, this amalgamation adjustment was written in other current assets in balance sheet. Or some cases, some authors had written this in miscellaneous expenditure in balance sheet. But all of this came to a close because under revised Schedule 6, no, that miscellaneous expenditure was there. Under Schedule 3, miscellaneous expenditure concept was not there. There is no miscellaneous expenditure in the balance sheet asset side. Now we are left with two options. Either we should write it in other current assets in the balance sheet asset side, or we should deduct it from reserves in the liabilities. Again, lot of author material still write other current assets, amalgamation adjustment in other current assets. But as per the opinion given by the EAC, this amalgamation adjustment, whatever is arising, has to be deducted from reserves and surplus. We'll write reserves and surplus no of the transferee company. From there only you will deduct this amalgamation adjustment balance. Get this? It is not another current asset. It doesn't fulfill the criteria for an asset to write it as done. What have you people read so far? Wherever you read it from, however you read it from, reserves reduction. If you're reading it as an asset to be written in the balance sheet asset side, I would tell you to correct it. I'm not telling you that it is wrong. Some author materials have still done that. I can show you one or two RTPs which is still shown that as an answer, but not recommended. What is very strongly recommended is to deduct it from reserves and surplus. And anyone who's ready to be written in balance sheet asset side? No one? No one? Nice. So we deduct it from reserves and surplus. That's fine. This is one place where you might do mistake again. And mutual indebtedness and unrealized profit adjustment, don't try to adjust them in transferor books. You need to do adjustment only in the books of transferee. You know that that money, that debtor is transferee, but still transfer it to realization, transfer it to what to say in the PC computation also you take it. PC computation adjust ಮಾಡ್ಬೇಡಿ. NATO goodwill PC computation, but don't eliminate that mutual indebtedness. Don't adjust that unrealized profit. Finish all that working. Only in the accounting entries when we're doing in the books of transferee, you should do it. Getting it? So it's like after takeover is when you adjust it, not before takeover. Not before takeover. It's like this: you owe 10,000 rupees to one friend of yours, and then you end up marrying that friend. Do you have to pay? No, then you don't have to. When after marriage, not before. First, everything should be over. Then you'll say, don't have to pay. Why? My money is your money is your money, so I don't have to pay you any money. Okay? Did not understand? Eventually, you'll get it. Even I felt like, what is it that's been? Later, I understood. Statement goes like, not told by me, but it will be told by my wife. Does my money is my money, your money is my money. But understand it looks very complicated, but it's nice to hear, funny, laugh, and then ignore. An unrealized profit is theoretical profit or deficit that exists in balance. We remove that. I explained it to you already. Statutory reserve also I told it to you. So you can follow. And there are certain disclosure requirements. After you prepare, every accounting standard has certain disclosure requirements to be made. No? Similarly, accounting standard 14 also has some disclosure requirements. So this is one thing that I used to do when I wrote exam. So what I used to do was this disclosure requirements are there. You learn it in accounting standard 14 class. This you don't usually read it with amalgamation. Whenever you do question on amalgamation, when you start your answer on amalgamation, do these disclosure requirements alongside with balance sheet. After you prepare balance sheet of transferee company, write disclosure requirements as per accounting standard 14. Right? Name of transferor company, name of transferee company, nature of business, gottilla, dash. Effective date of amalgamation, gottilla, dash. Nature of purchase consideration, PC, what is a lump sum method or net asset method or intrinsic value method. Write that. Write that. See, that is already there in the question. You write it. that will create a kind of impression in the eyes of the evaluator that, oh, this student has not just read all the formats and how to write journal entries and how to do the problem. Student has read theoretically correct. This person deserves to become chartered accountant. That heart might melt in some corner because of it, some place where there is a possibility where ingu agbodu, angu agbodu, if it is there, they'll put you on the side from which you might go for. Think this. So please do write it. It won't take much time, 10 seconds extra, and you won't get extra marks for writing. You will get a soft corner for writing. Get that? Evaluator also has a heart. It can also melt. You just need to be hot enough with your answers. Your answers. You get it? You can't show your face. No. See, everything that you would have done for 6 months, 6 months of efforts, and then 24, 25 hours of studying just the day before it will be judged in the span of 3 hours of what you write by an evaluator who corrects it in 20 minutes. So the gateway to the evaluator's heart is in the time period of 20 minutes. In 20 minutes, no, you should express it to him how hard you worked in the last 6 months. You can't write, no, I there was no power at our house. I studied under street lamp. You can't write all those stories. But gateway is just show them your work as to how hard you work, how much do you know. That's the place for you to show. Got it? Without writing your name. Yeah, and this is one more thing. I last time when the results came, lot of people, you people have messed up. In some random place, you written your name or you written your roll number. Or worst thing is additional sheet. When you take in the additional sheet, some people have written roll number, and you won't believe results was withheld. When the results came, these students' results was withheld. They didn't show the results, and later students had to write a sorry mail saying that I am sorry, I followed whatever malpractice has been done is not with an intention. I seriously apologize for it, and I would ensure that such malpractice or such disobeying of any of the examination guideline will not happen in the further time. They had to write a mail. Once they wrote their mail, big-heartedness mein, I say release their not survive, will not come in the new scheme of education. Everyone thought this will be one chapter which will get removed, but this is a chapter which has survived and which will continue to be there even in the case of new scheme of education. We full-fledgedly. A lot of chapters have a lot of cut, but this chapter will be there full. So when we start talking about branch accounting, for the purpose of accounting in this chapter, branches are classified into two categories based on where they are situated. Number one, inland branches. Number two, foreign branch. Inland branches in the same reporting country where the head office is situated. That is inland branch. If the branch is in a country other than the place where the head office is situated, we call it a foreign branch. We need to segregate it into inland and foreign branch. The reason being, if it is an inland branch, the reporting currency of head office and the branch will be same. If in case it is not an inland branch, the branch is in a foreign country, then the reporting currency will not be followed in the foreign branch. Then what is it that we would have to do? We would have to apply AS11 to convert the branch records to reporting currency. Take it. So the reason why we segregate the branch into inland and foreign is to apply AS11 and to not apply AS11. In fact, in inland branch, there is no need to apply it. Am I right? Talking about inland branches, to apply the accounting, we need to segregate into two categories. One is dependent, other one is independent. Dependent, the word here is much different than how it is in the practical scenario. In a practical world, when we say a dependent branch, that branch is dependent upon the head office for raw material or finished goods. That branch is dependent upon the head office for decision making. That branch is dependent on the head office for banking services. That branch is dependent upon the head office for fixing selling price, taking decisions, fixing financial what to say policies, sales policies, and all of that. Meaning, branch on its own cannot procure goods from somebody and then sell. Head office will send the goods. Head office will tell what price to sell. Head office will tell whom to sell. Head office will tell how much discount to give. Head office will give bank details. Everything should be happening as per the instructions of head office. That is what we mean dependent branch. In what? In a practical scenario. In this chapter, what we learn as a dependent branch is not that. In this chapter, when we'll say dependent branch, does the branch have an accountant? If the branch has an accountant who can sit there, pass journal entries, maintain books of accounts, it is not a dependent, it's independent branch. It is independent branch. When we say dependent branch, branch does transactions. Branch doesn't have a full-fledged accountant who can prepare proper journal, ledger, trial balance, prepare final accounts, and then send a MIS report to head office. Branch doesn't have accountant. Branch is a small shop. where there is one person, you only manufactures, you only sells the goods, you only collects money, you only sweeps the floor, you only close the shutter, you only opens the shutter, you only does the puja on Friday. He does everything. And you only picks the call if the call is also made. So one whole and sole person or two persons, they only do this. There is no place for an accountant to sit and pass journal. So whatever transactions happen, they'll tell over call or send the bills to head office. Head office only does account. That's what we mean by dependent. So do you understand the context of dependent branch in a practical world is much different from what we discuss in this chapter. Here we're seeing it only from the perspective of accounting. For the purpose of accounting and maintaining records, is the branch dependent on head office? The answer is yes, it is dependent. It is not dependent on head office. It can maintain its records on its own. It is independent branch. Keeping record of transactions is not accounting. Accounting is not writing only journal or maintaining books. Accounting is writing journal, posting to ledger, preparing trial balance, and also being able to prepare final accounts. Okay, first we'll start with dependent branch. Dependent branch में multiple cases are there, multiple scenarios are there. We'll discuss all of that and then go to independent. For the next 20-30 minutes, we're going to discuss dependent branch one. Independent branch, what we have is very less. Foreign branch is even more less. Major part of the chapter is on dependent branch. Major possibility of questions in the examination is on dependent branch. Whenever the branch is dependent, head office is maintaining books of the branch. Head office is maintaining the books of the. When head office maintains the books of the branch, head office can maintain the books of the branch in three broad methods. Number one, debtors method. Number two, stock debtors method. Number three, final accounts method. And other than this, there is plus one called retail price method, or what we call it as wholesale price method. Wholesale retailer type relationship they'll appoint and then try and do. So these four types we need to understand. So what are these? Number one, debtors method. Number two, stock debtors method. Number three, final accounts method. Number four, wholesale price method. All the methods are same. They'll give same answer. Sir, which one to pick? It is left to the convenience of the management of the head office. Head office will decide which method to pick based on certain criteria. Criteria number one, if they treat head office as wholesaler, branch as retailer, then we'll follow wholesale price method. Head office as wholesaler, branch as, they're actually one only. Retailer, wholesaler means there are two different persons. Retailer will book retail profit, wholesaler will book wholesale profit. It is not two different entities. It is one entity, but they will treat branch like a retailer. Then we'll follow wholesale price method. You did something called adjusted selling price method, or did something called retail price method in CA Foundation, chapter 4, valuation of inventory. You used to do one table to compute. Did that? Something similar to that. Or in accounting standard 2, when you did valuation of inventory, also you do something called retail price. Call the name. So that concept is what we apply in this wholesale price. So only retail is a wholesale is a, the one is wholesaler, the other one is obviously retailer. No? So from the perspective of the head office, we call it wholesale price method. From the perspective of the branch, we call it retail price method. Perspective is different. What we do is same to same. Then when the goods are sent and it is not treated like wholesale retail, then we can follow three methods: debtor system, stock debtor system, final accounts. Debtor system, stock debtor system, final accounts. Under debtors approach, head office will treat branch as a debtor. Head office will treat branch as a debtor. I've given goods to you. You should give me money. Not sold. I've given goods to you. You are like a debtor, not debtor. If you sell your debtor, it is like a sale, and you are like a debtor. So whatever money you owe to me, I'll write as receivable, asset, opening balance debit side, closing balance credit. If you say debtor, to debtor, what do you give? Goods. Here is like debtor. So you give him cash, you give him assets, you give him building, land, plant, machinery, inventory, and you also give him petty cash for expense. These are all the things that you give, no? For against that, you should give us money. We treat like that. Branch is an asset in the form of debtor. So we open debtors account. We open, but we don't write debtor. We'll write branch account. Branch is like our debtor. Everything that we have given to the branch, assets at branch, cash at branch, stock at branch, everything is our asset. We'll write on the debit side opening balance. We'll write on the credit side closing. Further, during there, we gave stock to branch, debit. Branch gave us cash. Branch incurred expense, we don't give. We incurred expense, we write. So transactions are done by branch. Accounting is done by head office. Head office will make entries for such transactions which will affect head office. If the transaction is between branch and third party, head office will not write it. The transaction is between branch and third party, head office will not write any entry. So think, whose records are we keeping? Branch. Who's passing the journal entry? Head office. So when will we write the entry? If it affects head office. The stock is sent to branch. We write the entry. Yes, debtors will increase, so debits. Stock is sold by the branch to customer. No entry. Why? This entry is between branch and customer. Entry is between branch and if the entry is between branch and customer, head office is not affected. Head office will not get involved. You don't write any entry. You will be like, sir, if we don't write the entry for sales, then how will we identify profit? Very simple. I'll write opening stock. I'll write purchases. I will not write sales. I'll write closing stock at cost. And then I'll find balancing figure here. Sales GP ಎಲ್ಲ ಒಟ್ಟಿಗೆ ಬಂದ್ಬಿಡುತ್ತೆ. Sales ಒಟ್ಟಿಗೆ GP ಸೇರಿಸಿ ಬಂದ್ಬಿಡುತ್ತೆ. What I'm trying. Basically, I'm writing COGS. I'm writing COGS types. So I will write discount. I'll write opening balance because I know it. I'll write goods into branch because I know it. I'll write the closing balance. I will not write the transaction between the branch and the customer. Customer paid money to branch. We don't write it. Customer paid money to us. We write it. Like we are. It is though the customer pays the money. It is like branch is paying us. You're getting it? Expense incurred on behalf of the branch by the head office. We'll write it. Expense incurred by the branch. We don't write it. Paid by the branch. We don't write. Why? We write opening balance of cash, closing balance of cash. If we send cash to branch, we'll write it debit. Automatically, net difference will be expense. It will get affected. So basically, there are several accounts: stock account, cash account, debtors account, expense account. There are several accounts. No, all the accounts we put together and P&L account. Stock only GP we should identify, transfer to P&L. Debtors may bad debts we should identify, transfer to P&L. Cash may expense we should identify, transfer to P&L. We should do everything. No, we'll put all the accounts together. When we put all the accounts together, it is only one account called branch account. So from there is no place to transfer to branch pay. So we ignore such transactions which will affect expense. Create only opening balances, closing balances. And goods sent, cash received, goods received will write. Net balancing figure will become branch profit. This is branch data system. This branch debtors is there. No, it is several accounts written together. What accounts? Debtors account, stock account, expense account, cash account, asset account, everything written together. In asset also, what is the entry for depreciation? Usually we write depreciation to asset. We don't write depreciation entry. Branch account we don't write depreciation. We write opening balance of asset. We write closing balance of asset. Net difference will be depreciation automatically affecting our branch profit. ಅರ್ಥ ಆಗ್ತಿದ್ಯಾ? Everything which doesn't affect head office straight away will ignore. All of that together will be our branch profit. This branch debtors account is there, no? If I cut it into several pieces, that will become stock debtors method. Under stock debtors method, I'll prepare stock account, debtors account, cash account, expense account, and then asset account. Every account will open separately. In asset account, I'll find depreciation, transfer to branch. In stock account, I'll find gross profit, transfer to PL. In debtors account, discount given to customer, bad debts I'll transfer to PL. Expense account, I'll transfer expense to PL. And whatever in branch PL we get as profit, that is the same profit that we would get here. Got that? Did you understand difference? And final accounts approach is our usual thing: trading account, P&L account, balance sheet. Treat branch like a separate entity which has purchased goods, which is opening stock, which has closing stock, which has incurred expense, which has paid money, all of that, and we'll write the entries. So this is the mindset that you should have. So I'll quickly revise in 10 seconds what I just told. 3 methods to maintain when the branch is dependent: stock system, debtor system, stock debtor system, final account system. Under debtor system, branch is treated as debt. Everything that's given to branch: asset, cash, petty cash, you want to say stock, and fixed assets, everything will be treated as opening balance of the debit, closing balance of the credit. Every transaction that's happening between the head office and the branch will be recorded. Transaction happening between branch and third party will not be. Balancing figure in branch account will be as. If you break that branch debtor account into small parts, each part will be one ledger under stock debtor system. That is stock account, debtor account, cash account, asset account, PL account. Final accounts, we do it as usual, or we do it for a separate entity. Shall you quickly see a question? Before that, I would want you to read this. Quickly run through this. Same thing what I just explained to you now. This reading, look at me. I can go. Reading, look. Done? Let's go ahead. Journal entries under a debtor system. When the goods are sent to branch, I told you branch is treated like a debtor. Debtor has to pay you money. Branch account debit to goods sent. This goods sent to branch will be deducted from your purchases. So ultimately, the entry is branch account debit to purchase account. Your purchases is decreasing, meaning the stock at the head office is decreasing because it is sent to branch and branch has to pay. Got it? Then the next entry, branch expenses. Expenses have to be incurred at branch. No, if it is paid by head office will tell I have paid expense on behalf of the branch. Branch has to pay money, so branch account debit to cash. Branch owes me money now. Right? Next one, if it is paid by the branch, head office will say, boss, I won't write it. I'll write opening balance of cash at branch, closing balance of cash at branch. Difference, whatever expense is there will affect our profit. During the year, if I have sent cash to branch, I will write the entry. What will be the entry? Branch account debit to cash. Why? My cash is decreasing. I have sent money to branch. Branch has to pay me. Liability. Branch is my asset. Asset is increasing. So I'll write branch account debit to cash. If branch pays me some cash, received no cash. Cash account debit to branch. It is like cash collected from data. If the goods are sold, credit sale, cash sale, doesn't matter. I don't write entry. Why? It is a transaction between the branch and third party. Or if you don't write sale, I will get profit. We don't worry. We'll write opening stock. We'll write goods into branch. We'll write closing stock. So how will we get closing stock? Stock is there. Count and write. Ask the branch. They will tell you right. In our case, in question, we might have to do working opening stock plus purchase minus sales minus goods destroyed, issued, in transit to ಎಲ್ಲ ಮಾಡಿದ್ರೆ closing stock you get. That will put in the branch. But that then collection from debtors. If the collection is made by the branch, we don't write it. Why? It is again transaction between debtor and branch. If in case the debtor gives us money directly, our branch will collect and give us money, then we'll write it. We receive cash, cash account debit. Who gave it? Either a branch gave it or we have received it on behalf of the branch. So if in case there is cash received, entry will be cash account debit to branch account. Before that, we have two more things. If the goods are returned by the branch, we had given the goods to branch, branch returned the goods to us. We'll write the entry ulta. We wrote branch to goods into branch. We'll write goods into branch to branch. Branch doesn't have to pay us money anymore. The money that the branch should pay us will decrease. Got it? And for bad debts, no entry. Why? It is a transaction between branch and debtor. We'll write opening balance of debtor. We'll write closing balance of debtor. Difference, sales, so bad debts, so collection, everything will get adjusted. It will affect P&L ultimately. You're getting it? Weird, no? But works. But works. You're still not able to place no journal entry for this. But you don't have to mug up all the journal entries. Only remember that transactions affecting head office and branch are recorded. Transactions affecting branch and third party are ignored. Let's start. Branch remits cash over. Cash paid by customer to head office directly, or branch is collecting the cash and paying us. Both the times same entry. Either customers directly pay me the money, or branch collects the money from customer and then pays the money. Same entry. Why? We received from the branch, or we received on behalf of the branch. We have received it from the branch, or we received on behalf of the branch. So either ways, we'll write the entry cash account debit. The money that the branch owes us is reducing because they've given us the money. After that, then goods sent to branch but not reached branch yet. See, I have sent the goods, but it's still in transit. We call this Gita, goods in transit account. If you don't write this Gita account, this stock will become part of closing stock. But it is not in stock with the branch. At the branch in the godown, if you count, it's not there. So just to ensure that it is not part of the closing stock in the branch, we write it as Gita to branch. Call it as Gita to branch. So Gita is asset. Gita is asset. Now in the branch ledger, opening balances will write on the debit side. Stock, asset, cash, petty cash, everything. Closing balance we write on the credit side. In this closing balance, what we write on the credit side? How do we get stock? How do we get? In the branch, how much stock is there? We'll count and write. Or we'll call the branch. They will tell how much stock is there. We'll write. Do you agree with me? When the branch calls and tells us, in this stock, will this goods in transit be recorded? Why? It is not reached the branch. Why? It is still in transit. Transit and still coming on the way. Not come yet. Are you getting? If you don't write that, you will not be able to find the correct profit. Right. So what do we do? Closing stock is there. Will not include in closing stock. Just above closing stock, I should write Geeta. What should I write? So I'll write Geeta to branch. So in branch account, I'll write by Geeta. Similarly, we have Sita. What is Sita? Cash in transit. Cash in. See, cash opening balance on the debit side in branch account. Closing balance on the credit side. Right. How do we get to know how much cash is there in the branch? Branch will call and tell this much cash is there, and the head office will write the entry. Now, if send some cash, it's still in transit. It's not possible right now. Long ago, they used to send the cash physically by way of transportation, communication, or money order or something. Now it's not like that. Now I say 10, I'll say, okay, Banta, you call, no? Correct or not? Previously, it used to be like you send after 1 week, they receive. Now, before you send them only, you will call. Now I'm sending money. Okay, now I'm sending. Okay, send, check. Did you get? Like that. No. Today I paid auto fellow. The moment I got on, I paid. Just imagine 7 years ago, 8 years ago, was it like that? No. When the money was sent to you, for you to check whether you got the money, you should take your ATM card, go to bank, go to ATM and then check balance. Or you should go to bank, open for the bank to open and then take your passbook, stand in the queue, give your passbook, edit, update it, then check. Then this used to be there. In the modern times, this Sita Anal is not possible. Sita Anal is not possible. In fact, international fund transfers will happen over a second. If you are doing some international contract and some international client has to pay you money, there they put send, here you receive money. Yeah, withdrawal, if you have not taken RBI permission for certain things beyond a certain forex percentage, they'll keep it on hold. You need to give the certificate to the bank and then you can do it. But otherwise, it can happen over the counter. But let's say there is Sita, cash is still in transit. In the closing balance, what we write, when the branch tells us, will it be returned? No, why it's not there in the branch. But if I don't write that cash, my profit will be wrong. Correct or not? It will be treated wrongly as expense because closing balance doesn't include it. We're finding balance in figure. So above this balance carried on, I'll write to Sita. To Sita. That's it. Sita account to branch. So in branch account, I should write by C. If there is normal loss, abnormal loss, no entry. Or how come? We'll write opening stock, we'll write closing stock. Difference automatically it will get adjusted. Are you getting it? Then insurance claim received by branch. We don't write entry. Why? It is transaction between branch and insurance. If head office is receiving money, we'll write the entry. Cash account debit to branch account. It is like branch has given us. And profit at the branch is found as balancing figure and it is transferred to head office P&L. It is transferred to where? Head office P&L. So this is how your ledger will look. Now ಆ ಕಡೆ ಕಾಣಿಸ್ತಾ ಇಲ್ವಾ okay fine. So we'll write opening balances on the debit, everything, asset, debtors, petty cash, branch stock, the color whatever I'm saying. And these assets closing balance I'll write credits. During the year stock is sent, stock will increase, cash is given, petty cash is given for expenses, that will all increase. No, goods sent I'll debit. Branch, this is expense of the branch paid by the head office on behalf of the branch. For this again the head office has to recover money from the branch, correct or not? So this is like debtor account, they have to pay money, receivable is increasing, debit, and we've given them cash so that they can incur for petty cash expense. Again that has to be paid by branch to us, debit. You're getting it? Branch has given us some cash, branch has sent the goods back to us. These both we will write. Goods and cash we have sent, branch has not yet received, so that they don't have to give us. Why? It's not reached them yet. So decrease in debtors value. So I'll write here Geeta C. You're getting it? If there is any expense outstanding, opening balance, liability, no. Credit side, closing balance, debit side. If you write this much, balance and figure will be your profit, which will be transferred to head office P. ಸ್ವಲ್ಪ confusing ಆಯ್ತಾ? Consignment account ತರನೇ works like that too. Very much true. But there is an agent. Here, this guy is not an agent. This guy is you only. Your branch. Whenever we can't set up branches, we go for consignment. Consignment is much simpler form of business than branch. If you have to set up branch, that place has to be registered in your name. You need to appoint an employee. You need to have an employment contract and then give. Whereas consignment is much simpler. Agent, this time I'll send goods. Next time I won't send. Branch opening is too many things involved. Goods in transit and cash in transit. See, this is like debtor account. Agree with me? There are two ways to know. Okay. Number one, this is like debtor account. Whatever stock you give, whatever assets you give, whatever cash you give, they should give you money. Correct? They have not received this. So much they don't have to give. So decrease in asset. So credit side. One way. The other thing is you have sent cash, it is written here. You have sent goods that you have written here. If you don't decrease it, it should come part of this branch stock here and branch cash here. It is not included in this, no. Why? It is not received by the branch. Correct. So we'll write here separate. In the next period, you know what will happen? Here you will get opening balance. No. In this opening balance of cash only, that Sita will get included. And in this opening balance of stock only, that will get included in the next year. Dang it. The next year there will be no opening Sita Gita. Only closing date pe Sita. In the next year opening, it will get included in cash and it will get included in stock. Got it? Confusing it. That's it. So certain transactions also, whatever might be confusing to you, I have put. Sales made at branch, whether cash or credit, should not be included. We write it. However, it will be used to arrive at closing inventory. To find the closing inventory, we should use this. We should do one working note. That working note you write in the form of ledger, that will become branch stock account under stock data system. You getting it? Cash received from debtors or bad debts, discount allowed to debtors. We won't write any entry. We won't write any entry. However, if they don't give closing balance of debtors, you will do one working note. Opening debtors plus credit sale minus bad debts minus discount minus cash received to find closing debtors. There we need it. That plus minus, if you write in the form of ledger, that will become branch debtors account under stock debtor system. Second method. Are you getting it? You might not have done this in class, but any question, the same question what is there in the book can be solved under debtor system, stock debtor system, and final accounts approach, and you'll get the same answer. Usually, what you do, first 4 questions, debtor system. Next 4 questions, stock debtor system. Last 3-4 questions, final accounts. That's not how. Any question in the chapter, if you pick for the same question, we can do debtors, stock debtors, and final accounts. So shall we do one question? So this goods can be sold at I'll finish off the concept and then this stock what is sent, no, in order to not disclose the cost price, it can be sent at invoice price. Invoice price hege antidare, cost price is here, selling price is here. This much profit, no, everybody gets to know. Why? In the goods when it is sent, you tell cost of the goods is 10,000. Branch will sell it at 1,50,000. Branch gets to know that head office is making 50,000 profit. So the branch manager can leave the branch, become a competitor. Everyone gets to know the profit. Should you disclose your margins? You never disclose your margin. You never disclose your profit margin. So in order to hide the margin, what we do, there is 100 rupees cost, 150 rupees selling price. You will put one barricade called invoice price, 130 rupees. So whenever I send the goods to branch, I'll write it at 130. So people at branch think that the profit is only 20. Are you getting it? Profit is 20, which is disclosed. 30 rupees not disclosed. Together 50. But in the branch account, if I write opening stock at 130, if I write goods sent to branch at 130, if I write closing stock at 130, profit what I get will be only 20. No, why? Sales will be at 150. Cost is 130. We'll get only 20 profit. But that is wrong. So what do? I would have written opening stock 130, closing stock 130 into number of units and goods sent 130. That I can't change. So what do? That 130 I should make 100. How do I make 130 as 100? Remove the load on the opposite side. Opening stock which is on the debit, on that load is removed on the credit side. If I write 130 on the debit side opening stock, I write 30 on the credit side. Closing stock, if I write 130, I remove the load on the debit side by writing stock reserve. On the opening and closing stock, we write stock reserve. Opening stock debit, if it is at invoice price, load will be removed on the credit. Closing stock is credit, if it is at invoice price, load will be removed on the debit. Goods sent to branch is debit, if it is at invoice price, load will be removed on the credit. You getting it? Sales will be at selling price, we'll get the profit. This opening stock debit, if it is at invoice price, load removal will be on the closing stock will be on the credit. If it is at invoice price, load will be on the goods sent to branch is on the debit. If that is at invoice price, load will be removed on the goods sent to branch return will be on the credit. On that load removed will be on the, understood this, everyone? Okay. Now, opening stock, closing stock would also be there in balance sheet. Would also be there in the balance sheet, asset side, stock will be recorded at 130. Wrong, no? In the balance sheet, goods will be recorded at invoice price, because of which balance sheet is also wrong, showing wrong position. In the balance sheet, asset side, stock should be 100. You wrote it 130. Asset side totally increased. What will be the impact? Liability side, in the profit, you would have booked 30 rupees profit without even selling the goods. But stock is with you only, no? It is with your own branch, your own stock. Have you sold it? No, cost 100. But you're recording the stock in the balance sheet asset side at 130. Because of it, 30 rupees you have increased, no? Obviously, when you increase the value of stock 30, it will go to profit. Am I right? That's the reason no people play with stock. Correct or not? So what do you do? That profit should be removed. That profit should be. So what do we do? When we remove the value of the stock, we call it stock reserve. What do we call it? We reduce, no, in our branch account. Opening stock is on the debit. We remove on the credit side. That credit we write by stock reserve. By, so in the balance sheet liability side, we'll write stock reserve 30. If we don't write stock reserve 30, that will get included in reserves and surplus P&L account balance. To the extent of unrealized profit, that is load on the stock which is left unsold. Understood? We don't have balance sheet here, but I'm just trying to tell you why do we do that. And similarly on the closing stock, that, my friends, is the reason why in our branch account on the opening and the closing stock, load is removed by using the word stock reserve. Load is removed by using the word. However, on the goods sent to branch and goods sent to branch return, we don't write the word stock reserve. We write load on goods sent to branch, load on goods sent to branch return. We use the same name. Let me repeat. Opening stock is on the debit. It is at invoice price. We remove load on the credit. What do you write on the credit side? Stock reserve. Closing stock is on the credit. It should be at cost. If it is at invoice price, load will be removed on the debit. What would I write there? To stock reserve. Goods sent to branch is on the debit. On that, when I remove load credit side, what do I write? By load on goods sent to branch. By load on, and goods sent to branch return is on the credit. If it is at invoice price, I should remove load on it on the debit. What do I write? To load on goods sent to branch return. I won't write what to say stock reserve. Understood this? Okay. Listen to this. Okay. Removal of load on opening stock. Entry is stock reserve account debit to branch. So in branch account, I should write by stock reserve. Credit side. By debit side, there is opening stock. Credit side will see the closing stock. What is the entry? Branch account debit to stock reserve. So debit side, I'll write stock reserve. Why? Closing stock is on it. With regard to goods sent to branch, entry is branch to goods sent to branch. When the goods are sent, removal of load will be ulta, goods sent to branch. Or I can say load on goods sent to branch. And later that load on goods sent to branch is transferred to goods sent to branch. Why? We reduce goods sent to branch from where? In head office books. Very good. Purchase. From where do we deduct? Entry. What is the entry when the goods are sent to branch? Am I discussing too much? Understanding? Branch to goods sent to branch to purchase. Correct? I purchased 1000 rupees worth of goods to sell in my head office. In that 100 rupees worth of goods I've sent to branch. So in my trading account of head office, purchases 1000, but I'm not selling 1000. 100 is sent to branch. So 1000 I should reduce by 100 and write 900 in the order column. Correct or not? Okay, yes sir. Hello. Okay, fine. Now tell me, I'll judge you. Okay. From 1000 you will deduct 100 and then write 900 in the outer column. If it is sent at invoice price, can you deduct 130 from 1000? No, it will become wrong. So you should deduct only 100. But goods sent to branch is at 130, no? Correct or not? So if you write goods sent to branch at 130, 30 rupees load should be deducted from goods sent to branch. To make goods sent to branch 100. So that from the purchases, what we deduct is 100 and not. This is everything like you want to hide something. So you did mistake. You remember how much mistake you did and correct so much mistake. So it's like you don't want to tell truth to someone. So you told someone a lie. You remember the lie that you told, and then every time whenever you're telling, you should build up on that lie. You're getting what I'm trying to tell? Because once you lied, you can't step back, no, from that. So ಆಮೇಲೆಲ್ಲ ಆ ಲೈನ್ ಜಸ್ಟಿಫೈ ಮಾಡ್ಕೊಂಡು ಹೋಗೋದೇ ಆಗ್ತದೆ. Got that? Yeah. So that's this part. And once you're done with that, this is how your ledger will look under invoice price method. Assets you write here, same to same what we've discussed before. Assets closing balance here. Done. And goods are sent to branch here, then goods sent to branch returned lala. If the cash is spent on expense of the branch, that also has to be recovered here. And if the branch you're sending cash to branch, that also needs to be recovered, so we'll write here. And if the branch has outstanding expenses, liability opening balance here, liability closing balance, then Sita Gita, because it should not be included in closing, we've written it separately. And when the goods are sent to branch but it is returned by the branch, credit side. Done. Now comes the fun part. This stock should have been at cost, it is at invoice price, so I remove load here. This is at invoice price, so we remove load on that here. This goods sent to branch are returned, no, this is at invoice price, on that we remove load here. This closing stock is at invoice price, on that we remove load here. See everything yellow with only the cash what is sent by the branch to head office, collection from debtors type decrease. Aita, then you'll ultimately find your branch profit balance. Now, should we do one question on this method now and then go to stock data, or should I finish stock data system, final account system, and then do question? One question ಮಾಡೋದಾ? One question. I'll tell you the question number. Question number 1 ಮಾಡೋಣ. Buckingham Brothers. People think branch is redundant, but if you get into a bigger company, they'll have several branches, and then that inter-branch transactions, that reco and all reconciliation, that will be a major part. So practically also very much relevant, because a lot of this inter-branch transactions, adjustment, indebtedness, this unrealized profit, all of these transactions, when they do know, they don't do it in a proper accounting package, they do it in Excel, and then they pass the net effect entry in the books. And when the accounts are made at the end of the period at regular intervals, monthly or quarterly, you would need, say, information records for decision making, MIS records and other. Or whenever you're going for due diligence, or whenever you're going for new investor, they would ask you a lot of questions. So then you don't do those changes in the accounts to answer them. What you do is you make adjustment entries in the Excel, then generate a report to show it to the investor. Okay, come on. Let's quickly start with first one. Should I clear the entire thing and then start the answer from the scratch? If you think that is difficult to you. Question number 3 ಮಾಡ್ಬೇಕಾ? I had put question number 1 here. If I have to do question number 3, then I'd have to open another Excel sheet. Third one ಮಾಡ್ಬೇಕಾ? ಖುಷಿನೇ ನನ್ನ ಖುಷಿ. Third one ಮಾಡಿದ್ರೆ ಖುಷಿನಾ? ಫುಲ್ ಖುಷಿ ಅಂತೆ. One moment, I'll open another sheet. If we end up doing this chapter in detail, we might do other chapters slightly less. ಆಯ್ತು ಪುಟ್ಟ, ನಾನು ಹೇಳ್ತಾ ಇದ್ದೀನಿ ಅಲ್ವಾ, if you do something more, you would have to do something less. ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಬೇಡವೇ ಬೇಡ, ಬೇರೆ ಯಾರಿಗಾದ್ರೂ ಬೇಕಂದ್ರೆ. Okay, let's do illustration number 3. Yapi, come to illustration number 3. Let me open the question 5. Some of them don't have no question 5. Everyone has material. Page number 2. Okay. This one. Should I clear the complete answer and then start the answer from the scratch, or show the answer and then mark it yellow? Whatever makes it happy, whatever makes you happy. Mark it yellow. So whatever is not yellow, you should not see. Act like jaundice will. Let's start. So XYZ is having a branch in Kolkata. Goods are invoiced to branch at 20% profit on sale. So we'll finish invoice price on this one. So it is sold at 20% profit on sale. So invoice price is 100, profit, that margin is 20, and then cost is 80. Branch has been instructed to send all the cash daily to head office. Whatever cash they've collected, immediately same day they'll send it to head office. All expenses are paid by head office except petty expenses which are made by branch manager. Is obvious. From the following particulars, prepare accounts in the books. The stock on 1st April 2011 at invoice price, it is 30,000. What is it? 30,000. Opening balance, where do we write? In the stock, in the branch debtors account. Debit side will write opening stock. Branch stock. How much? 30. Shall I do that? Observe here. Branch to balance brought down. Branch stock. Branch stock at invoice price. How much? 30,000. On this, the load has to be removed on the opposite side. Do you agree with me? How much is load? 20% on sale. This is basically our sale price or invoice price in this case. How much will be load? 20% of 30,000. 6,000. I should deduct 6,000 from 30. I can't deduct it in the same side. I'll write it on the opposite side. If it is goods sent to branch, I will write buy load on goods sent to branch. This is opening stock. So what do I write? Stock reserve. On the credit side, I have written stock reserve. Removal of load on stock, 6,000. Okay, now. It is not profit. It is stock what is there in the branch. We should have recorded at 24. We have increased the price. Now we will decrease it. We recorded a price higher than the cost. We are bringing it back to cost. It is not profit. It is profit only when the goods are sold. It is profit only when the goods are sold. No, it is it is profit when head office gives the goods to branch and the branch sells it to somebody. If I have given the goods to branch, it is not profit. You agree with me? Why? Branch closing stock, it will be there. Branch closing stock is my closing stock. I moved goods from this godown to this godown and then say I made profit. Is it correct? No. From that godown, if it goes to customer, then profit. I am not telling you it is not profit. It can be. I don't know. I don't know. I don't want to. I don't want to know. Are you getting it? Right, sir. Clear? Shall we read the next line of the question? What is after that? And question always read in the order. Don't read one line here, one line here, one line here, one line here. I will not tell anything. So read the question in one order, solve the answer in one order. Don't do here, there, here, there. Next, sundry debtors, 1st April 2011, 18,000. Opening balance of asset. Where do we write? In our branch account, debit side, two balance brought down. There only will write stock, debtors, cash, petty cash, asset. If there is any other asset, that also there. We will write sundry debtors 18,000. Observe here. Sundry debtors 18,000. Are you getting it? What is after that? Cash in hand. Opening balance. Again, same place. 800. Cash in hand. That is petty cash balance. 800. Okay. Then Api's furniture 3,000. Furniture is there in the branch. That is our furniture. Belongs to us. Our asset. Branch has to pay us for that. So again, in the balance, when I write balance brought down, I'll include their office furniture. Very good. Goods invoiced from the head office. Invoice price 1,60,000. What is the entry when the goods are sent to branch? Branch account debit to goods sent to branch. In other words, you have given this much goods to branch. Branch has to pay you money for it. Debtors is increasing. Debit side. What do I write? Two goods sent to branch. But this is at invoice price 1 lakh. Is that invoice price 1 lakh? It should not be at invoice price. It should be at cost. But I already have written at 1,60,000. Shall I write 1,60,000 in the inner column and then deduct load? I'll write on the opposite side. Shall I write stock reserve? No. Stock reserve is only for opening and closing stock. No, what will I write? By load on goods sent to branch. Or you can write by goods sent to branch account only. You still accept. So I will write here. By goods sent to branch. Removal of how much? 20% on selling price or invoice price. 1,60,000 into 20%. 32,000. Everyone understood? Sure? Can I go further? What is after that? Goods are returned to head office. 2,000. So when we send the goods to branch, we wrote branch account debit to goods sent to branch. When branch sends the goods back to us, we should write goods sent to branch account debit to branch. So in branch account, I should write buy goods sent to branch return at invoice price 2000. It should have been recorded at cost. We recorded at invoice price. On this 2000 which is there on the credit, load will be removed on the debit side. How much is load? 2000 into 30%. So here I'll write, sorry, 20%. Sorry. 2000 into 20. Sorry, not intention. 400. Okay, na? ಮತ್ತೆ ನಾಳೆ ಕ್ಲಾಸ್ ತಗೊಂಡು ನಾಳೆ ಕ್ಲಾಸಲ್ಲಿ ಹೇಳ್ಬೇಕಾಗುತ್ತೆ. Today when we were doing branch by mistake, I told 30 in the place. I can tell it was not my intention to tell wrong. I would take necessary care that I will not repeat it next time. 1 year ಆಗಿದೆ. Not understand the ಮದುವೆ ಆಗ್ಲಿ ಗೊತ್ತಾಗುತ್ತೆ. Cash received from debtors 60,000. When the cash is received from debtors, what is that? It is as good as we receiving the cash from branch. Am I right? Entry will be cash account debit to branch. Sir, no sir, it is received by branch. Why do we rate? They told no, any cash received is immediately sent to head office. Branch has instructed to send all the cash daily to head office. End of the day, cash box mein 1 rupee and 1 lemon bittu ulidella cash they take and they give it to us. Take it. Correct? No, that 1 lemon will be there. Remember. ಪಂಚಂಕ್ರಮನ್ ದೇವಸ್ಥಾನದಿಂದ ತಗೊಂಬಂದಿಟ್ಟಿರೋದು ಇರೋದಿಲ್ಲ ಕ್ಯಾಶ್ ಬಾಕ್ಸ್ ಆಲ್ವೇಸ್ ಮನೆಯಲ್ಲೂ ಇರುತ್ತೆ ನೋಡಿ ಲಾಕರ್ ಅಲ್ಲಿ ಅಮ್ಮನ ಹತ್ರ ಕೀ ಇಸ್ಕೊಂಡು ಸತಿ ನೋಡಿ ವಿಲ್ ರೈಟ್ ಇಯರ್ ಬೈ ಬ್ಯಾಂಕ್ ಆರ್ ಕ್ಯಾಶ್ ಹೌ ಮಚ್ ಇಸ್ ಕಲೆಕ್ಟೆಡ್ ಫ್ರಮ್ ಬ್ರಾಂಚ್ 1,60,000 1,60,000 ಅಷ್ಟೇನಾ ಏನಾದ್ರು ಇದೆ so actually 1 lakh and then next entry is 1 lakh sorry 60 and then 1 lakh together 1,60,000 is collected. It is like realization from branch or received from branch. Asset is decreasing, so credit. Understood? Then credit sales. Do we write entry? No, we don't. Why? This is the transaction between the branch and customer. Head office will not write entry. But if they give closing stock, good. If they don't give closing stock, we should find the closing stock. So there we'll take, what and all do we take? We'll take the opening stock 30. We will add goods sent to branch. 1,60,000. This will deduct this 2,000. And then goods returned by debtors 960. Debtors have returned it back to, so we'll deduct this also. Sorry, we'll add back this also. Cash sales we will deduct. Why? Goods are going out, no? So we'll deduct this cash sale and credit sale. That is how we find the closing stock. If they give, very good. If they don't give, we will find it. If they give, very good. If they don't give, we'll find stock. Opening stock plus purchases plus sales, sorry, minus sales plus sales return is equal to closing stock. If they give, good. If they don't give, we'll find. Do we know right now that whether it is required or not? No. No. Chill madi. Relax. Will we go ahead? Next, discount allowed to debtors. Do we write entry? No, we don't write entry. Ignore. Why? This is transaction between debtors and third, what to say, debtors and branch and third party. Understood? If in case they give closing debtors, good. If they don't give closing debtors, then we would need this. Why? Opening balance of debtors plus credit sales minus cash collected minus discount minus bad debts. You should do that to find the closing debtors. Do we know right now closing debtors is given or not? Now you don't do. Now relax. Ignore. Then expenses paid by head office. For this we write entry. What is entry for expenses paid by head office? It is like we paid money to branch. Branch account debit to how much? Rent to salary, stationery. Again, Bekar Kudi. We'll write the entry as 1,800, 3,200 and 800. 4,000. 5,800. Branch account only 2 cash. 5,800. Correct? Did you understand? After that, petty expenses paid by branch. Do we write entry for the 600? Don't write entry. You know, if they give us the closing petty cash balance, good. If they don't give us the closing petty cash balance, then we should use this. By opening balance of petty cash plus further money given by way of petty cash less petty cash expense paid to find the closing balance. That will be working. Will be then depreciation to be provided. We don't consider. If they give closing balance of furniture, ignore. Write closing. If they don't give closing, opening balance of furniture minus this to find the closing balance. This will not come in our branch. Then stock at invoice place. Stock they've given. We don't have to complete. If they would have not given, we were supposed to. How much is stock? 28,000. 8,000 at invoice price. Shall I write here credit side by balance carried down? How much is stock? 28. This is at invoice price. I should remove 28%, 28,000 into 20% on debit side. By what rating? To stock reserve. How much? 5,600. Just 5,600. What do we have after that? Question. Question. Okay. Check whether all the opening balances we have written closing balance or not. On after that you find profit. Debtors, cash, asset. Debtors, cash and assets. Have we written them? We have not written those values. We should find it. First we'll start with branch asset. Branch asset opening balance is how much? 3,000. Depreciation is 10%. 3,000 to 10%. 300 decrease depreciation of 10% will get 2,700 as closing. Understood? Okay. After that, next item is debtors. Debtors will find 18,000 is the opening balance. Take in your calculator 18,000. 18. Sale, credit sale. Add 60. Deduct discount 160. And cash collected is there. Deduct this 60,000. Cash received from debtors. And also deduct 960. Did not understand what not to deduct? Okay. ನಾನು ಇನ್ನೊಂದ್ಸತಿ ಹೇಳ್ತೀನಿ ಕೇಳಿ red. Okay na? So take sundry debtors 18,000. Branch debtors. ಇದರಲ್ಲಿ ಬ್ರಾಂಚ್ ರೆಕಾರ್ಡ್ ಮಾತ್ರ ಮಾಡ್ತಾ ಇದೆ. ಹೆಡ್ ಆಫೀಸ್ ಎಂಟ್ರೀಸ್ ಮಾಡ್ತಾ ಇಲ್ಲ. We are not doing head office entry. Head office entries we will do in trading account of that. 18,000 is the debtors opening balance. To this, how much is the credit sales made? How much is discount given? 160. So 18,000 plus 60,000 minus 160 minus the goods that they gave back 960 minus the cash we have received 60,000. Ashte alla? How much do we get? 16,880 will be our branch debt. Similarly, here we have petty cash. How much is opening balance? We should find the closing balance. How do we find? Take this. Now I'll use different color. Which color? Brown. 800. Did you take 800? Then what is the cash sent to branch for petty cash? Petty cash expense paid by the branch. Deduct this 600. Is there any petty cash sent to branch anywhere? Not there. So from 800, 600 is paid. What is remaining? 200. Done. When you write all of this, you take the total on the credit side, total on the debit side, balance and figure is whatever we did now, no, it can be found as working note. Load invoice price. We can compute it. And next thing, that closing debtors, closing petty cash, cash remitted, all of this also we can do detailed working note. Sir, will we get marks for this working note? For these working notes, you don't get marks. But they are part of the answer. Only working note barade marks kododilla. Don't expect marks for writing only working note for these things. Are you getting it? So I'll share this sheet with you all where solution to all the chapters are there. Branch, incomplete record, department, insurance claim, all the questions. And for everything, every item, it's not just written. How did we get that amount is presented in. Yapi na? Closing stock? Kotilva. Closing balance of debtors. They have not given. We found it, no? Stock kotilla. Stock kotilla we should find. But whatever stock that we find now might not or need not match with 28,000. Why? There might be normal or abnormal loss. What do? We take opening stock. We'll add goods into branch. We'll deduct sales. But everything should be done at invoice price. Opening stock at invoice price. Very good. Goods into branch at invoice price. Very good. Sales will be at selling price, what they've given here. That selling price should be brought down to invoice price and then we should deduct it. Such question is also there. That question is also there. I'll tell you which question mein stock has to be found. One of the question. See, branch stock has to be found. Question number next question. Question number 4. Question number 4. Opening stock we know. Goods into branch we know. Goods into branch returned we know. Sales we know at selling price. We'll write the sales at invoice price and then deduct it.
See what is the stock, what is the sales that is given in question number 4. Next question. Okay, no. See the sales, sales 9,700 and 3,140. Am I right? Here I have not taken 9,700 and 3,000. Sales is made at invoice price only in this case. Sales is made at invoice price ಅಂತ ಕೊಟ್ಟಿದ್ದಾರೆ. If they told sales is made at 20% more than invoice price, from sales we'll eliminate that 20% and then find the sales at invoice price and then take it. You getting it? Such relationship will be given. Depends, sir. 8 marks ಕೊಡಬಹುದು, 10 marks ಕೊಡಬಹುದು. I'll tell you something. There is actually no standard blueprint. I can tell you certain same question when it is asked more than once in the examination. There are few questions which has been asked more than once in examination. Same marks ಕೊಟ್ಟಿಲ್ಲ. Certain times the same question which was asked for 12 marks. In another exam it's been asked for 10 marks. You getting what I'm trying to do? They can play. There is a possibility to play with that. And that's how paper becomes difficult. Paper becomes difficult means they won't ask an out of the box question. 12 marks question illa 10 marks ಕೊಟ್ಟು. So they would have to actually write for 120 marks in an 100 marks paper. So then it will obviously become difficult. It will look difficult. That's how paper becomes difficult. And at CA final level, when they introduced the costing and case-based questions, the same questions what were there in costing were actually there in this SEMA exams and USCMA exams for 40 marks question. That 40 mark question ತೆಗೆದುಬಿಟ್ಟು ನಮಗೆ 20 marks ಹಾಕಿದ್ರು. That's how it used to be there. So at ICA, what happens is you will be asked to do more things for less marks in less time, because that is the requirement of the hour. These many returns to file by with this much time, because you want this much money. Getting it? See, compare the population of US and compare the population of India. Which country has more population? India. US has more certified public accountants, CPS, than what India has. There are so many CPS. That is the largest accounting body. No, how does something become largest? Number of members are more. No, you're getting it? So with country with less population has more CPS. Country with more population has less chartered accountants. CPA in USA is nothing but CA in India. You're getting it? How do they survive? There, that's the reason. There, everything is expensive. People like the one who sweeps and then mops only will ask for your kidney and lungs. That's how expensive it is. So in our country, lot of things are cheap. But it's very, very affordable. So people who give accounting services, taxation services want to have a very posh life. They want to charge premium money. So this is still a premium service in the country. Getting? So to keep that as a premium service, you should charge high. When is it that you can't charge it? There are too many people giving services. Too many people should not give services. Too many people should not pass. If too many people should not pass, the course should become demanding. And because the course is demanding and there are not too many professionals, too much work to do from too many less people. That's the trick. So to be able to handle that pressure as a chartered accountant, you should be able to handle that pressure as a student. So CA examination is basically a stress test. Will you survive as a chartered accountant, or will you break as a chartered accountant? So no chartered accountant will go, oh, I can't do this. You won't do that. Why? In exam, you can't do that. No. So you've gone through all those levels and you've been so polished and then crushed that you become a diamond at the end. The diamond will only shine after you become. Ako sir. Pradeep Ishwarad ನೋಡ್ತೀವಿ. You next topic. ಆಯ್ತು. I will do the next one. Yeah. ಮೊಟ್ಟೆ ಅಂದ್ರೆ ನೆನಪಂತು. ಮೊಟ್ಟೆ ಹೊರಗಡೆಯಿಂದ ಹೊಡೆದ್ರೆ ಆಮ್ಲೆಟ್, ಒಳಗಡೆಯಿಂದ ಹೊಡೆದ್ರೆ ಮರಿ ಬರುತ್ತೆ. Shall we go to next topic? Next we'll go stock data system. Generation the biggest ರೋಗ ಏನು? ಕೋವಿಡ್, ಕ್ಯಾನ್ಸರ್, ಹಾರ್ಟ್ ಅಟ್ಯಾಕ್ ಅಂತ ಏನು ಅಲ್ಲ. ಯಾರು ಏನ್ ಅನ್ಕೊಳ್ತಾರೆ ಅನ್ನೋ ಭಯ. ಬ್ರದರ್ ಬೈಸ್ಕೊಳ್ಳಿ ಬ್ರದರ್. 10-15 ಹೇಳ್ತೀನಿ ಕೇಳಿ ಬ್ರದರ್. ಹೇಗೆ ತೊಳ್ಬೇಕು, ಓದ್ಬೇಕು, ಕಷ್ಟಪಡ್ಬೇಕು. ವಯಸ್ಸು ನಿಮಗೆ 7 ವರ್ಷ ಆಗಿತ್ತು ನನಗೆ ಕಳ್ಕೊಂಡಾಗ. I saw some reel someone had sent. Our king of inspiration, drone uncle, is sitting and then listening. And then this guy is giving inspiration. He's telling how to motivate people. Pratap is like, inta space na next ಕೊಟ್ಟಿಲ್ಲ.
Let's start with the second method, stock debtor system. Stock debtor system is actually debtor's approach. The debtor system we do know. Same thing. That one ledger has how many opening balances? 4-5 opening balances. 4-5 closing balances. For each opening balance, we'll open one separate ledger. Stock opening balance, goods sent to branch, goods sent to branch return, closing stock. We'll write it in one ledger, branch stock account. Opening balance of debtors, closing balance of debtor. Are you getting it? Credit sale we didn't write. Cash collected from debtors we didn't write. That we'll write now in one ledger. That's called as what? Discount bad debts. That will become our branch debtors. And opening balance of petty cash, closing balance of petty cash sent to branch. These three will pick. We'll write in one ledger. They will write branch cash spent also. That will become our branch cash. Are you getting it? Each of the ledgers in branch stock account, balancing figure, transfer to branch PL. Branch expense account, balancing figure, transfer to branch PL. Petty cash account, balancing figure, transfer to branch PL. Debtors account, bad debts, and then that discount allowed, all of this transfer to branch PL. And in the branch PL, after rate all of these items, what you'll get is the same profit. You'll get same profit. And then common items will get, if you eliminate and then write them one over the other, it will become branch debtor. Sorry, branch debtor system. Do you understand this? Now come on, read this. It is improvised version of debtor system. Under debtor system, though we ignore transactions between branch and customer, we still consider and in closing balances computation. Where is this? In debtor system. And here what do we do? There we do in one ledger, one working note, we do no plus minus. That working note will become ledger account here. What do we do? Like memorandum stock and memorandum debtors account, we prepare that small working note. Under which approach? Debtors approach. Under stock debtors approach, what do we do? We open one separate ledger. There we do kuti working note to find closing balance. All of that will become ledger. We prepare an account called branch stock account, branch debtors account, branch expense account, branch cash account, and all the balancing figures are transferred to branch P&L account. Branch stock. Why do we prepare branch stock? To determine gross profit. We don't call it gross profit. We call it surplus. If there is gross loss, we don't call it gross loss. We'll write deficit. And then branch debtors to determine the balances of debtor. And branch cash, branch expense, branch PL. Balancing figure in stock, debtor, cash, and expense is transferred to branch PL. And here we find the profit of the branch. And there we used to remove load within the branch account. We'll open one more ledger called branch adjustment. Branch in the branch stock, debit side, if opening balance is at invoice price. Branch adjustment, credit side we remove load. Goods sent to branch in branch stock account debit side, removal of load, branch adjustment account credit side. Closing stock, branch stock account credit side, removal of load, branch adjustment account debit side. And branch adjustment account may we get difference, that is also transferred to branch PL. Ultimately, you'll get the same answer. You're getting it? I don't want to waste time discussing journal entries, but what I did is for each entry under debtor system, right next to the same transaction, I written the entry under stock debtor system so that you get different. For everything, we wrote branch account, branch account, branch account. For stock sent, branch account. For debtors, branch account. For cash, branch account. For goods sent, branch account. Here we don't write them. Here we use branch debtors, branch stock, branch expense, branch cash, branch PL. We open separate ledgers. Here, branch stock. Here, branch expense, branch account. Here, branch expense. So we'll open separate ledgers. Branch debtors account, branch cash, branch expense. That. Are you getting it? Shall we solve a question? If in case available, same third question I didn't take up third question to discuss in the class because for third question I had not solved it under the other method. No, third question. Let me just check. Give me one. Because you'll find it nice for the same question. For the same question I have not solved. So 13th one ಏನೋ ಬರ್ಕೊಂಬಂದಿದ್ದಾರೆ ಯಾವ ಕ್ವಶನ್ ಮಾಡಿಸ್ಬೇಕು ಅಂತ. Okay, I have another question ready. I'll do what I've already kept it ready. Okay, so that will save little time. I'll share the solution to everything, guys, later. I want to do question number 1 so that we can finish the concept. We'll go a little further ahead also. 10 o'clock. We need to do 4 more chapters. Huh? ಅಲ್ಲಪ್ಪ ಈಗ ಉಳಿದಿದ್ದೆಲ್ಲ ಮಾಡಬೇಕು ಅಂದ್ರೆ ಆಗೋದಿಲ್ಲ ಪುಟ್ಟ. We have so much more to do. ಅಲ್ಲ ಕಣ್ರಿ ಎಲ್ಲ ಮಾಡಕ್ ಆಗೋದಿಲ್ಲ. ಸಾಲ್ವ್ ಮಾಡಿರೋದಕ್ಕೆ ಹೊಸದಾಗಿ ಸಾಲ್ವ್ ಮಾಡಕ್ಕೆ if it is ready I will do. I don't mind solving it from the scratch but we won't finish it within the time ತಗೊಳುತ್ತೆ. ಲಾಸ್ಟ್ ಅಲ್ಲಿ ಈಗ ಟೈಮ್ ಇಲ್ಲ ಸರ್. ಸಾರಿ ಡೋಂಟ್ ಫೀಲ್ ಬ್ಯಾಡ್. ಆಯ್ತು ಅದ್ರ ಮೇಲೂ ಬೇಜಾರು ಮಾಡ್ಕೊಳ್ಳಿ, ನಾನೇನು ಮಾಡಕ್ಕಾಗಲ್ಲ. All I can tell you is this will ensure that we won't cross the time limit and we will be able to do everything. If you have told your requirement in prior, I would have handled it. Let's do question number 1. Our method, I have solution to question number 13, but not in the approach that we want. Not under both the methods. Okay. Let's quickly finish question number 1. Quickly see question number 1. Yeah. So first we'll do it under debtors approach. Then we'll do it under stock debtors approach. The same question. Have a look. Opening balance, impressed cash, sundry debtors. This both where do I write? In our branch account debit side. Opening balance. So branch account debit side. Impressed cash 2000. Branch debtors 25. Correct. What do we have after that? Stock transferred from head office, direct purchase. There are two varieties of stock. Some stock head office is sending to branch. Some stock branch itself is buying. So how much is it? 24,000 and 16,000. I will write branch stock 24 plus 16. Together it is done. What do we have after that? Cash sale, credit sale. We will not write entry for these. We will write the entry only when the branch sends the cash to head office, not when the branch sells the goods to customer. Done. Then direct purchases. So directly goods have been purchased by the branch. Branch would pay cash against it. We will not write the entry. We will adjust it to find our closing cash balance. May write who's paying cash for this. If head office pays cash for this, then I'll write. If the branch has paid the cash, then we won't write. I think head office has paid up. A direct purchase are also made by the branch for which the payments are made at head office. Head office is paying the cash. So this is like branch expense paid by head office. What will be the entry? Branch account debit to how much? 45,000. Next, returns from customers. Customers have returned the goods to branch. We won't write entry. Goods sent to branch from head office 60,000. Branch account debit to goods sent to branch 60,000. It is not at invoice price. After that, transfer from head office for petty expenses. Okay, head office has sent cash to branch. So this is branch account debit to petty cash. This entry will be written. So much money is recoverable from the branch. No, 4,000. I'll write here to bank or cash. Our cash balance is decreasing at the head office. Head office is writing this entry. Understood? Then what do you have? Cash expense. No entry. When we adjust it and then find the closing balance, it will be fine. Head office has paid this one. No, branch has paid if I'm not wrong. Head office paid. No, branch has paid. No, don't worry. For petty cash, it's only the same thing. Amount illa. Transfer from head office for petty cash expenses. Sorry. Bad debts. No. Discount to customers. No. Remittances to HO. How much? 1,65,000. The branch account is write credit side by bank or cash. 1 lakh. Yeah. 1,65,000. 5,000 not received by head office. Sir, it is Sita. Sita is when it is sent by head office, not received by branch. It is not Sita when branch has sent and head office has not received. When is it Sita? Head office has sent it, branch has not received it. But when the branch has sent, head office in branch account will write, they have given us 1,70,000. In my cash account, I will not write. I'll write 1,65,000 and then 5,000 in my balance sheet, I'll write it as Sita. You getting it? Geeta also. I will not include in my closing stock. Just above my closing stock, I'll write Geeta. Getting it? Then after 1,70,000, branch expense directly paid by head office 30,000. Branch account debit to cash. Got it? Then closing balance. Stock they've given, debtors they've given. Debtors and impressed cash we should find. petty cash they've given, right? 10, 15 and 4 will write. So 10, 15 and 4. 10 and 15, no branch stock. 10 and 15 together is if 5. And what do we know? 4 another petty. Oh, this is cash expenses. Petty cash expenses paid by the branch. Maybe for that we will not write it. Paid by the branch will not write it. That will be used to find the closing balance. So now we don't know two things. One is petty cash, other one is branch debtors. How do we find branch debtors? Opening debtors is the question. The question 25 no. That is the expense paid by the branch ಅಂತ ಅನ್ಸುತ್ತೆ. Closing balances ಅಲ್ಲಿ ಕೊಡಬಾರ್ದಿತ್ತು, ಅದು separate ಆಗಿ ಕೊಡಬೇಕಿತ್ತು. Alignment is little gone for. Okay, and that petty word is petty cash expense paid ಅಷ್ಟೇ. Petty cash expense paid. 25,000 is debtors. So 25,000 debtors. How much is credit sales made during the year? Credit sales, credit sales, credit sales. 1,30,000 credit. And there is bad debts 1,000. There is discount to customers 2,000. Is there any return of goods by customer? Returns from customers 3,000. So 25 plus 1,30,000 minus 3 minus 1,000 minus 2,000 plus 1,30,000 minus 3 minus 1 minus 2. And there is some money collected. How much is collection from debtors? Collection from debtors. Where is it? Discount to customers, remittances to HO. Ilva. Collection from cash sales is 45 and 1,65,000 is the amount remitted. So if you adjust it, you will get how much is the cash collection. How much is the money that you sent to head office? 165, no. In that, how much is cash sales? 45. Correct? 45, if you eliminate, what do we get? 170. 5,000 is in transit. 165 plus 5. 170 we have sent. Cash sales are list month. 45. Remaining money, how did we get? Did we print? No. Collection from debtors. Collection from debtors is 125. It is not a very simple question also. One beda, one beda, one beda. Yeah. Collection from debtors is 120. If you deduct that, you will find the closing debtors balance to be 24. And that 24 will write here. Branch debtors 24. Understood? What is after that? Now you should find impressed balance. Impressed opening balance 2. What is the further cash sent for petty cash expense? How much is the expense incurred? 2 plus 4 minus 4. Understood this? We can do working note if you want. 2 plus 4 minus 4. And once you're done with this, we have everything marked in our branch account. Take the total on the credit 170 plus 2 plus 24 plus 25. We get 221. From 221, start deducting all of this. 2, 25, 40, 60, 45, 4 and 30. Get profit of 50. This is under which approach? Debtors approach. Now let's do stock debtor system. Will we do stock debtor system? Under stock debtor system for the same thing. Let us say we're starting with branch impressed cash. Branch impressed cash. So ಈ branch impressed working out ಮಾಡಿದೀವಿ ನೋಡಿದ್ರಾ? Opening 2, received 4, spent 4, closing balance 2. Correct? 2 ಹೋಯ್ತು, 4 we collected, 4 we spent, balance is 2. Observe the account here. Opening balance 2, cash received from head office 4, branch expense 4, and then closing balance. Understood? In impressed cash account, I have done by branch expense. Am I right? In branch expense account, ಮಾಡಿಲ್ವಾ? Right away we posted to P&L. Expense is how much? 4. We can actually open one branch expense account if there are too many expenses. There on the debit side I'll write by branch cash. On the credit side I'll write 2 branch P. Now what I'll do, in impressed cash account I've written by branch expense, we'll go to P&L. In P&L account I've written by branch cash, by branch expense. How much is that? 4,000. Understood? Next I'll open one more ledger called branch debtors. Here we did debtors working note. What now did we do? Opening 25. Correct? Move this. I'll do it again. How much is opening balance? 25. Am I right? That 25 I'll write here. Opening balance. What is the next item that we have written here? Credit sales of how much? 1 lakh 30. I will add 1 lakh 30. I'll write again in branch debtors, branch stock 1 lakh. Then what is there? Sales return, bad debts, discount, collection. 3, 1, 2 and 125. I'll write here. Sales return, bad debts, discount and collection. 3, 1, 2, 125. Are you getting it? Then we'll find the closing balance. This branch stock only 3000 barat. What is this? Sales return. In branch debtors, if I write by branch stock, in branch stock I should write 2 branch debtors 3000. And this discount and bad debts 1 and 2 expense. In branch debtors I have written branch PL. In branch PL I'll write 2 branch debtors 1000 and 2000. Bad debts and discount. Got it? Anything else that's left here? In branch debtors I have written branch cash 125. In branch cash I'll write 2 branch debtors. How much? 2 branch debtors, no? 125. Understood? Very good. So branch stock, branch interest account you understood, branch debtors you understood. Now we'll do branch stock. How much is the opening balance of stock? We have it in the question. I think we have not done working out for it. I think entire data was given to us in the question. Opening balance is how much? 24 plus 16, 40 in our branch stock account. 24 plus 16. How much is purchases made? There is some one entry called purchase made. No. So this is over. 24 over. How much is direct purchases made? 45. Again, this cell right. Branch account debit to cash. Then credit sale, cash sale together. 45 and 1 lakh 30. This is decrease in stock. No. In my branch stock, I'll write credit sale. Cash sale 45. Credit sale 1 lakh 30. Sir, this sales will be at selling price. I know. That's the reason we find balance figure in branch stock account. Branch stock account. That will be our GP. Sir, what if this branch stock is at invoice price? Then this is invoice price. This is selling price. Difference between selling price and invoice price you will get here. And on this invoice price load, you will remove in branch adjustment account on opposite sides. There, whatever balance and figure you find, also you will write it to branch PL. So ultimately, in branch PL, you will get difference between cost and selling price. Understood? Branch adjustment will have opening stock ಮೇಲೆ load, closing stock ಮೇಲೆ load, branch purchase ಮೇಲೆ load, branch stock transferred, reversed, on that everything load. Their balance and figure will again transfer to branch PL. Nice. So this is over. Then goods sent to branch is also given in the question. How much is that? 60,000. Correct? Seeing it from the question, no? How much is stock sent to branch? Goods sent to branch. Okay. And then return from customers. Customers has returned. That is also again received. Here I have written 3,002 branch debtors. In branch debtors account I have written on the credit side. Already written this item. We wrote it from there. So then what else is there? We have closing balance. How much closing balance? 10 plus 15. 25. So I'll write branch stock. 10 plus 15 closing balance. So this is the balance. This is like gross profit. Like you're getting it? Difference is 52. So in branch stock, I've written branch PL. In branch PL, I'll write by branch stock. So by this, I'm done with petty cash account, debtors account, stock account. Now cash account. They've given opening closing balances. Just write whatever is given. So branch has sold goods. Branch has sold goods. It has received cash sales money. How much? 45,000. You'll write 45,000 there. And then the cash that is received is 165 and 5,000 is not received by head office. This is the money sent by the branch to head office. So that much money will go. This is matched. This is not affecting our P&L anyway. In the P&L, only thing is that branch expense paid 30,000. If we write, we get profit same 15,000. I marked it. If you people think in the order, keep your branch stock, branch debtors, branch expense, branch cash, branch P&L, all the ledgers you keep open. Start the question from the beginning. Each item you go on ticking and wherever it belongs, go on posting. You will get the answer more smoothly. For everything, you think of the journal entry. Expense paid, what is the entry? Cash received, what is the entry? Think of the entry, post it to respective ledger. You will get it. Not difficult. Actually, not difficult. And same thing, whatever we have now, this branch stock is there, no? I will call it trading account. I will not write balance product. I'll write opening stock. I'll not write two cash. I'll write two purchases. I'll not write two debtors. This is sales return. I'll deduct it from sales here. And then I'll not call it branch cash, branch debtors. I'll call it by sales account. Cash sales, credit sales, less sales. I'll not call this balance carried over. I'll call it closing stock. Understood? And I'll not call it goods. Goods into branch, I'll write like that. This I'll not call it branch P&L. I'll call it by gross profit. And below this, I'll write P&L account. I'll not call it branch P&L. This is by gross profit brought. And all of this, I won't write branch debtors. I'll write two bad debts, two discount, two branch expense, and call this net profit. And these ledgers, I won't call them branch cash, branch stock, branch debtors. I'll call it debtors account, cash account, expense account. And then prepare. It will look somewhat like this. Final accounts approach for the same question. Read which one? Which one now? It's a different one, but see, this is how it looks. So these are the ledgers under the normal one. Under final accounts approach, we start rating it as opening stock, purchase, sales, closing stock, gross profit, bring gross profit down, write expenses, find net profit. So this trading account is branch stock account. This P&L account is branch P&L. If it is at invoice price, in branch stock, everything will be at 24, and here it will be at 4,54,000, no problem. This will be at 4,80,000. So this -6, -120, and -12 will be there in branch adjustment. From there, we'll write it to P&L account, trading account. That will look like final account. You're getting it? A regular class, we do it for a very long time, so people understand it much better. Here also, we have not spent anything less. We spent 1.5 hours to understand all the three methods. I hope this made little sense to you. Yes, majority of the times, the question in the examination will be usually on debtors approach, first approach, usually. But there are instances where they've asked you stock debtor system or final. They'll not ask more than one method. They'll ask only one method. They'll ask only, you understand this? So this is how we do under all the three approaches. And then we have the next one called as wholesale price. Okay, I told you, no, whenever the stock is sent at cost price or invoice price, three methods: debtor, stock debtor, and final accounts. Then the next one, when the head office treats the branch as a retailer, then we prepare wholesale price. Shall we see wholesale price method? Very good. This is something similar to our invoice price. Okay. Now, head office cost of goods is 100. Head office sends the goods to branch at 130 rupees invoice price. Branch sells it at 150. So the disclosed profit margin is 20. Undisclosed profit margin is 30. We call that 30 rupees as load, 20 rupees as profit at the branch. What branch? Am I right? We'll change the name. 100 rupees cost, 30 rupees whatever is their inflated price. We call that 30 rupees wholesale margin. And then invoice price 130 is there. We'll not call it invoice price, we'll call it wholesale price. 20 rupees disclosed profit is there. We'll call it retail margin. And 150 rupees selling price there. We'll call it retail price. You understand? Invoice price will become wholesale price. Load will become wholesale margin. Profit disclosed will become retail margin. Selling price will become retail price. First, because head office sends the goods to branch at wholesale price. That is nothing but invoice price. Branch sells the goods at retail price. That is nothing but selling price. Cost plus load, wholesale price. Add retail margin. And this load is nothing but wholesale margin. Understood? Read this. Stock entries in the branch will be booked at wholesale price only. That is nothing but invoice price, except for the sales at the branch, which will be recorded at sale price. Obviously, in the branch stock also we wrote the sales at selling price. Difference became our GP. And load difference has to be removed. Load we remove by opening branch adjustment. Same thing we do here also. They do it by stock reserve. Stock reserve. This is how the ledger will look. Opening stock at wholesale price, nothing but invoice price. On this, the load has to be removed. We'll remove it. And then goods are sent to branch. These are wholesale price. These are like invoice price. Again, load has to be removed. We'll remove it. And then closing stock is at wholesale price. On this also we should remove load. We'll remove it. Abnormal loss. And then we'll write sales. Sales is at selling price. Goods sent to branch returned is at wholesale. By doing this, we get gross profit. No. This is not the difference between cost price and selling price. This is difference between wholesale price and selling price. 130 and 150 difference idu. And 130 and 100 difference 30 we should write, no? Cost 100, wholesale price 130, retail price 150. Here we are writing the cost as 130, selling price as 150. So how much is the profit booked? 20, but original cost is 100, selling price is 150. How much is profit? 50. In the 50, 20 rupees is booked is GP. That is difference between wholesale price and retail price. Difference between cost and wholesale price 30 should be booked. No, where do we write it? Next, ಇಲ್ಲಿ GP ತಗೊಂಡ್ಬಂದ್ಬಿಟ್ಟು here we'll write that profit. Sorry, we'll open stock reserve. There we remove that. We open stock reserve account. There, here this is wholesale price. No, this wholesale price, this wholesale price, this wholesale price. On that we write opposite side. Opening stock and goods into branch credit side. On the closing stock debit side. We write it like this. See, opening stock and goods into branch pay. Sorry, opening stock pay credit side, and on the closing stock and on the opposite side. We remove load. Whatever balance we get in the stock reserve account will be transferred to branch PL account. And then that branch PL balance will get the correct answer. And but this is done at the head office. There what we do, you know, under invoice price method, we do it in the same ledger. Right below that we open one branch adjustment. There only we remove load. Transfer it to branch PL only. Are you getting it? What we do now is we are trying to identify the profit at the branch. That is retail profit. That retail profit will transfer to head office PL. So head office PL may from the branch we book profit of only 20. 30 rupees profit is there, no? That will write only in head office profit and loss account straight. That 30 rupees we straight away write as profit in the head office PL only. Previously what we used to do, 100 rupees worth of goods sold by the branch at 150. You should record 50 rupees profit in the branch name. You are not recording 50 rupees branch profit. We used to record 30 from gross profit. We used to add, 20 rupees we used to book as GP. 30 rupees we used to add to branch PL. So branch profit is to become 50. Now you know what do we do? We'll treat branch as a retailer. So retailer made profit on only retail margin. Retail profit is only 20. So branch in the profit will become 20. My wholesale margin I will write as if I sold to branch and I made profit of 30 here. Ultimately 50 rupees profit. Ultimately 50 rupees. But did you understand this? That's the only difference here. Just everything is same. There we prepare branch adjustment in branch books and transfer to branch PL. Here that branch adjustment is done in head office books and then transferred to head office PL. Head office records ಅಲ್ಲಿ ಮಾಡ್ತೀವಿ stock reserve. We do stock reserve where? Head office record, not in branch record. On this there is one question or maybe two questions. I think there is only one question. If you do this, you would understand. It wouldn't be difficult. If you want me to discuss this question in detail, we'll handle it. So by this we're done with dependent branch. I told you, no, dependent branch. Dependent branch may we need to do debtors, stock debtors, final accounts and wholesale price. Isto adre dependent branch. Now independent branch. Independent branch means what? Branch is maintaining its own records. Branch is maintaining its own records. When branch is maintaining its own records, there are two ways. One, branch keeps records of everything. Branch keeps records of everything. And then at the end, they'll send one report to head office. And head office will include that, consolidate it. Next one is called abridged. Abridged means what? Branch will record, not everything. Branch will say, I will maintain sales, purchase, expense, cash, I'll record. Assets record, I won't. Assets record, you maintain. Expense I'll maintain, cash you pay. So that is abridged. Half I'll do, half you. Or if I'll do everything and I'll give you proper trading P&L balance sheet, I'll give. You just consolidate this into your head office records. That is what is a consolidation of records. You maintain full records. If they do half, I do half, it's called abridged. I'll do half. They would have had the half. We should adjust that and then include it there. Getting it? That is the entries that you have next. Shall we discuss that independent branch? Might sound very difficult, independent branch. I don't know why people also hate independent. Do people hate independent branch? We hate branch only, sir. But it's logical. Tumba logical. Odo avashyakate illa sir. Correct ಆಗಿ ಅರ್ಥ ಮಾಡ್ಕೊಂಡ್ರೆ you don't have to revise it, mug it up the day before exam. You'll be able to handle it. Record all the transactions at the in the perspective of the branch. Branch only maintains the records. After branch maintains all the records, no, branch will tell how much is the balance of head office account in branch records. And head office will tell how much is the balance from branch in the head office records. Both should match. Branch doesn't have capital. Branch gets capital from where? Head office, no. So So when the branch prepares balance sheet, capital ಜಾಗದಲ್ಲಿ head office ಅಂತ ಬರುತ್ತೆ. Capital ಜಾಗದಲ್ಲಿ head office ಅಂತ ಬರುತ್ತೆ. Correct or not? And in the head office books, we won't write individual asset of branch separately. On the asset side, we'll write one thing: Bangalore branch, Chennai branch. In that, if you click every asset, liability, trading account, P&L account, everything will come in detail. So on the asset side of head office books, there is branch. On the liability side of branch books, there is head office. Balances should match. Same amount should be there. If it is not the same amount, why is there a difference? You should do reconciliation. You do reconciliation. For that reason, we maintain this much records. Got it? Okay. So branch prepares a trading P&L and balance sheet. So these are the entries. The goods are sent to branch. Head office will write branch to goods sent to branch. Branch will write goods received from head office to head office. So for everything, there will be ulta entry. Only cash credit, only cash debit. So that way, the set of entries has to be recorded. So when the branch paid, purchase of goods and the money is paid by, what to say, branch is paying it. Head office will not write entry. Branch will write purchase account debit to cash. Branch stock will increase, branch cash will decrease. If it is paid by head office, purchases is made by branch. Payment is made by head office. It is like you go somewhere, you buy something. You'll call your dad and say, I like this, I'm buying. For the photo kalastine, scanner, payment money. So you purchase, payment made by dad. You will write purchase account debit, dad will write cash account credit. Correct or not? You wrote purchase account debit. Credit, you give credit to dad. Correct or not? Papa's gift. Dad will debit your name. You are asset in Papa's balance. Correct, correct. Expense, expense not written off. Don't know how to write off. So still kept in the balance sheet asset side. Okay. That similarly branch expense. Expense is paid by branch, expense to cash. Incurred by branch, expense debit in branch, paid by head office. Head office will write branch debit, branch will write head office. Same thing, goods sold by branch. If cash is received by branch only, branch will write cash to sales. Sometimes it will happen, goods are sold by branch, cash is received by head office. You work hard, you want to get money. So whom to pay money, you give Papa's money will be received by Papa. You will write sales account credit and head office will write cash account. Head office will write branch account credit, branch will write head office debit. One day that will also come where they'll receive money on your behalf and they'll give credit to you. Somewhere they go and they're like, okay, you are his father, no? They're like, oh, they'll feel good. They'll go like, not too far. Yeah, the day will come. Then the cash is collected, cash to debtors. The cash is collected by head office, cash account debit in head office books. Debtors account credit in branch. Branch will write head office debit, head office will write branch credit. You're getting it? It is the same boring entries, guys. Asset is purchased. This depends who's maintaining the asset. If the asset is maintained in the name of head office, ledger is maintained by head office, records are maintained by head office, used by us. We are using the asset. Vehicle is bought, registered in dad's name. Documents are with dad. Only key is with us. Are you getting it? Or no? Head office only buys the asset. So head office will write asset account debit to cash. We will only use it. Sometimes it might so happen you bought the asset, but in dad's name. So head office will write asset account debit. We will write cash account credit. You're getting it? Head office will write branch credit. Branch will write head office. Getting it? So head office has maintained books, but you are using the bike. You should charge depreciation. What do? You will write depreciation account credit debit. Branch head office will write asset account credit. Maintenance of the asset account is made by whom? Head office. Usage is done by whom? Branch. So expense should be booked by whom? Branch. So branch will write depreciation account debit. Asset account credit will be made by head office. Sir, why that way? If you don't book expense in your branch books, your profit will be overstated. Profit will be, are you getting it? If you are maintaining the branch records, asset records, then you will write depreciation account debit. You will write asset. Are you getting it? Observe this. Asset purchased, paid by branch, head office no. Assets are maintained by whom? Branch only. So if it is maintained by branch pays asset to cash. If it is paid by head office, cash account credit by head office, asset account debit by branch. Got it? Depreciation account debit to assets by branch. By maintenance of records is with branch. However, if the records are maintained by head office and the asset is purchased and paid by branch, branch will write to cash, asset will be debited by head office. If it is paid by head office will write asset to cash, branch will write to it. Records are maintained by head office, depreciation expense has to be recorded. Depreciation will be debited by branch, asset will be created by head office. Branch will write head office credit, head office will write branch debit. Understood that? Ultimately, remittance of fund. One person is sending, the other person is receiving. These entries have to be written. They'll ask you these base journal entries. This is difficult. Initially, you had seen this, you had found it difficult. Asset maintained by branch, asset maintained by head office. Oh my god, complicated. It's very easy. Usually, you won't get question. If you get questions, they'll give 4 entries, 5 journal entries. Transactions will be given, you would have to write entries. If they give 4 entries, minimum 6 marks. If they give 6 entries, minimum 8 marks. Very less probability in exam, but it has come. This independent branch entries, and sometimes they'll ask this entries based on this abridged and consolidation, also incorporation of assets into head office books. Yeah, little boring but easy. In head office books, branch will be there as an asset. Branch account 1 lakh. That branch account, if you open 1 lakh, why is it 1 lakh? There is assets worth 1 lakh 20, there is liabilities worth 20. So instead of writing branch account 1 lakh, you will write asset A account debit, asset B account debit, asset C account debit, asset D account debit, to liability A account, to liability B account, to liability C account, to branch account. Instead of writing branch 1 lakh, you will write 4 assets, 3 liabilities. Assets minus liabilities will be 1 lakh only. That is nothing but entries of detailed consolidation. Head office account debit to credit all the assets. Here debit all the assets and then credit branch. Same thing like how we do in amalgamation, transfer of assets. No, only group 1. You understood this? This is easy. You just have to see it once and you will love these entries. And ultimately, lastly, we have one thing in this chapter called as foreign branch. What is it called? Foreign branch will be classified into 2 categories: integral operation, non-integral operation. Integral operation means that branch is there, no, that is my extended operation. Non-integral means that's not my extended operation. But however, for the purpose of understanding, there are 3 words given: management decision, no, course of finance, so quantum of transaction. If it is dependent on head office, if not integral. Meaning head office will take decisions for branch. Head office will make financing for branch. Head office will send the goods to branch. Majorly, it is dependent upon head office for decision making. That is integral branch. Not, it can buy the goods on its own, it can sell the goods on its own, it can raise the funds on its own, it can borrow loan from anyone on its own, it can decide the selling price on its own. Domestically dependent, independent ಇರುತ್ತಲ್ವಾ, foreign ಅಲ್ಲಿ ಅದೇ ತರ integral, non-integral. But the difference why I didn't tell dependent independent is, in India when we say inland branch, dependent independent andre records maintained, records not maintained. Practical case mein dependent means dependent upon head office for decision making, independent means not dependent on head office for decision making. But in accounting, when we say dependent, records maintained, records not maintained. Records maintained by branch, records maintained by head office, alva. When it is a foreign branch, records has to be maintained in the foreign country, in the foreign currency by the branch, whether dependent or not dependent. They have to maintain records. They cannot say, no, every sale bill I'll send you the invoice, you write that. No, you have to maintain accounting. Why? That country also will have some rules. You're getting it? Unless you have created in some holiday country, Maldives, so Mauritius, so Cayman Islands, so where there is no one. Ella like 10,000 people, 20,000 people will be there. There are 1 lakh companies incorporated. Cayman Islands and all, population is less than lakh, but number of companies incorporated is so many. Cayman Islands and all, Vodafone case, all this, they're all tax holiday countries. So what they do is they incorporate company there, and that will become the holding company of several small subsidiary companies. And whenever they want to sell a company, now assume that I have a land in Bangalore, I want to sell that land in Bangalore to Sriniti, Shri Sirish. I want to sell one land to Sirish. If I sell one land to Sirish, then you will say cost of acquisition, indexation, ella seri LTC yaaki rupi ದುಡ್ಡು ಕಿತ್ಕೊಂಡ್ಬಿಡ್ತಾರೆ, income tax. So what do? I'll buy a land in India, not in my name. I'll create a company in Cayman Islands. That company will buy land in India. I want to sell land to him. I will not sell Indian. That Cayman Islands may have shares, no. I will sell that shares to him. I was the owner of that company. I was the 100% shareholder of that company. Now he becomes 100% shareholder of the company. You getting it? If income tax department, sir, I say I don't have any car in me. I have shares. That shares is 10 rupees. I sold it for 10 rupees. Taxation also you do. They it will happen there. See, this is how all this Vodafone case happened. You read this Vodafone case. What happened? Vodafone case. What happened is that India, mein Hutchinson SR was there. No, that dog pug used to walk. That was selling their business. So when they're selling their business, Hutchinson SR, there was a UK-based company, Hutch, that had Indian operations called Hutchinson SR. Hutch was selling its business. Vodafone was interested in buying the business. They didn't do anything in India. That Hutchinson SR was there, no? It was controlled by a company which was there in Cayman Islands. That Cayman Islands company shares were transferred from Hutch to Vodafone. Income tax department told there is sale. Give me tax. They told Vodafone that India mein Hutch was there. That told boss, I don't know. I am doing my business. How, there is no sale happening here. Are you getting it? Then they asked Vodafone. Vodafone told, I didn't even keep my feet into India. Sorry, boss. How do I do it? I don't do it. Why? I didn't even come to India. Why should I pay? Then that Vodafone Hutch's parent company is there. They told, boss, did I even sell one share of Indian company? Oh, then why are you asking? So then income tax department was strict here. They're like, man, what did amount of money involved in that was very huge. So they wanted to somehow prove it. Then you know what happened? India's Hutch company changed their name to Vodafone. Then they're like, you are an agent of a foreign company in India. You have the responsibility to do TDS. Why did you change the name from Hutch to Vodafone? Because they told, who's he? Your boss. You are an agent of a foreign company in India. Your ownership is getting changed. You should do TDS. He's like, hey, boss, the one who's paying consideration will do TDS. I am the one who's being sold. Why should I do TDS? The question was told. Then they made some retrospective amendments in the tax laws to bring that under the tax bracket. This is, and then the international, what to say, no, fight, disruption, international dispute, or there is this better word. So what they told is that if government has a right to change the law retrospectively to bring an contract under the taxation agreement. See, they read the taxation agreement. To counterfeit the taxation agreement and to go beyond and taxation doesn't come, they plan their contract. After they plan their contract, if you're changing the taxation laws to include that into the thing, then you should also let us to cancel that contract and then redo the contract in such a way that it doesn't attract tax again. So that's where the entire faith in the Indian economy was questioned, and people told we will not be willing to do business with India. They're going to change their tax laws prospectively. So that is the thing. Read sometime when you have free. Not now before exam, but read later. It's a very interesting case, even to today's date. Integral and non-integral. Classification as integral, non-integral is based on these things. Now, why do we segregate it into integral and non-integral? Because the rates applicable are different. If it is integral operations, then what do we do? Opening stock, we'll try to apply actual rate. Opening stock will not be on a specific date, no. Opening stock, what is there in the foreign branch, when it should be converted to domestic branch, we'll apply the actual rate. If the opening stock includes stock which has come from 3 different dates, the 3 different units which were sent on 3 different dates, what was the rate? That rate we should apply. If that is not available, then we'll apply the opening date. If it is non-integral, then what? They are doing it as an individual operation. No, we will not have so much data. Opening date may whatever rate is there, on that date we'll apply that rate. Are you getting it? For the goods which is sent, we'll not apply any rate. Why? Head office is only sending goods to branch. No, we know the actual value of currency, such goods in Indian currency. We'll rate that Indian currency. Remember, it is not conversion of foreign currency to Indian currency. It is conversion of foreign currency to reporting currency. That's where AS 11 is applicable. If the branch is there in India, head office is there in US, then AS 11 will be applied to convert the branch records which is there in rupees to dollars. AS 11 is applicable for conversion of branch records to reporting currency. It is applied for converting branch rate to head office rate, not head office rate to branch rate. That's one thing that you should remember. Then closing stock, again same thing. If actual rate is available, actual in integral. If actual rate is not available, closing rate. Non-integral, it's like separate entity. We'll apply closing rate only. Done. Then for revenue items, average rate, purchase, sale, and everything. Each purchase, each sale, we can't go on doing the rates. We will write average rate. And for monetary items, items which can be quickly converted into cash, current assets, current liabilities, we'll apply closing rate. For non-monetary items, we'll apply original rate. We'll apply original rate. In the case of integral, non-integral, closing rate. Sir, then depreciation, what rate do we apply? Depreciation, what rate do we apply? Now there is an Indian company which has a branch in the foreign country. It has assets in the foreign currency. It is depreciated. Depreciation closing rate. Some people say closing rate. Why, sir? Depreciation is computed on the entire. But depreciation is for the entire year, no? Average. You know what you do? Foreign currency asset is there, no? Depreciated. After depreciating value, you will get no asset. That you convert to domestic. Get the logic? Don't apply any rate on depreciation. First full depreciation you do. Full depreciation. After depreciation, you get the value of asset. No? That asset you convert to domestic. Same with regard to provision for doubtful debts and a lot of other things. Wherever it has to be adjusted. Okay. Then head office balance. Head office books may branch balance will be there in domestic currency. In branch books, whatever is there, that should match. He'll adjust it. Any difference that's arising, in the case of integral, it will transfer to P&L. Why? Num there. My own extended arm, no, will transfer to P&L. If it is non-integral, we'll write it to foreign currency translation reserve account. Why? This time there is positive difference. Next period it will become negative difference. So don't book it as profit. It will get reversed. It will get reversed. Keep it there. Go on changing till the time branch is closed or head office is open. That day we'll book it as profit. Till then we'll keep it like that. FCTR, foreign currency translation. So whenever the question is given, try and identify whether it is integral or non-integral. So how do we get a question? Given the question. If they give integral, then remember, try and apply actual rate on opening and closing stock. If not available, opening stock, opening rate, closing stock, closing rate. Revenue items, average rate. Monetary items, closing rate. Non-monetary items, opening rate. Non-monetary items, transaction rate, actual rate. And when it comes to non-integral options, what do we do? Opening stock, opening rate, closing stock, closing rate. Revenue items, average rate. And then monetary items, closing rate. Other items will apply non-monetary items also closing rate. Not original. Non-monetary items also closing. If it is integral operations, difference that is arising between the balance, head office books only, branch balance will be there in domestic currency. When you change all of these numbers in the branch records, in trial balance you will change or not in balance sheet. Where do you change? In the trial balance, when you change that balance in the branch books, head office balance will change. That difference, what is there, will be transferred to P&L. Where? Integral operation. Non-integral operations, transfer it to foreign currency translation reserve account. Whatever is that one question that I want you to try on this, I put it here. Here only. Answer is there. I put question number also with explanation. I would want you to try this, and I hope you will understand when you do. Got it? I don't mind doing a question on this, but we've already spent 2 hours on branch. Got branch?